morning, everyone. Yes, it's indeed a very good morning. Welcome to Yeshas Academy. Once again, to all of you people. Hopefully, for one last time for CA Foundation Accounting, because you never be sitting in CA Foundation class ever again. So we are here for marathon revision of CA Foundation Accounting for January 2025 examination. Right? Okay. Unlike Team India, we should not struggle to be scoring those 200 runs in either of the innings. And right now, it's not a test match, it's a T20 match. That's in a way good thing because consecutive 200s were scored in the T20 match if you compare like against Bangladesh, unlike against Australia in a VGT. So may your Virat Kohli score 100 in accounting in CA Foundation, and may your team score 200 in CA Foundation. And on this note, are we ready to start with CA Foundation accounting? Very good. So to begin with, let's understand the word accounts. You might have spent a lot of hours learning accounts. So let's still start with the footsteps on what is accounts. So when we start with the word what is accounts, the history of accounts goes way, way back. Not the day you started your first PUC accounts class, or not the day when you first heard about accounts when you were in 7th or 8th standard. This goes way behind time. So behind that, people were living in caves, and people were not wearing clothes also completely. They were wearing animal skin and then leaves around. And then they used to write these lines on the walls to keep a track of the number of days that they survived, or maybe to keep track of the cattle that they have. So that's the historical significance of the accounts. Ever since that day to the modern day, where you are flooded with messages on Telegram, where you're flooded with messages on your WhatsApp, Snapchat also, I didn't put that image though, or Instagram, or email, or the message that comes in the morning telling how much is your bank balance. Everything is account. Instagram is an account. Snapchat is an account. Facebook, what your mom uses, is an account. Get it? And that LinkedIn account, Gmail account, everything is account. So from the time Arliman drew lines on the wall to the modern time, when you check your Snap in the morning, everything is flooded. Everything is basically running around the word account. So what do we mean by accounts? Is it all of these? Accounts in generally means a very, very simple thing. It is a count of. Is a count. There is a small space between the word, between the letter A and between the rest of the letters which spell as count. So it is a count, meaning a systematic track or record of things. Anything you keep a systematic track or record of is accounts. You keep a track of how many people entered the class, how many people left the class, accounts. A watchman keeps log of number of people entering the mall, accounts. You keep track of how much collection is made by Pushpa 2 movie, that is also accounts. Two, you keep a track of how much capital does the partner bring, how much money is left in the case of dissolution, how is the equity shares issued, how is preference shares redeemed. Everything is accounts, but we are restricted to that part of accounts which deals with money. The case of sole proprietorship, partnership, and company, NPO, in our syllabus of CA Foundation. So accounts is much more than what you read for 100 marks in CA Foundation exam. The definition of it for once was given by AICPA, American Institute of Certified Public Accountants, in the year 1941. Don't have to muck up the definition, won't be asked for 2 marks. This is not second. But every part of this definition, whatever we have, no, the words that you see there: recording, classifying, summarizing, analyzing, interpreting, communicating, significant manner, what do you mean by in terms of money, transaction, event, all of these words in this definition will be dealt with the chapter 1 and chapter 2 of your syllabus. So the definition of the word accounts is not read in first 5 minutes of accounts class. It is what you read over the first 2 days of your account syllabus, or maybe like first 2 chapters of your accounts syllabus. So in short, let's just test our audio, whether, let's check if it's working fine. Can you read out the definition for me, please? What is the definition of the word accounting? Accounts is the in a significant manner and in terms of transactions and events which are in part or at least of financial character. Analyzing, interpreting, and communicating the results thereof is also part of the same. For now, let's focus on the word transaction and event. So throughout in accounting, what we deal with, what we identify, what we record is all transactions and events. What do you mean by a transaction and what do you mean by an event? So any human activity can be classified into two: one economic, other one non-economic. Non-economic activities, leave them, we are not going to care about it. Whatever is an economic activity, It is called economic if it affects money or money's worth. That specific human activity affects in money or in money's worth, it will be called as economic activity. This specific economic activity, if it affects business, then it will become transaction. So human activity, which is an economic activity which relates to business, is a transaction. So firstly, it should be a human activity. That human activity has to be an economic activity. Such an economic activity should be relating to business. Then it will be called as, we do recording, classifying, summarizing, analyzing of transactions. Got it? So let's see. What do you mean by a transaction? Read this. Is an economic activity in relation to. Very good. What do you mean by economic activity? Which affects money or money's worth. Which affects money, or it can affect money's worth also. Why? Because not every time it is cash settled. Sometimes the settlement is postponed. So what do you do when you record a transaction on credit? You measure it in terms of money and then record it. At a later date, it will be settled. Till that date, it is not a cash transaction. It's a credit transaction. It will be settled in cash later. As of now, it can be measured in terms of money, but it's not definite amount of money. Get that? So such a transaction is also, sorry, such an event is also called as transaction. Got what I'm trying to tell? Very good. So then let's have a small activity now. So all you have to do is you'd have to help me classify the following items into transactions and not a transaction. Shall we do that? Very good. If it's a transaction, it's a green. If it's not a transaction, it's a red flag. But say I'm going to put green and red flag next to the statement here. You guys are 16. You act like some 25, 26 when I say, okay, still close to 16, not close to 25. Green flag, red flag. Oh, green flag means go. Red flag means stop. Okay. Started business with cash of rupees 1 lakh as capital. Tell me, transaction or a transaction? It's a transaction. Why 1 lakh rupees money is getting affected? It is bought in as capital relating to business also. Yes, that's a transaction. Let's see the next one. Filled a bank application form. Received passbook and debit card. Transaction or a transaction? Why? It doesn't affect no money or money's worth. What? You open one bank account, you received passbook, you received debit card. Where is money involved? Get it? There is no money involved. Maybe Jandan Yojana, like zero balance account. What if you deposit money into the same bank? 70,000 rupees. It is affecting money. Money 70,000 is going into the bank. What if I say that you purchased a plant, not the plant for which you put water, a plant which is used in the manufacturing process, or by paying rupees 20,000 by check? Transaction. You pay, but you did not give cash. Check is given. No, you get what I'm trying to tell. And a plant is bought. Money is worth. Very good. What about appointed workers for operating the plant? That plant will not work by itself. So you appointed workers. Because appointing them doesn't affect you economically. But paying them salary does. What if you pay them wages? Transaction. Next one. You received free sample of raw material. The material what you should use in the production. No. The supplier, he gave you free sample. You'll check it. If you like that quality, you buy the rest of the goods. So before ordering, he gave you sample of raw material. Transaction or a transaction? Free samples. You also learn journal entry for free samples. Transaction or a transaction? Receiving free samples is not a transaction. Issuing free samples is a transaction. Why? You give free samples as advertisement. You receive free samples as their advertisement. You think from your perspective. To you, you are testing the quality of the product before you buy. To you, it is not a transaction. Got it? Then how about issuing price list to customers? Menu card to give to a restaurant, no? Or you give that list of prices. Transaction or a transaction? This is invitation to offer. This is not even offer. Sorry, not law class. So this is price list given. This is inviting to do a transaction. This is not a transaction. Got it? Then next one, issued free samples to customer. Idu transaction. This is a transaction. Receiving free samples is not. Issuing free samples is. Are you getting it? Fantastic. One last one. Okay, sold goods to customer. Obviously, if this is not transaction, I don't know what is. Correct? So this, my friends, is a transaction. So I hope you're getting warmed up with the basics of the things. We're gonna go slightly slow. We're gonna pick up speed slowly, slightly later, and we're gonna do chapter 1 and 2. We're not gonna skip it. Okay, one moment. Take a 10 seconds. Okay, we just learned what is a transaction and what is not a transaction. Let's now these transactions have been categorized. How do we categorize the transactions? Can anyone tell me how many categories of transactions do we have? Cash, credit. That is on the basis. Oh my God, they had easy entry. Close the door. Come early tomorrow. So categorization of the transaction is based on different bases. Based on settlement, it is cash and credit. Based on people involved, it is internal and external. So categorization of transaction depends upon two bases. Number one, settlement in cash. A settlement in cash basically there are two. One is cash, other one is credit. And what is cash transaction? It is settled immediately by cash. You purchased goods, you immediately gave cash. You sold goods, you immediately received cash. Or the employee work, you immediately give him salary. So a transaction which is immediately settled in cash or cash equivalent immediately, that would become what? A cash transaction. It can be a receipt, it can be a payment. Credit transaction is where the settlement is postponed to a later date. The purchase happens today, payment will be made later. Sale happens today, receipt will be booked later. So that will become a credit transaction. And we have a decision making here as to how do we decide whether a specific transaction is a cash transaction or a credit transaction. Very, very difficult to focus correctly. If the transaction specifically states that it is a cash transaction, then it is cash transaction. If the transaction specifically states that it is credit transaction, then it is. Wow, so beautiful. What if the transaction doesn't tell whether it is cash or credit, not mentioned? Then what to do? Then we have to check whether the name is mentioned. Check whether if the name of the party is mentioned, then it is credit transaction. If the name of the party is not mentioned, then it is cash. I'll repeat. If the transaction mentions that it is cash, then it is. If the transaction mentions that it is credit, then it is. If the transaction doesn't mention cash or credit, then check for. If the name is mentioned, if the name is not mentioned, very good. Why? It's like this. Someone comes to your shop, buys goods from you. You give them the goods, you collect the cash. What if I come to your shop, I buy goods from you, and I'll say I'll give the money tomorrow? What will you do? You'll ask, no, yeah, Nesro. Why you want to write down my name? No, that I should have to give you money tomorrow. So when you have to book a credit transaction, least thing that you'll do is ask their name. So when the name of the party is mentioned and it's not mentioned whether it is cash or credit, go with. And lot of times they won't straight away mention cash is received, cash is paid. They'll use different kind of language. Receipt is made, payment is done, or they'll use some English synonyms. Be slightly careful there. Whenever they use the word paid, received, settled, or any other synonyms, it still means it is cash transaction. Okay, cool. Let's understand what is internal and what is external transaction. Shall we? It depends upon the people involved. If there is no external person is involved in a transaction, it is internal transaction. If there is an external person involved in the transaction, then it is called as an external transaction. So simple. So what is it? If it doesn't involve another person, then it is internal. If it involves another person, then it is. Shall we take a quick demo of transactions and then tell whether they are? Take your earphone out tomorrow to the class on time. Yeah. So let's see. We have a set of transactions. You should help me tell whether it is internal transaction or it is. Shall we? Come on. Look at the first one. Started business with cash of rupees 1 lakh as capital. Internal. There is no external person involved. You get it? You and your business. That's it. Then deposited 70,000 rupees into bank. Internal, external. It's an external transaction. Why? Bank is involved. Sir, bank means my bank. Bank is an external person. It might be your bank account, but that bank is another person. No? Then how about purchased plant by paying rupees 20,000 by check? Paid by check to somebody. You purchase plant, no, you purchase from someone, no. That person exists. So this is again an external transaction. How about paid wages to workers? Internal. Oh, interesting. That person to whom you're supposed to pay is an external person. Users of information is different, as a person is different. When you say outstanding wages, do you owe money to yourself? No, you owe money to an external person. That is an external transaction. Then how about purchase goods for rupees 2,500? External transaction. How about goods not insured, destroyed by fire? Internal. Because it is not insured, you cry alone in the corner of the room. So this is internal transaction. What if the same goods are insured? Why insurance company will come to give handkerchief and ask you not to cry? Why? Don't worry. Yeah, jo tera hai wo mera hai. Your loss is like my loss. I will compensate. Okay, depreciation charged on the plant, internal. Okay, it's only you and your plant. There's nobody else there. Get it? You depreciate its value by 10%. So by this, we're done with our internal external part. We can do a kutti question on identifying credit and cash. Shall we? We'll hardly take a minute. Come on, quickly help me with this. Started business with cash of rupees 1 lakh as capital. The question itself is no cash of 1 lakh. Next one, deposited 70,000 into bank. Cash transaction. Fantastic. Purchase plant by paying 20,000 by check. Cash. Check, yeah. It is still settled. He might deposit the check on any given date. You settled right now, no, by giving check. That's a cash transaction. How about paid wages to workers? Very good. How about wages outstanding? This is not settled in cash. This is deferred. You need to settle it at a later date. This becomes a credit. How about purchase goods on credit? See, that only tells no credit. It's a credit transaction. How about purchase goods from Kiba? See, they've not told cash. They've not told credit also, but they mentioned name. So this becomes a credit. Got it. How about sold goods to Sakura? Rupees 7,000. They've not told cash. They've not told credit also, and they've also told a name. So how about sold goods to Sasuke for cash? They've told name. They've told name. Doesn't matter. When they tell cash, it is cash. Fantastic. Cash transaction. So by now you understood complete part about transactions. Now, what do you mean by an event? Before we go to who's the father, what do you mean by an event? The result of a transaction is an event. Result of a transaction is an, for example, you purchase goods, you sell goods. You purchase 10,000 units, you sell 8,000 units. You're left with 2,000 units of closing stock. That becomes an event. Okay, sir. Everyone tells the same example. Tell something. Okay, you incurred expense of 10,000. You booked income of 12,000. Net profit 2,000. Event. You write journal entry for transaction. You don't write journal entry for event. What is a journal entry for closing stock? When you write trading account credit side, buy closing stock. You write closing stock account, buy closing. Debit side, you write two opening stock. Do you write opening stock account? No, two opening. They are events. When you write buy gross, two gross profit. Do you write gross profit carried down or do you write two gross profit account? That is an event. Event. It is resulting from transactions recorded in trading. Net profit. Event. There is no journal entry for net profit, gross profit, opening stock, closing stock, because all of these are events resulting from a set of transactions. Everyone got it? Very good. Yeah. So who's the father of accounts? All of this we discuss in the regular batch. Usually long ago, Italian mathematician was there by name Luca di Pacioli. He was writing a book on arithmetics, Luca di Arithmetica Geometria Proportioni et Proportionalita. And in that book, he was telling how to recognize the net worth of a businessman. And then he wrote about the practices of accounting already followed by people in the city. That became the first reference for modern method of accounting. And Luca di Pacioli is recognized as the father of modern method of accounting. Will not be a question, don't worry. However, the earlier reference to accounts is there much before that. Chanakya or Chandragupta Maurya's teacher, you remember? So when he wrote the book Arthashastra, so in that book he has mentioned about how to do accounting, how to do auditing, about management, warfare, everything. So that in fact is the earliest reference available to the world accounting, even way before the civilization existed in the West. It's okay, we are way ahead of time. So let's not worry about the history right now. Let's focus on accounts. How do we approach the word accounts? How do we do the entire accounting that's there in the rest of the chapters? Very simple. Universally accepted approaches are two. One is the UK approach, which is the traditional approach, and other one is the US approach, which is same thing. What to say, made to look differently, and they call it American approach or modern approach. There's nothing so modern about it, but yet widely. So many approaches are there? Two. One UK approach, one US approach. UK approach is also called as traditional approach or golden rules approach, and US approach is the modern approach or the accounting equation. So this is the UK approach, English approach or traditional approach. We have US approach, American approach or modern approach. But what we usually follow is our Bangalore approach. Yeah, see, to make Bangalore get the recognition across the globe, so we have something called as Bangalore. Kale ಕಾಣಿಸ್ತಾ Red Fort, UB City, Chalukya Circle, MG Road, Church Street. Okay, let's see what exactly do you mean when you say Bangalore approach. So you make a very tight fist and then like punch it. When you punch it, your knuckles start hurting, and then what you punch, the moment you punch, the sound that comes is called as bang. And then you open the rest of the fingers. Each of the finger will take the rest of the letters in the spelling of Bangalore. So bang, allo, A-L-O-R-E. A for assets, L for liabilities, O for owner's equity, R for revenue, E for expense. And in this, A for, L for, O for, R for, E for, in this, no, assets and expense together. If it increases, it is debit. If it decreases, it is credit. Asset and expense together, if it increases, it is debit. If it decreases, it is credit. The rest of the fingers, liability, owner's equity, revenue. If it increases, it is credit. If it decreases, it is debit. So this will cover the entire process of accounting that you should do for the rest of the chapters. Works everywhere, works fine. Asset and expense, increase debit, decrease credit. Liabilities, owner's equity, revenue, decrease debit, increase. Does that help you? Fantastic. Next, we have to focus on the golden rules. Golden rules we know, no? There are 3 rules. Do you know them? Yeah. 1, real account. 2, nominal account. 3, personal account. What is the rule for real account? Debit what? Comes in. Credit what? Nominal account. Debit all expenses and losses. Credit all personal account. Debit the giver of benefit. Sorry, debit the receiver of benefit. Credit the giver of benefit. Don't forget the word of benefit. Debit the receiver, credit the giver. What did you do benefit? Had for breakfast. No, please state the rule completely. And how many types of accounts do we have? Previously, MCQ में beautiful question this used. Now it is little less interesting. How many types of accounts are there? Very good. 2, not 3. It is 2. For 3, no, real, personal, nominal. No, it is personal and impersonal. Later, personal accounts are divided into real personal, artificial personal, and representative personal. And impersonal accounts are divided into real and nominal. Understood this? What do you mean by real personal account? I am a real personal account. One who have skin, blood, bone, natural persons. Natural personal accounts are real personal accounts. What do you mean by artificial personal accounts? Artificial personal accounts are persons created by law. Persons created by partnership firm, LLP, company, bank, cooperative society, union, HUF. All of these are artificial personal account. What do you mean by representative personal account? It represents a real or an artificial. It represents a real or an artificial person. For example, when you say outstanding salary, it is representing an employee who is a real person. When you say sundry debtors, it is representing a debtor who supplied goods to you, who might be a company or a partnership firm. That is representative personal account. Understood all 3? See, this is the speed at which we'll go. Is it okay? Very good. And then we have impersonal accounts. Impersonal are 2, real and what do you mean by real account? Real account represents accounts of assets. Nominal account represents accounts of expenses and income. I'm not going to go deep into it and then help you understand the definition in detail, but can I run through it? Very good. Okay. Then after this, we have our US American approach. This US American approach looks like they've stolen it from our Bangalore approach. Same to same. Asset and expense, increase debit, decrease credit. Capital, liability and income, increase credit, decrease debit. Oh my God, they've stolen. No, I've stolen it. Indianized version of American approach is Bangalore. You guys get it? Just like an American citizen's job, we've stolen their approach also to make it into Bangalore style. Okay. The same thing, yeah, what we learned in Bangalore approach. Just to make it feel more native, I've given it a touch by telling them. Otherwise, nothing creative. Okay, we have to know the definition of the word asset, liability, expense, and income. I hope you people are aware of that. So can I skip that? Okay, we just skipped accounts, assets, liabilities, expense, income definition. Okay. Okay. Yeah, please read through that. I'll keep telling you points that I'm not doing, what I'm expecting you to study. Please read definition of asset, liability, owner's equity, revenue, and expense. Not because it will come for a 2 marks question in the exam. but because it's important for you to know, because you're learning accounts for life, not for an 100-mark exam where you want to score 50. Okay, what do we have after that? Why do we have to read accounts? So this is the last topic that's there in the first unit of the chapter. Objectives of accounts. The accounts help us keep a systematic record of transactions. Accounts help us identify the financial performance of the entity as well as the financial position of the entity. Accounts help us know the solvency position. Also, accounts will help us take decisions. Very important, can come as a theory question. Lot of marks do come as theory. Don't take theory lightly, don't skip theory. Are you getting it? If in case you get a question with an adjustment what you don't know, then you have to fall back on the theory part. Get it? If you want to skip something, skip it in the exam hall, not when you are preparing for the exam. Got it? Objectives of accounting. What are the objectives? Read. Come on. Fadafat. Number one, systematic record. Number two, ascertaining financial performance. Number three, ascertaining financial position. What's after that? Decision making and solvency position. Got that? Very nice. Then we need to also make a note of financial, sorry, what is the functions of accounting? What are the functions of accounting? Very simple. We need to know how to do measurement. Basically, it's about measurement of transactions and events in terms of money. We need to do forecasting. Forecasting is predict the future. Not exactly, but we need to forecast what will be the profit in the next year, next to next year. Based on that only we'll arrange our resources. No. Third one, like I told you, decision making. You need to make decisions whether to expand the business or to reduce the size of the operations, what product to sell, what product to not sell, all of this. Next one is comparison and evaluation. You need to compare your business with someone else's business. No, only then you get to know whether you're doing better or not. You need to compare your business with previous year's business also. If you can't compare your business with previous years, then again, how else will you know whether you've done better than last year? After comparison, you do evaluation. That statement, whether you're doing better, not doing better, all of that. Finally, to have control over your business, you need to have accounts, and government wants you to maintain records. When you file your income tax return, you need to tell no what profits do you have. And as a company, you need to file your annual accounts regularly. And even simplest of the thing, the cashier in your company steals the cash from the cash box and then runs away. Police also ask for records of your cash book. He wants to know how much cash was there in your cash box. Are you getting it? Can you say, sir, actually black money was there? Can you tell no? If that is the case, you can't even file a case. If you maintain right records, then you can file a case in the event of robbery. Or let's say your goods catch fire. You need to provide stock records to the insurance company for them to upload the claim. If you have not maintained records, then lot of regulations you have not complied. As per Income Tax Act, as per GST rules, as per excise duty rules, and as per what you say normal maintenance of books of accounts companies act, as per every other act you have to maintain records. And even government tells no, our IT sector has increased by 20%, per capita income is this much, GDP is this much. Government makes the statements. How do they make it? Based on the records you maintain and based on information you provide to the government at the end of every year. Got it? Even the budget of the country is made based on the records that you maintain. Oh, that is the reason, sir. We give wrong information. Obviously, when you don't maintain completely correct information and then give wrong, incorrect information, the policies made by the government based on that also will be incorrect. So, limitations of accounting. What are the limitations of accounting? Accounting keeps track only of quantitative data. Entire qualitative data is ignored. Do we keep a record of qualitative data? No. Qualitative data is ignored. The feedback of the customer, a very important employee hired, the CFO of the company dying, or any of this important qualitative information is ignored. And it keeps track of only historical information, like what happened long ago. Price level changes, inflation is not considered. Accounts is biased. Biased means what? Rules are different for different people. I follow different policies, you follow different policies. Our profits will be different. So, in fact, I can select such an accounting policy which will give me the kind of profit I. Let's say I want to show more profits. I'll select such accounting policies which will give me more. They do that. Yes, that is what we call window dressing. What we call accounts can be used to dress up the window so beautifully that people outside will think the building is beautiful looking at the window. ಒಳಗಡೆ ಬಂದ್ರೆ ಗಬ್ಬು ಗಲೀಜು. Get it? No? Because financial statements is what people see. Now I want to invest in one company. What do I see? I see that company's financial statement. I don't go sit there, see each journal entry and then each transaction. So financial statements can be drafted in a deceiving way to make me take wrong decision. So accounts can be deceiving. Windows books of accounts can be window dressed. These are the limitations. Got it? Again, can be a 4-marker question. One of the most probable question in your syllabus in chapter 1 is role of an accountant in the society. What works can a chartered accountant do in the society? So there are various sectors in which he can work. In the service sector, the accountant or a chartered accountant can basically help maintain books of accounts, do audit of books of accounts. Audit can be several types: internal audit, statutory audit, incorporation of company, winding up of company, arbitration services, consultancy. Lot of services can be provided by an accountant in the society. You guys getting it? If in case you want to like entire thing what is there in the ICS statement, I've converted into bullet points and crisp note. At any point, if you want to take a note of this, no, don't try to click a picture in the class. It won't happen. So right now, try to listen to what I say and then try and understand. If you still want, however, the YouTube upload will happen sometime later. Go back to YouTube, pause at that point, click a screenshot, or pause and then read or write, up to you. If you've already written it, very good. If you have not, then you can use it that way. Is that okay? So these are the services that a chartered accountant can provide. So we are always required, whether the industry is in boom or industry is winding up or industry is terrible. In the case of a very nice industry, booming industry, everyone is incorporating companies. We are required for incorporation, drafting AOA, drafting MOA, getting the incorporation done, applying for availability of name, applying for directors identification numbers, everything. If the market is not doing good, full bad state of market, still we are required. Why? Everyone has to wind up the companies for liquidation process, for sale of assets, for settling liabilities, for redeeming debentures, for redeeming preference shares. So either of the cases, an accountant will never be having no work. Any whether the company is doing profit or doing loss, you would have to pass journal entry anyways. Whether the employees are getting salary or not getting salary, you would have to write journal entry for outstanding salary also. So don't worry, you will always have work to do. Next one, instead of giving services, you can work in an industry. There are various segments of the industry where you can pick your work from. You didn't know? You didn't know that it was there. Then don't come. Why did you come? If you don't know, how did you come? Whose mistake? You don't know? January 12th, 2 o'clock examination. Remember? Then later you should not tell I did not know. Come, first row. Close the door correctly. For a guy, you should remember the date. How can you forget? There will be people waiting. Can't make them wait for long. Remember the date, no? Industries where you can work in as a chartered accountant is accounting industry, costing industry, finance industry, budgeting industry, taxation, treasury management. These are the industries in which you can work. And instead of that, you can get into public sector enterprises, PSUs. PSUs is your BHEL, BML, SBI, LIC. All these are called as public sector undertakings. In these industries also, you can work in finance department, budgetary department, accounting department, auditing department, reporting department. Or you don't want to give service, you don't want to work in industry, you don't want to work in PSU. What can you do? You can help the country's fiscal policy to be framed. Now the finance minister comes out now in the month of February with budget. Get it? So man will not sit previous night and write all of those. There is an entire team of people who sit there and then churn those numbers, make those policies. That team of people will definitely include chartered accountant. Can be part of it. You can either work for Srimati Nirmala Sitharaman madam, who's the finance minister of the country, or you can work for Siddaramaiah uncle, who's the chief minister and finance minister of the state. So both at the state level and at the central level, there is finance ministry who need help in framing fiscal policies, and that is definitely done by a group of chartered accountants, or the group which includes chartered accountants for trade, commerce, industry, as well as public goods and services. Or in your own way, you can help in nation building for its economic growth. You get entrepreneurship, entrepreneur andre business model. So you can help in doing business also. You have to be slightly cautious about this question. I'll tell you what is the mistake that people do in this question. asked more than 2-3 times, okay, in the exam, this question. Sometimes they ask, what is the role of an accountant in the society. When they ask what is the role of an accountant in the society, you will write service, industry, PSU, framing fiscal policy, economic growth, everything you would write. But if the question specifically says what are the services what a chartered accountant can offer, then you should never write industry. You should come to specifically services and write each of them. Are you getting it? So the question has been never asked what services can a chartered accountant offer in industry, or what can you do in public sector enterprises. That's not been asked. They either ask role of an accountant or they ask what services can you offer. So one of these two can be asked. Please be slightly prepared. It's been asked in the past also in the exam. 4 marks, 5 marks question. Okay. Yeah. Usually comes along in that first true or false question or the last question. So last question is usually the easy question, but usually people are unprepared for theory, those skip that. So don't be the one who skips it. Got it? So by this we are done with the introduction part, and I wanted to do this very clearly so that you get a starter to read, because you never read otherwise than in the times where I would ask you to. Next, we will do concepts and conventions. After we do concepts and conventions, then we will understand that provision, contingent liability, contingent asset part, and capital revenue, and then we'll go to chapter. Is that fine with you all? And just to tell you people what we'll be doing in this, I didn't want to start with telling we'll do this, we'll do this, we'll do this. I wanted to just start and later eventually tell you. In this, we will also be solving some problems in the marathon revision. What problems to pick? Now he has a problem in one problem, someone else has a problem in someone else's problem. And what's her problem is not her problem. What's both of their problem is not his problem. So same problem is not the problem for everyone. Get it? So I cannot keep everyone happy by solving one problem. So what have I decided? I've decided to solve RTP of Jan 2025 examination. We'll solve RTP Jan 2025 in the class, and if in case required, if there is a specific topic which is not covered in RTP Jan 25, and if the time permits, we'll do that specific topic question from any other RTP or PYQ, whatever is available. Is that okay? Fantastic. So let's focus on concepts and conventions for now. Shall we? Very good. What do you mean by an accounting concept? What do you mean by a concept? It is an idea. It is either an idea or a notion. Have a look at this. It is either an idea. See, idea or a notion which is having universal application. It is not like I and you, both of us will get one idea and it will become an accounting concept. No, it should be an idea or a notion having universal application, and this should be followed in preparation of financial statement. So remember it like this. What is an accounting concept? It is an idea or a notion having universal application which is used in preparation of financial statement. Remember it like this. What is an accounting concept? Three things. Number one, idea having universal application used in preparation of financial statement. Three hand signs. Number one, idea. Number two, universal application. Number three, financial statement. So why is this financial statements? What is this? Assets. This assets, liabilities, owner's equity, balance sheet. Assets, liability, owner's equity. You write in balance sheet. No, liability side, asset side. Together balance sheet. Two. This one, revenue. This one, revenue and expense. P&L account. You get this? So this is P&L account. This is balance sheet. Put them together, financial statement. What is it? Very good. So it's an idea or a notion having universal application, which is the fundamentals or which is the assumptions based on which financial statements are prepared. Got that? So how many accounting concepts do we have? We have about 10 of them. In that, one of them is not there in your new syllabus material that's given. But we'll discuss all 10. Shall we start with the first one? Very good. We'll start with 6 at the beginning. Yeah, first to 6 or Tamil method. Okay. First one, going concern concept. What is the first one? What does going concern concept say? Going concern concept says that an organization either has an intention or a necessity to close down its operations in the near future. Okay, repeat after me. An organization, and repeat after me, not with me. You understand? After me and with me. An organization. Don't sleep. Come on, wake up. Do the hand signs. Okay. An organization, either as an intention nor a necessity to close down its operations in the near future. 2 marks bರುತ್ತೆ. True or false question. Difference between going concern and matching. If you write two definitions, 4 marks. Now keep your hands like this and they're like LKG. Come on, don't pass act. No to say, comment sitting there. Please follow what I say. You get it? If you sit back at home and try to mark this up, it's going to take much more time and you find it not very interesting. So let me help you. Okay, one last time. An organization, either as an intention nor a necessity to close down its operations in the near future. Going concern concept. See, the only reason why we prepare balance sheet is going concern. Whatever the angdi that you close on 31st of March, you know that you'll open on 1st of April. If not, what will you do? Sell all the assets, receive all the money, pay all the liabilities, settle the capital. Again, next year, freshly start the business. That's not how we do. We have an intention to continue the business the next day. That's going. Balance sheet of an entity is prepared because of going. If there was no going concern concept, there would be no balance. There would be no joint venture. Have you heard of? They prepare no balance sheet. Why? There is no going concern concept in joint venture. Joint venture is a special purpose partnership created for a specific purpose. Once that purpose is fulfilled, capital illa, revenue illa. Everything you write in one. Got it? Hell yeah. Very good. Then let's go to the next one. Next one we'll discuss periodicity concept. What is periodicity concept? Hey, see. Now jump into periodicity. Look at the O in periodicity. Oh. Let's see what is periodicity. See, I told you, you have an intention to continue the business for quite a long time. When you have the intention to continue the business for quite a long time, does that mean I will say I'll not prepare P&L account at the end of the year? If someone asks me how much profit did you make, I'll say no, going concern. I have intention to do business for long. After the day I close my business, that day I will tell difference between my opening and closing capital as my profit. I started business with some capital. The day I close my business, I'll identify how much capital is there. That day I'll tell how much profit. Can I keep you waiting till then? That's too much to keep you. Like no, should not keep for so long. So what should we do? At regular periodic intervals, we need to evaluate your performance. That is where periodicity comes. In case periodicity concept was not there, you would have never prepared P&L account. You would have never prepared balance sheet for each year. You know what is the problem in that case? You started business. You thought going concern, you'll not prepare balance sheet, you'll not prepare PL. After 5 years, capital became zero. Then you understood, oh, doing loss from year one. Too late to realize. Too late. If you'd have realized at the end of year one, you might have at least closed down the business with little capital left, or you might have changed the way you do business. Are you getting it? So it is not just taking the car and then keeping going 300 kilometers towards Goa or 400 kilometers towards Goa, only to realize that, oh my God, I've come in the wrong direction. Now I've reached Kanyakumari. No, you need to be cautious about the direction that you head also. At every regular intervals, when you take a pit stop for peeing or teeing, ask, sir, Goa inge na. You should ask. You should check whether you're going in the right direction. That's periodicity. So what does periodicity concept say? It says that entire life of the business, what is there, should be divided into smaller parts. And each small part is called as accounting period. And we need to open books of accounts for each accounting. Have a look at this. So you need to take pit stops. Entire life of the business is divided into small fractions called as accounting period, and books of accounts and financial statements are prepared for each accounting period. After me, will you? Entire life of the business is divided into small fractions called accounting period. Financial statements are prepared for each accounting period. Once more, very good. Entire life of the business is divided into small portions called as accounting period. Financial statements are prepared for each accounting period. Everyone understood? Very good. And if not periodicity, there would be no P&L account. There would be no uniformity. There will be no comparability. There will be no consistency. I'll come to it later. And the next one for you to note is the topic of entity concept. What is the next one? Entity concept, your favorite concept. Entity concept says that business as an entity is different from its owner. You get this? So have a look. Business is different from its owner. Eradu bere bere, not same. You get this? Business partner is different, life partner. Business affairs is different. Personal affairs are different. Capital to business, it's a liability. To me, it is an asset. I have given the business capital. No, if the business closes down, business muchkondo hodre, business should give that capital back to me. So to business, it is liability. For me, I am supposed to receive it. For me, it is drawings that I make. To me, it is liability. To business, it is asset. Business has to recover it from me. Are you getting it? So the logic is an organization is different from its own. A business entity is different from its own. This is like organization. It is different from its owner. This is owner. Remember an organization either as an entity. Here also we did like this. So this means organization. All of this will help in the exam. How you sitting here, your friend is sitting there. There's a question for okay, going concern. You see, communication becomes smooth. Like, what? Hey, stop abusing me. Tell what is it. It will become easier. Got it? So what is entity concept? Business is distinct from its okay, everyone after me. Business is distinct from its owner. Okay, next time dance model. Okay, pull all the concepts put together. So the capital, which is a liability to the business, is an asset to the owner. Your liability is liability. Your liability is my asset. You are my asset. Okay, I'll keep you on the asset side. You get it? So entity concept is actually very different from separate legal entity what you learn in company accounts. Okay, just for you to know. So let's not stress too much on that part right now. Then let's go to money measurement concept. What are we going to discuss next time? Money measurement. Money measurement is a very nice concept. You've seen Three Idiots movie. Class will come no. मेरी 4 लाख की शेरवानी no 1.5 लाख की शेरवानी 4 लाख की थी. Watch it. Like everything he measures in terms of money. That's very important. You have to measure things in terms of money. If you don't measure it in terms of money, how else will you write it? Can you write like okay PPE? What is PPE? Nice PPE. Can you write expense? Ishtu. Profit ishtu. You can't write no this much, that much, very much, too much, nice, good. See, we are not here to share compliments in accounts. In accounts, you should write number. Profit 1 lakh, purchases 5 lakh, capital 10 lakh, depreciation 50,000. Goodwill also should be measured in terms of money. Anything and everything to be recorded in accounts, it has to be measured in terms of money. If you can't measure in terms of money, you can't write it in account. Are you getting what I'm trying to tell? Very important. So try to understand this. What does money measurement concept say? See, transactions. What is this transaction? Like you take goods, you give money. Or you give goods, you take money. Purchase, sale, purchase return, sales return, purchase of assets. You take services from employee, give him salary. So this is transaction. What is this? Transactions, after me. Transactions, not like this, okay? One front, one back. Okay, transactions to be recorded should be measured in terms of money. Okay, one second. Transactions to be recorded in books of accounts should be measured in terms of money. Indirect speeches, if you cannot measure it in terms of money, you cannot record it in books of accounts. Are you getting it? So ಅಷ್ಟೇ ಒಂದ್ ಕಡೆ ಪಿಂಕ್ ಕಲರ್ ನೋಟು ಇನ್ನೊಂದ್ ಕಡೆ ಐಟಮ್ ಇಡೋದು ತೂಕ ಹಾಕೋದು ಬರೆಯೋದು ಅಷ್ಟೇ. You understood this? So why is money? Money is an universally accepted unit of measurement. You can say, sir, quantitative characteristics says that qualitative characteristics are ignored. No, so I can't write purchase 10,000 kgs, sale 5,000 kgs. Who will write profit? Get what I'm trying to tell? Or can I say purchase of raw material 14 centimeters? If you buy some items, cloth and all, when you buy kgs, so liters, you can measure, no, but you cannot write profit. Not everything can be measured in terms of any single unit of measurement. Universally accepted unit of measurement is anything can be expressed in terms of money, raw material, work in progress, finished goods, salary, services taken from employee, goodwill of a customer. Getting this? Now, friendship, sorry, what are we talking? Everything can be measured in terms of money. So measure it in terms of money and then write it in books of account. Get what I'm trying to tell? Very good. Bhavesh, where are rest of your friends? Told them. Very good. Dispose carefully. Recently also someone else got caught. Huh? No, after you cut them into small pieces, when you dispose carefully. Recently some guy got caught. Oh, yeah. Okay. Then I have a beautiful idea. After you cut it into small pieces, no. ಬಾಕ್ಸಿಗೆ ಹಾಕ್ಬಿಟ್ಟು ಕೊರಿಯರ್ ಇಟ್ಟು ಸಮ್ non-Asian country. Well, here's sniffer dogs, everything. Like send it to some African country or send it to some Maldives. Courier ಮಾಡ್ಬಿಟ್ರೆ simple. Okay, simple. Let's go. Next time, think of it. Let's discuss accrual concept. Shall we? What do you mean by accrual concept? The accrual concept says that transactions, whatever are there, no, these transactions should be recorded as and when it happens and not merely when it is affected in. Shall we? Once again, tell me, what does accrual concept say? Transactions, after me. Transactions should be recorded as and when it happens and not merely when it is affected in cash. Once more, okay? Transactions should be accounted as and when it happens and not merely when it is affected in cash. I sold the goods to you today. You bought the goods from me today. You told you will give cash tomorrow. Do we write the sale entry, purchase entry today or tomorrow? Today. Just because the cash is settled tomorrow, we should not defer the transaction. Are you getting it? That is accrual concept. That is accrual. This is what will help us do mercantile system of accounting. This is also called as mercantile system of accounting. This will help us in matching. If this is not there, then there is no matching concept. Then there is no, what is matching? I'll come to it slightly later. There is another method of accounting called as cash basis. What is it called? Under cash basis, we record a transaction only when it is affected in cash. Only when it is affected in, you should not follow. You should not follow it. Are you getting it? There can be a question. Difference between cash system and accrual system. You don't have to write one page lengthy answer because it is 4 marks. Write the correct words and then the correct expression of the word accrual and cash. You will get 4 marks just for writing this part and then writing the same part for the cash part, writing that transactions are recorded only when it is affected in cash. Just for that you will get 4 marks. Sometimes you write one entire page. Accrual transaction is not a cash transaction. Cash transaction is not an accrual transaction. Accrual transaction is my favorite transaction. Cash transaction is my second favorite transaction. So like that, if you write 5-6 points, it doesn't give you any marks. In fact, the evaluator will get frustrated. Yeah, he will feel like, I like this guy's answer. I want to read it once again. Yeah, come back in May. Yeah. Then what should we follow? Always mercantile. Got it? Oh, we have successfully completed 5. Shall we go to matching concept? Matching concept is my favorite dancing step. So what does matching concept say? Matching concept says that we need to match current year expenses with current year incomes to arrive at current year profit or current year. Imagine one P&L account. Debit side, credit side. In debit side, you write expenses, no, salary, wages, depreciation, expenses. Credit side, you write income, commission, other income, gross profit, everything. So income total, expense total. If income is more, expense is less, profit. If expense is more, income is less, loss. Am I right? So let's express it in statements. Shall we? Okay. We need to match, everyone. We need to match current year expenses with current year incomes to arrive at current year profit or current year loss. Fear and emotion. What is this? We need to match current year expenses with current year incomes. And body should move slightly like this. You're like this. In Gode over style. Like this. We need to match current year expenses with a head nod, current year income to arrive at current year profit or current year. Covers up as a nice step. So in the exam also you can do. Ma'am, do you know this step? Then your friend will say, okay, sir, ma'am, I know that step. But does he know this step? Heard or not? Okay. Matching concept. What does it say? Read. Matching current year revenue with current year expense to arrive at current year profit or current year loss. You get this? Very nice. So this concept is based on periodicity and accrual. Periodicity and the accrual concept says no, we need to write the transactions as and when it happens. Don't wait for it to be settled in cash. Let's say there is a transaction happening in this year, but cash settled next year. We'll record this year. Correct? No. Let's say there is an expense. Let's say there is salary expense, but you decided to pay the employee next year. Still write salary account debit outstanding salary this year. No. That's when that expense will match with income to arrive at profit. Get this? If matching concept was not there, accrual concept was not there, then you would have written that purchase transaction or salary transaction next year. Matching also would have not happened. And matching concept enforces you to write the transaction in this year, so it is not paid in cash. Accrual over, and once you write in this period, you cut it into period. No, then you can match. If you don't cut it into smaller accounting periods, how will you match? You can't. So matching concept, accrual concept, and periodicity concept are connected. Got it? So whenever there is a question on accrual concept or periodicity concept, there don't forget to mention matching concept. Get this? Okay, then here I would make you write usually periodicity concept, matching periodic revenue with expenses. And let's go to cost concept. Are you ready for cost concept? What does cost concept? There's another name to this, historical cost concept. What is the other name? Cost concept says that purchase of an asset should be recorded at historical cost. Should be recorded at what cost? Very good. Whenever we purchase an asset or acquire an asset, it should be recorded at historical cost. What do you mean by historical cost? The amount that you paid at the time of acquisition. Amount that you paid at the time of acquisition. This becomes historical cost. Lot of discussion around this, but we're going to keep it very crisp considering it is marathon. I have dedicated 1.5 to 2 hours for the theory part. We're just around the 1 hour mark and we are going good. So in the first 1.5 hour, we'll finish the entire theory part, and after that, so even if you want theory, we'll be doing problem. So don't worry. And this historical cost concept is followed when the organization is going concern. The day the organization stops being going concern, we will not follow historical cost. Then we'll follow realizable value concept. What concept will we follow? Very good. However, there's another important point. That was the olden times. In the modern time, even when the organization is a going concern, you can choose to not write an asset at historical cost. That is called as revaluation. Get this? They value it at realization value and then record, but the modern name to it is called as what? Revaluation. See, when you buy an asset, you should record it at historical cost, no? But on depreciation chapter, you would have learned, no, upward revaluation of the asset, downward revaluation of the asset. There is a going concern. How did you revalue the asset to show it at other than original cost? Because cost concept allows you to. Initially, cost concept was stubborn. He told you should follow what I tell only. Till the time you are a going concern. Whenever it is not a going concern, you can follow what do you say? Realizable value. Come here, going concern. When the entity is going concern, historical cost. When the entity is not a going concern, then you should actually follow realization concept. What should you follow? This is actually removed. Under realization concept, we don't record the asset at its historical cost. We record it at what value? Today if I sell, what do I get? Let's say I bought this watch for 20,000. If I record it in my books of accounts at 20, what does that become? Historical concept. Today if I sell, let's say I'll get 8,000 rupees. That 8,000 rupees what I get is realizable value. Are you getting the difference? Historical cost and realizable value. Very good. So we should follow historical cost concept whenever there is going concern. Whenever it is not a going concern, we follow realization concept. Understood this part, everyone? See here. When an entity is a going concern, what do we follow? Historical cost in preparation of financial statement. Whenever an entity is not a going concern, we follow realizable value in preparation of financial statement. Understood this? Very nice. Yeah. What's after this? Then realization concept is actually removed from your syllabus. If you see ICA study module, there is no realization concept printed in the material. But though it's not there in the material, it's still part of your accounting. Accounting concept cannot be removed, no? So you'll still use it everywhere. You still use it. It's like you uninstalling the clock on your phone and then saying that time will not exist. Time will exist. It's just that you will not know. Then dual aspect concept. The next one. What is the next one? Accounting equation concept also comes because of this. There's one more which is removed from your syllabus. It is called as revenue recognition concept. So let's quickly discuss it for a minute. So revenue recognition concept says when to recognize revenue. Revenue, sale, whenever you sell goods, when to write the sale entry. You should write the recognition of revenue on transfer of three important things. How many important things? Three important things. Number one, risk. Number two, reward. Number three, effective control. We'll learn this in accounting standard 9, revenue recognition in scale. For now, in foundation, remember a very simple thing. When should we recognize revenue? Revenue should be recognized on transfer of three things. Number one, risk. Number two, reward. Number three, effective control. Effective control means possession. Effective control means before 2019, the edition of CA Foundation material, what was printed in that, this is there. Ever since 2020 May, when the new syllabus came, like some chapters got removed, they've removed this concept. From the syllabus, they've removed this concept. But as a practicality, concept still exists. Get it? No, I told no. Uninstalling the you not wearing the watch doesn't mean time doesn't exist. Different. Okay. Fine. Realization concept is for assets, this is for goods. PD. Now let's discuss the dual aspect concept. What should we discuss? Every transaction will have two aspects. We need to recognize, measure, and record both the aspects. The dual aspect. Get it? After me. Okay, tell. Every transaction will have two aspects. We need to recognize. Recognize means see. Okay, kannida. Recognize, measure. What is this? Money. In terms of money, we should measure. And then record. What? Both the aspects. We cannot record one aspect and skip the other. So we need to recognize, measure, and record. No, not like this. Just this is sufficient. Like, not because I told. No, you are free to do. So we need to recognize, measure, and record both the aspects. Got it? Just do like this. Don't poke your eyes. Okay. We need to recognize, measure, and record both the aspects. We call now accounting equation. Assets is equal to liabilities plus capital. That is on this one. Get it? So on this, questions are there in the material, the class material as well as in the IC study material. Would have done in the class. So I'll skip this part. Can I? So this one thing that you should read as to when an increase in an asset happens, there is decrease in another asset or increase in liability. When there is increase in liability, there is decrease in another liability or increase in asset. So you know all of this. And do you also know example for each of this? I am trying to skip this, so I'm asking you, can I skip this? Or do you know this? Okay. Increase in an asset will lead to decrease in another asset or increase in liability. Decrease in an asset will lead to increase in another asset or decrease in liability. Increase in liability will lead to decrease in another liability or increase in asset. Decrease in a liability will lead to increase in another liability or decrease in asset. Would have done all of this? Okay. Anyone who wants me to answer any part of this if you have any doubt? No? Will you take a note of this? So I'll tell certain things that you should read. Today the must thing read. Number one, role of an accountant in the society. Second thing, examples for accounting equation. Examples for these items. No, glance them once. Okay, please. Number one, role of an accountant in the society. Number one, role of an accountant in the society. That chapter 1, unit 1, last part, service, industry, adu, read that. And the next one is this accounting equations. Accounting equation based topic examples. Done. Very good. The next thing that I would want you to do is, I have discussed all the concepts and conventions. No, concepts are done. We'll discuss conventions now. Revise them once, because in a true or false question, in a short note question, or in difference between question, this is the institute's favorite. What is institute's favorite? Concepts and conventions. In what questions? True or false? Summary. Summary means short note. They'll write a short note on accrual concept. Or difference between. Difference between, you don't have to write T table and then differences. They will tell difference between accrual concept and matching concept. Right? Meaning of accrual concept, right? Meaning of matching concept. Okay, they can ask any two. Done. Did you make a note of it? Very good, yeah. So I usually used to discuss these examples in detail, but hoping that you people know I am going forward to objective evidence. Objective evidence is again a concept which was there in the syllabus till 2016. When CPT to CA foundation it became, then they removed this. So objective evidence concepts is that every transaction to be recorded in books of accounts should be backed by an evidence. Is it? Every transaction to be recorded in books of accounts be backed by a voucher, bill, invoice, something of that sort should exist. Okay, now. So, if you know this much, we are done with accounting concepts. Next, shall we discuss conventions? What do you mean by accounting conventions? What is accounting convention? Okay, accounting concepts are the basis. Based on accounting concepts, you start doing accounting. When you start doing accounting, accounting conventions emerge out of the accounting practice. What is it? It emerges out of the, yeah, in the usage and practice of accounting, accounting conventions will arise. See, emerge out of the accounting practice, derived by usage and practice. Derived by usage and practice. Okay. Any reason? Huh? ಮಾತೇ ಇಲ್ಲ ಬಾಗ್ಲ ಕರೆಕ್ಟ್ 11:30 ಬಂದ್ಬಿಟ್ಟು ಬಸ್ ಲೇಟ್ ಅಂತೆ 10 o'clock class come at 11:30 and you say bus late, you know, how could it? Hey, which bus doesn't come for 2.5 hours, 1.5 hours? You would have started only at 10 o'clock, 10. 12th of January, 2 o'clock is the exam. Be there by 1:30. 4 o'clock ಗೆ ಹೋಗ್ಬೇಡಿ. ಅವ್ರು ಹೇಳ್ತಾರೆ ತುಂಬಾ ಬೇಗ ಬಂದಿದ್ದೀರಾ, ಮೇನಲ್ಲಿ ಬನ್ನಿ ಅಂತಾರೆ. Please. When is the exam? What time? What time should you start home? ಎಷ್ಟೊತ್ತಿಗೆ ಮನೆ ಬಿಡಬೇಕು? 2 o'clock ಗೆ ಬಿಡಬಾರ್ದು. Done. How many accounting conventions are there? You understood, no? Accounting conventions emerge out of the accounting practices, and these are derived by usage and practice. Accounting conventions are 4. How many? 4. Conservatism, consistency, materiality, and full disclosure. Full disclosure convention is not there in your material, but still you would have to know it. We will learn it. Shall we start with conservatism? What do you mean by conservatism? Conservatism, firstly, is not prudent. Prudence means accounting practically. So that is much more and much bigger than conservatism. Conservatism is an example for prudence. Conservatism is an prudence is equal to conservatism. You getting what I'm trying to tell? Very good. So for example, prudence is like RCB. Conservatism is Virat Kohli. Part of RCB. He is not RCB. He is, but just to make you people understand. Get it? Okay, so let's see, what do you mean by conservatism? What does conservatism say? Conservatism say we need to account for all expected expenses and losses, but not for expected incomes and gains. Shall we? Once again, okay, after me. What should we do? Account for all, everyone, account for all expected expenses and losses, but not for expected incomes and gains. Everyone understood? Account for all expected expenses and losses, but not for expected incomes and gains. If you match it with the food movement, like okay, like this, and then like this, it'll come to be a very nice dance step. If you know dance, okay, I don't know much, but I hope you people understand. You understood conservatism? Hell yeah. This results in understatement of income. Why? You expect the expenses from the future and then record, no? It also leads to understatement of wealth. Why? You expect the liabilities from the future and write, no? Am I right? So this expectation and applying conservatism should be done prudently. Should be done practically. It should be done in an unbiased manner. It should be not done with a culprit evil mind to show lesser profit. Are you getting it? See this? It should be done prudently. It should be done neutrally. It should be done with an intention of faithful representation. Got it? Very good. Next one. After conservatism is consistency. What is consistency? Consistency states that The accounting policies and accounting principles that you follow should be same from one year to another. Lastly, yeah, after me, accounting policies and accounting principles. No, accounting policies and accounting principles. See, I don't know how to tell accounting policies. Accounting is everywhere. No, subject itself is accounting. So policies and principles. P for policies, P for principles. Get it? No. So what do you say? Policies and principles should be consistent from one accounting year to another. Okay, once again, policies and principles to be consistent from one year to another year. 1 year, another year, same policies and principles we cannot change. Can we change? Yes, there is an exception which is given under accounting standard 1. When accounting standard changes, when the law changes, or for the sake of better presentation, you can change your accounting policy. Otherwise, you cannot. What are the 3 reasons? Number 1, when the law changes, when the accounting standard changes, and for the sake of better presentation. For these 3 reasons, we can change our accounting policies. Everyone got this? Yes. Consistency enables comparison. If there is no consistency, there is no comparison. Consistency means what I told you, same policies and principles. Last year you followed FIFO. This year you followed weighted average method. Can we compare your GP? No. Why? Last year when you followed FIFO, the valuation of inventory method is different. This year you have to follow same valuation of inventory method to compare profits. We follow different accounting policies. Comparison is not possible. One of the primary objectives of accounts is comparison and evaluation. We discussed. Did we? Systematic records, financial performance, financial position, comparison evaluation, knowing solvency position, and decision making. 6 objectives of accounting. You will not be able to fulfill that if you don't maintain consistency. Understood? Very good. Consistency is the key. Consistency is the key. Very good. Oh my God. I don't know why Virat Kohli is so consistent. Yesterday, when I slept, I know this morning Virat Kohli will not make 20, India will not score 200. But somewhere still hopeful. But hope is killing me. Yeah. What is accounting policy? Will you please read? See, whenever you have to prepare financial statements, at some junction, when you come, you have one option. Either take this road or take this road. Both the options are there. Whichever you pick is your policy. Same in accounts also. Whenever you're doing accounting, preparation of financial statements or presentation of financial statements, you will encounter options. Like you can do FIFO or you can do VAM. You can compute goodwill under either of the methods. Asset can be recorded under cost model or revaluation model. So you get all of these options. At these junctions, you pick one option that becomes your accounting. That becomes your accounting. Did you understand? Examples are valuation of inventory is an accounting policy. Recognition of revenue is an accounting policy. Treatment of government grant is an accounting policy. Valuation of investments is an accounting policy. Method of depreciation is not an accounting. Method of depreciation is an accounting estimate. Method of depreciation is an accounting. Very important to remember. I've written it and then put a line because people will think if I give 4 examples, sir has given 4 examples, but there can be more than 4. Depreciation is also an accounting policy. Sir did not. No, it is not an accounting. Remember, depreciation is an accounting estimate. What is depreciation? Accounting. Everyone got this? Very good. So next, after this, periodicity, concept alone, consistency. The 3 important points of periodicity conceptually. We're done with conservatism. We're done with consistency. Let's now discuss materiality. What do you mean by materiality? See, everything has to be accounted, no? But things what is accounted should be disclosed separately if it is material. If it is, what do you mean by material? If it affects the decision making of the user. If it affects the, very good. For instance, let's say your mom gave you 2000 rupees in the morning. You lose it today. When you go back home, you need to inform your mom that you lost the 2000 rupees what mom gave. Because if you don't inform, it will affect the decision making. So you get this, any crucial vital information which can affect the decision making of the user should be informed so that the user takes the right decision. Get what I'm trying to tell? And if some information is not material, no need to disclose. 10 rupees lost, don't have to disclose. 2000 rupees lost, yes, good. Why? 10 rupees lost will not affect this year. Okay, 2000 rupees lost does. There is a fridge at your home. On the top of the fridge, there is one small basket or bowl. In that, there will be some money. I know. So in that, if some 2 rupees goes missing, yeah, you keep no. Suddenly change. Oh, now ella Google Pay, Phone Pay. Suddenly, if you need change and all, they has to keep. Now everyone is Google Pay. So some 10 rupees, 15 rupees is paid. You don't have to disclose. It's absolutely okay. But from that box in the kitchen, 2000 rupees is missing. It has to be disclosed. But you need to close the door correctly when you go out. You can't leave the door open. Look back, check, close the door, and then go. Good. Guys are how much? 18, no? 16, 17, 18. You should learn to close the door when you come in, close the door when you go out. Not people will feel chichi. Careful every time. This door also. Next, materiality. So materiality, what was I telling? I was telling that all the transactions which are material, all the facts and figures which are material have to be disclosed separately. What do you mean by material? Which can affect the decision making of the user. See this, facts and figures that have significant economic effect are considered material. And what should we do with material items? All the material items should be disclosed. You all get this? Please tell, yeah. Very good. Okay. So contradicting to this materiality concept, we have something called as full disclosure convention. What does full disclosure say? It says material, immaterial, avella gottilla. You disclose everything. Why? See, you think we were discussing materiality. I told you based on materiality concept, we'll disclose only material facts and figures. However, full disclosure says disclose everything. So we feel like if you lose 2000 rupees, mom will be upset. If you lose 10 rupees, she won't be. But you never really know. Mom. So 10 rupees, if you lose, she might become upset that 10 rupees only you can't handle. How can I trust you with 2000 rupees? So it might start with 10 rupees. And they might create a scene as if you lost 2000 rupees or 2 lakh rupees on playing rummy. They do act. Am I right? Same with the users. So you cannot decide upon materiality. You cannot decide upon materiality. You have to disclose all the information, whether it is material or it is immaterial. Let the user take the decision. But isn't this contradictory to the one that we discussed slightly before? Yes, it is. Then how do we handle this situation? Very simple. All the information has to be provided, but material information has to be provided on the face of the financial. Let us say you write sundry debtors. In the balance sheet, you will write sundry debtors. You will not write each debtor's name. There are 100 debtors. Write all the debtors in one note, take the total and write it as sundry debtors. However, there is one debtor who comes up to 80% of your total debtors. That one debtor, if he becomes bad, go in the. So what should you do? You would have to disclose separately, especially for that one debtor. Especially one that debtor. Rest of the debtors, you write others. Are you getting it? Now write expenses. In your P&L statement, you write expenses, all major expenses. Put small nonsense expenses, put them together, write other expenses. Are you getting it? So material items should catch attention. So you disclose them as a separate line item. Immaterial items, put them all together and then write them, etc. Like others. The detail is there, available. If you open the complete detail, everything is available in detail. But you might not disclose it on the face of the financial. The moment you look at it, you won't get to know. But if you see every notes to accounts in detail, you will surely get it. Got it? This is accounting concepts and conventions. We are done with this, and we also know that there is contradiction between these two. Am I right? There's one nice story that we learn for that part. So another point to notice: going concern concept, accrual concept, and consistency convention. These three are called as fundamental accounting assumptions. What three? Two concepts and one convention. See, one concept. Which concept? Going concern concept as a green flag. Then accrual concept as a green flag. Along with that, consistency. These three are called as fundamental accounting assumptions. So what do you mean by fundamental accounting assumptions? These three have to be always followed, and following these three is an assumption. Whenever you follow going concern, you don't have to tell I follow going concern. You don't have to tell. It is assumed. Whenever you follow consistency, you don't have to tell that you follow consistency. And whenever your accounts are maintained on accrual system, again there is no need for you to tell We follow accrual system, not cash. You don't have to tell. It is assumed. However, if your organization is not a going concern, if you are maintaining accounts under cash system, or if you are inconsistent with regard to accounting policies, then it is a mandatory disclosure that has to be made in the account stating that our accounts are prepared with inconsistent accounts. Our organization is not a going concern, and our organization's consistency or cash system, consistency, and going concern. These three, if you don't follow, disclosure required. If you follow them, no disclosure. Did you understand? If you follow these three, no disclosure. If you don't follow, then there has to be a disclosure. Understood this? So then there's little more of theory again further pending. So what will we do is, now we'll march into the practical side of the syllabus, and the little bit of theory what is left again we'll do tomorrow in the first half an hour. Got it? So we spent about good 1 hour today revising the entire theory. So little bit part whatever is there as and when required we'll do it. Is that okay? So next thing that we have to note is, if you come to RTP January 2025, there is a question on this only. 2A, fundamental accounting assumptions versus accounting. You asked a difference between question. So just now I explained what are fundamental accounting assumptions. Going concern, accrual, consistency. Write the meaning of going concern, write the meaning of accrual, write the meaning of consistency. Tell that all those three have to be followed. If they are followed, no disclosure required. If they are not followed, disclosure required. What is accounting policies? I told you, accounting policies are accounting principles which are adopted in the preparation of financial statements of an entity. Examples: valuation of inventory, valuation of fixed assets, valuation of investments, valuation of goodwill. I wrote method of depreciation and a scratch that one. Write that meaning. This is one theory question from Jan 25 RTP, which will surely do after the class today. You do read it. This true or false will do tomorrow at the end. Last will do true or false. Why? One true or false question is on journal, one is on concept convention, one is on inventories, one is on what to say bills of exchange, one is on partnership, one is on NPO. Different topics are there. We'll do this at the end tomorrow. Last 5-10 minutes, let's do this true or false. Okay. Then there is one on changes in accounting policies. One more question from RTP Jan 2025. When do we change accounting policies? Actually, by consistency, we should not change accounting. It should be consistent. Accounting policies and principles should be consistent from one accounting period to. However, exception is there for consistency. 3. RCBR, changes requirement by law. C, changes in accounting standard. B, better presentation. So when the law requires you, or when the accounting standard has changed, or for the sake of better presentation, these three are the reasons because of which you can change your accounting policy. Here, yeah. Very good. Then question number 3 from our RTP is on journal entries. We will start with journal entries now. So I'll tell you what and all have we covered. Chapter 1 now we have done to the extent of first 2 parts. We still have to do capital revenue. We still have to do provision contingency, and we'd have to do valuation principle. These are the 3 important things that we'd have to do. Or shall I take another 15-20 minutes and finish that part? 15-20 minutes only. Shall we finish it off? So that will not keep anything pending for tomorrow. Okay, friends. Hangadre, let's do the next topic, which is on the rest of the topics from our accounting cycle. We'll do it in second chapter. Accounting process and accounting. Got it? Accounting for transactions is based on first categorization of them into capital items and revenue items. When I say capital and revenue, this is not the capital what we say capital in balance sheet liability. Here capital means capital receipt or capital payment. And when we say revenue, it is revenue receipt or revenue payment. It is revenue receipt or revenue payment. Very good. How do we decide to categorize a specific item into capital or revenue? So I'll not go to the story, I'll straight away come to the point. This is done based on certain considerations. What are the considerations to decide whether an item is capital or revenue? Number 1 is nature of business. Number 1 is I buy and sell buildings. To me, building is revenue item. It is not a capital item. However, I'm a chartered accountant in practice, so I buy this building as my office. Capital item. Same building can be capital, can be revenue. Depends upon what I do. I'm a teacher, I buy a car to commute, capital item. I'm a car dealer, I buy a car to sell, revenue item. You getting what? Or I buy and sell cars, car is a revenue item. I am a person with an office, I use the car for office commute, that will become a capital item. So the first consideration to decide whether an item is capital or revenue is nature of business. What is the primary consideration to decide whether an item is capital or revenue? Nature of business. Then the second point is purpose. What is the purpose for which you buy? Let's say I am a dealer in car. I buy and sell cars. I bought one car, but this car is not bought for sale. Car is bought for utilization of my business. Then it becomes a capital item. So primary consideration. Number one, nature of business. Number two, purpose. Both have to be seen. Only one will not help. You getting it? So I am Shobha Properties or I am Prestige Group. What do? I construct apartments, I construct buildings and then sell commercial properties, residential properties. I construct and sell. Or I am monthly developers. So I constructed one building. Now tell me, capital or revenue? But that will become my corporate office. You got it? No, you should ask who are you? Till I'm monthly developer. Plus, what are you doing? I'm constructing building. Why are you constructing? For my office. Capital. Why are you constructing? To sell it to someone. Then it is. Get what I'm trying to tell? So it depends. What is the nature of business and what is the purpose for which it is constructed? Purpose for which it is being incurred or paid or received. Got it? Then the next point that you should also note is recurability. What is it? How often are you going to recur that expenditure? If it is recurring in nature, repetitive in nature, it is revenue. To be capital, it should be not recurring. To be capital, it should be, are you getting when I say not recurring? If you incur the same expenditure every day or every month or several times in a year, that is revenue. If it's going to be one expense from which the benefit will be taken for over 4 years, 5 years, then it becomes capital in nature. Are you getting it? See, I built one small hut. I built one small, every rainy season the hut goes away, I need to construct it all again. Are you getting it? So that is revenue. That will never become capital because it is not recurring. It's recurring in nature. It is not recurring. Getting it? Yeah. Very good. Then the next thing that you need to know is materiality. This is also a decisive factor. Sometimes an item might be intended to be used for a long term. For example, I bought a pen. So the pen that I bought, I'll use it last year, I'll use it this year, I'll use it next year also. Why? I'm not using it to practice accounts problems. I'm using it to sign. If you only use the pen for signing, that will last long, no? So I'll keep the pen in the table, I take it, I sign, I keep it back. That pen will last for 2 years. The moment I pay, what to say, let's say 200 rupees and buy that pen, should I write it as asset in my balance sheet and then charge depreciation 100 for first year and 100 depreciation for next year? Not worth it. Someone who comes to meet me, after I give shake hand and I turn this side to give them water bottle, if they flick that pen and then go, I don't cry after they go. Look, yo, my pen is, I won't cry. So it is not material. It is not, ignore it. You write it as an expense in the P&L account. It is a revenue item, not a capital item. Are you getting it? However, the same pen was bought for 2.5 lakh rupees. Why? The pen's nib you see, no? It's made of gold. And at the tip here you see white color, that's a diamond. Now tell me, then is it a capital? Yeah, then you write it as a capital item. Or let's say this pen was used by Tipu Sultan. Yeah, to sign the treaty with British. Then you tell me, what does it become? Capital item, antique item. You get it? And because it has a revenue generation capability. Why? It has a revenue generation. I can keep that pen, turn this place into a museum, charge 50 rupees ticket for everyone to come and see the pen. Getting it? So that pen is generating revenue. When the pen is generating revenue, pen is not revenue. Are you getting what I'm trying to tell? So whenever the product starts generating revenue, that product is no more a revenue. Mari hakadmele, that is not nai mari, that is nai. Why? The moment it gives birth to puppy, it is no more a puppy. Get what I'm trying to tell? You get exactly the same thing. So whenever the item is generating revenue, it is no more a revenue. I buy this car, use it as a cab. I pick up and drop people and then take revenue from them. So this is generating me revenue, no? This is no more revenue. I buy and sell cars. One car I'm using it to give cab services. Or one car I'm giving it on rent and earning revenue. The moment I start giving that car on rent, it is generating revenue. Because it is generating revenue, that car is no longer revenue, it becomes capital. very silly topic anta ansate. Only this much of data is there, but almost every time repetitively they ask question on this. They'll give 4-5 items and they'll ask you to classify the items into capital and revenue. Are you getting it? Okay. Okay, there's a question on the recent RTP also on this in Jan 25 RTP. Shall we do it? On, yeah. Let's do question number 3B. We're doing question 3B from our RTP. Doing question 3B from our RTP. This question is on capital and revenue. You don't have to worry, you don't have to get hard copy or you don't have to open soft copy. I'll show the question on the board and I'll also discuss the answer on the board. You just sit back, relax and enjoy. Okay. Whenever we're doing practical questions, maybe you can start scribbling in your book, try to write along. I won't give you copy time. If I give you copy time, then you won't be able to do enough in the marathon. You will go home unhappy that shall we discuss this? Come on guys, let's now discuss question 3B from our January 2025 RTP. This question is on capital and revenue. So they've given list of payments or receipts. We have the responsibility to classify them into capital or revenue. Shall we do it? Read the first one. An extension of railway tracks in factory area. In the factory, there is railway tracks to move the raw material into the factory and finished goods out of the factory. Maybe the factory has become bigger, number of blocks in the factory has become more. So you are extending the railway track by putting extended railway track. Such extended railway track can be utilized for more than 1 year. Amount of money that you incur in it will be material and it will generate revenue for you in the future. So this expenditure on extension of railway tracks in the factory area is capital and it is not revenue. Next one, amount is spent on painting the factory. So your factory walls have become black. It was not originally black, it was all white. Because of all the dust and everyone is doing this, it has become black. Now you want to change the walls again by painting it white. Okay, ivory white is what you want to paint. So when you paint the walls of the factory, the efficiency of the factory will not become more. When you paint a 2 BHK flat, it doesn't become 3 BHK. Painting is part of regular maintenance. In fact, in the Indian household, you do painting every Deepavali or every time granny dies. Like, they die repeatedly only in school, but they die only once in life. But anyways, so when someone dies at home or whenever there is a wedding or whenever there is Deepavali, you paint, right? Or once every 5 years you paint. So that's not going to increase the efficiency of the asset beyond its original capacity or something. So painting is a recurring thing which is immaterial considering the value of the asset, and it's going to increase, it's not going to increase your revenue generation capability. So this is a revenue item, should be charged to P&L. You will not add that painting cost to the cost of the asset. However, if it was first time painting of the building, you should add it to the cost of the asset. However, you buy a second hand building and before you move into that building you get it painted, again that should be added to the cost, that will become capital. Read the third one. Payment of wages for building a new office extension. The payment of wages which is normal in nature will be revenue. Here wages is paid for building a new office. So you building the office, for that you got laborers, for them you are paying the wages. Without that wages, construction and building will not arise. So that laborer wages what you paid will add to the cost of the building. This is a capital item. It is not a revenue. See the next one. Premium received on issue of shares. Whenever you issue shares at a price more than nominal value and collect security premium, that security premium should not be returned to P&L account credit side. It should be returned to security premium in the balance sheet, reserves and surplus. That is a capital receipt, not a revenue receipt. Understood? Then comes an interesting one. Rings and pistons of an engine were changed to get full efficiency. See, this one should be capital, but in the RTP, I think they by mistake given it as revenue. But remember, this has to be marked as a capital expense. Ring and piston form the engine. Ring and piston form the engine. In an engine, if you take the ring and piston out, that bike doesn't work. So to make that engine work, you change the ring and piston. So they're telling that the efficiency will come to full efficiency, whatever was there previously. So there is no condition that the efficiency should go beyond its original capacity. Such a requirement was there as per accounting standard 10 old. Now accounting standard 10 revised is there, no PPE. Whenever the asset comes back to even original efficiency, it is capital expenditure. It is not revenue. Understood? You don't change ring and piston every day. Then brake shoe na daily change madake. Engine oil na. No. You change it once in lifetime. So this becomes a capital expenditure which should be added to the cost of the asset. You get it? Legal fees paid to acquire a property. Legal fees paid to acquire a property. You acquire the property, no? Before you acquire, you take the documents and give it to lawyer and then check. That is a capital expenditure. However, after you acquire the property, someone files a case saying that that property is mine. Then you appoint a lawyer to fight. That is revenue. Why? So many people can file a case after, but the expenditure that you incur at the beginning when you acquire the property will be always capital expenditure. You guys getting it? Very good. This is question 3B. Capital or revenue expenditure. Time permits towards the end, maybe tomorrow or then, if there is still time, we'll do one big list of capital expenditure questions, lot of examples, so that you become good at it. I've compiled a lot of things from all the past examples together. We'll do it if time permits. Okay, very good. Come back here. So capital, revenue, expenditure, everyone understood? Hell yeah. Why do we classify them? You pay bonus every year. Revenue. Somewhere it might be an error. Humans error. God corrects. So it's okay. Bonus will be paid every year, no? Every Deepavali or every Dasara or every year, whenever they want to give, they give bonus. It becomes a revenue expenditure. It is not capital. Okay. Why do we classify these receipts and payments into revenue and capital? Why? Receipt is a receipt at the end of the day. Payment is a payment at the end of the day. Why do we classify? Not because they are accounted differently in cash book. From the cash book, the place where we post to is different. If it is a revenue item, it will go to P&L. If it is a capital item, it will go to balance sheet. See, the treatment and presentation in financial statements is different. If it is a capital item, post it to balance sheet. If it is a revenue item, post it to P&L. There is one last thing called as deferred revenue items. What is the item? What do you mean by deferred revenue items? These are actually revenue items. These are actually which are to be deferred to a period more than 1 year. So temporarily they will look like capital, but they are not capital. For example, rent paid, revenue or capital? Revenue. What you do is you pay 24 months rent once. The owner will ask me to, sir, please pay 24 months rent together. 2 years rent you give, you enjoy the property. If you want, I'll give you 4 months rent discount. 1,000 rupees per month, you give 20,000 rupees, use the property for 2 years. So when you pay 20,000 rupees, it is not a capital item. It is deferred revenue item. It is revenue expenditure of 1,000 per month, which is to be deferred over 2 years. When you defer it over 2 years, remember you should not write entire 20,000 to P&L account in first year. It is for 2 years, no rent. 20,000 for 2 years means 1 year 10,000. So current year you should write P&L account 10,000. Another 10,000 you should carry it forward from current year P&L to next year P&L. Write it in next year P&L account 10,000. Do you agree with me? Yeah. So in this year, I paid 20. I paid P&L account, I'll write 10. Where will I park the balance 10? Balance sheet. For time being, I will tell stay in the balance sheet. Just because it stay in the balance sheet, it doesn't become our person from our house. It's just a guest. It is not a balance sheet item. It is a P&L item. It is not a capital item. It is a revenue item. Temporarily, I will park it in my balance sheet. Prepaid rent 10,000. Next year, I shift it again to P&L. So deferred revenue item is a revenue item. Which acts like capital items, which because it belongs to more than one accounting period. Same thing we discussed under representative personal accounts. Remember, outstanding, prepaid, same thing. Okay, very good, yeah. So next is accounting policies. We already discussed, did we? Then accounting standards definition will come. I hope you are aware of all of this. Objectives of accounting standards, need of accounting standards. Please read through this part. What should you read? Objectives of definition of accounting standards, objective of accounting standards, need of accounting standards, and drawback of accounting. Basically, accounting standards introduction. Yeah, I don't mind discussing it now, but I think it will be little waste of time. So I'm skipping it. So what am I skipping? Accounting standards, objectives, definition, drawback, need, all of this. Okay. So now, come on. Disclosure of accounting policies. Accounting standard 1. I told you some time ago, no, when we discussed concepts and conventions, we marked the 3. We call them fundamental accounting assumptions. What are they? Going concern, accrual, consistency. Going concern, accrual. These three have to be always followed. If you don't follow, then disclosure has to be made. Next comes our changes in accounting policy. This also I told you. So accounting policies have to be consistent from one year to another year. You cannot change. However, you are allowed to change in three circumstances. You are allowed to change in, what are the three circumstances? I told you, requirement by law, change in accounting standard, or better presentation, RCB. Got it? That is exception to consistency. ಅಂದ್ರೆ RCB ಕನ್ಸಿಸ್ಟೆನ್ಸಿ ಇಲ್ಲ, ಎಲ್ಲಿದೆ? ಇಲ್ಲ ಇಲ್ಲ. ಒಂದಿನ 200 ಹೊಡಿತೀವಿ, ಒಂದಿನ 40 ಆಲ್ ಔಟ್ ಆಗ್ತೀವಿ. Yes or no? RCB will tell its fans, don't bring anything to the stadium to eat, ನಾವೇ ಕೊಡ್ತೀವಿ. Okay, so after changes in accounting policies, the last one, consideration for picking accounting policy. See, AS1 does not tell how to select accounting policy, it will tell how to select accounting policy. There are three considerations for selecting accounting policy. How many considerations? Three. Number one, prudence. Number two, substance over form. Number three, material. Number one, prudence. Number two, substance over form. Number three, what is prudence? Prudence is accounting for transactions practically. Don't getting lost, not getting lost by the transaction. Get it? You account the transactions practically. Example is conservatism. Example is, next one is substance over form. What do you mean by substance over form? You need to read that with another word in between over and form. It is substance over legal form. You need to read between the words. What is it? Substance over legal form. Legality is important, I agree, but reality supersedes. Reality supersedes legality. You should not go just by legality. You should go by reality over the legality. Get it? So let's say you have purchased one property, you have paid the money, agreement is signed, just the registration is pending. Why did you not register? You did not register because today is some holiday, or today the day is not nice, or the person to sign is not available, or is some band or strike going on. So you postpone the registration to another month, next month. Just because you postpone the registration to another month doesn't mean that you have not bought. You have purchased the property, you have paid the money, you have signed the sale deed. PBMP office go to, you have not registered. Just because of that, can you say you won't record the asset? You should record. Legally, you are not the owner, but in reality, you are the owner. Any day you can go to court, prove that you have paid them money, show the sale deed, and get it registered in your name. Are you getting it? Hell yeah. So reality will override the legality. That is substance over. Materiality, so anyways, you know. This is AS1. One more accounting standard that you would have to read in this topic is provisions, contingency, and contingent assets and contingent liability. Once you know this, then last one, valuation principles, then theory done. Then we'll start with the journal entry. We'll do subsidiary book. We'll do rectification of errors, BRS, valuation of inventory, depreciation, all of that. Okay, come on. Let's start with the last topic of the theory types. What is it? Provisions, contingent liabilities, and contingent assets. What is contingent liability? Read. There is a simpler way to know it. Don't waste your time reading this. Very simple. Don't focus on the word provision first. Focus on the word contingent liabilities and contingent asset. We anyways know liability and asset. Let's focus on the word contingency. Shall we focus on the word contingency? What do you mean by contingency? See, this is something that we are not sure as of now. This is something that has not happened, but we are waiting for it to happen. So, contingency is an event which is dependent upon occurring or non-occurring, happening or non-happening of one or more future uncertain and uncontrollable event. Future uncertain and uncontrollable event. FUN, fun. Future uncertain UN, uncontrollable UN. Basically, fun. You get this? You don't know whether that fun will exist or it's not, because it's in the future. It is uncertain. It is not in your control. Get what I'm trying to tell? If this uncertainty results in an inflow of asset or inflow of resources, it is contingent asset. If this uncertainty results in outflow of resources, it is contingent liability. Check this. Did it? Contingency is an event dependent on happening or non-happening of future uncertain uncontrollable act. If that results in inflow, contingent asset. If that results in outflow, did you understand contingent asset and liability? Detailed an hour discussion, but we're running it crisp in 2 minutes. Fatafat. Marathon revision. Everyone clear? Very good. So in short, yeah, asset is a resource. Contingent asset is a possible resource. Liability is an obligation. Contingent liability is a possible obligation. ಅಂದ್ರೆ ಏನು liability ಆಗ್ಬೋದು ಆಗ್ದೇನೂ ಇರ್ಬೋದು. It can be. It is dependent upon future uncertain uncontrollable act. For example, wife and husband, asset and liability, balance sheet, home, they go there. Whereas contingent asset, contingent liability, boyfriend, girlfriend can become asset and liability, may go to balance sheet, but not right. Get this? That becoming asset and liability is dependent upon an event which is in the future. Get that? It is uncertain, it is not controllable. Get this? Like a wedding. That is future, that is uncertain, and that's not in your control. If it happens, that contingent liability will become liability. If not, that contingency will remain. Where do you rate contingency? Contingencies will be disclosed outside the balance, not inside. Contingent assets should not be disclosed, in fact. Only contingent liability should be disclosed. The contingent, why? Practical, prudent life, conservative life. Yeah, are you getting it? Hell yeah. So tell me, what is a contingent liability? Now shall we see the definition? Yeah, see, contingent liability is a possible obligation. It is not an obligation. If it is an obligation, it is liability. Contingent liability is a very good that arises from past events. Their existence is confirmed only after occurrence or non-occurrence of future events. That will be uncertain as well as uncontrollable. Contingent asset definition free. Contingent liability definition ತಗೊಂಡ್ರೆ contingent asset definition free. Why? Everything is same. Here possible obligation ಅಷ್ಟೇ, ಏನು ಚೇಂಜ್ ಇಲ್ಲ ನೋಡಿ. Read 1 2 3 start. That arises from and there one or more. Easy. Everyone understood? Now, sir, I understood contingent asset and contingent liability. What about provision? Provision, don't see the definition here. Provision is created for a contingent liability. Provision is created for a, see, contingent liability means what? It can become a liability. It will not, I am not saying it will become a liability. There is a contingency. Am I right? Can I write it in my balance sheet? No. Why? Contingency rule. Contingent liability should be disclosed outside the balance sheet. Cannot be written in the balance sheet. But conservatism, expected loss, expected liability, you should record. So you cannot break this rule, you cannot break that rule also. What to do? So you will not say contingent liability. You will tell name. Hey, she's not my, she's just friend. And then you bring home. Yeah, my girlfriend adot mane karkomandre hoditare. They will not allow you to bring them home. Get it? No. You will tell one lie. What? Just friend. That the balance sheet is there. No, inside that you want to bring contingent liability. If you bring contingent liability, they'll scold. They'll say, hey, contingent liability is not allowed. Custom, tradition. Keep that contingent liability outside balance sheet. Correct or not? Till the time there is future certainty, you don't bring it into the balance sheet. Correct? No. They'll say, this is not contingent liability. This is provision. We'll tell one lie and then bring that provision into balance sheet. You understood now? But to create provision, that contingent liability has to fulfill two conditions. Number one, there should be probable outflow. Number two, there should be reliable estimate. Probable outflow means that contingent liability comes with a big bag, toothbrush, bed, everything. Then there is no probable outflow. That's going to stay here forever. Get what I'm trying to tell? There should be probable outflow. Second one, there should be reliable. How long is that contingent liability staying here? You should tell. So only when you can tell with certainty the probability is there for outflow and there is reliable estimate to disclose that contingent liability as a, very good. Let's talk in accounting terms like we always do. So for contingent liability, you create provision where you think that you might have to incur money. It will become liability. Your famous example, your favorite example, there is a case pending against the company. Contingent liability, you have started getting the feeling from inside that I will lose this case. Your lawyer also told, sir, arrange madkoli duddu. Gottogtira case. So I am arranging funds now. So I know I will lose. So for this contingent liability, they will create provision. But again, when I make provision, I should write in my books of accounts. How much should I write? I should write some number, no? So there should be reliable estimate of how much money do we have to pay. So whenever for a contingent liability there is probable outflow and reliable estimate, you create provision. What do you create? Everyone understood that you create provision? Tell ya. Very good. For a contingent liability, when there is probable outflow and reliable estimate, you create. Understood? Now see the definition of provision. Provision is a present obligation arising from past event which would result in outflow of resources embodying economic. Till here what you read is liability definition. Liability is an obligation which arises from past event raising cash outflows of resources in the future. Am I right? So two words. One, probable. Further, a reliable estimate of the amount can be. So to liability definition, you put two words: probable outflow, reliable estimate. That liability definition will turn into provision. I'll repeat. For the liability definition, you should add two words. What are the two words? Number one, probable outflow. Number two, when you add these two words, it will change from liability definition to provision definition. Did everyone understand contingent liability, contingent asset, and provision? The last one is valuation principles. What is the last one? Same item can be measured under multiple values, and based on the situation and circumstance, we decide at what value to write. I'll tell you in 1 minute. Shall I? Very simple thing. I bought this phone 1 year ago for value of 50,000 rupees. What is it? Historical cost. Historical, same phone, same brand, same characteristic features, same color, same model. Right now in the market, 40,000 rupees. Current cost. What is it? Current cost. If I sell this, I will get 30,000 rupees. Realizable value. I can give this phone on rent and earn 1,000 rupees rent for next 20 months. That is the cash that I'll get for 20 months. If I discount it to today's date using time value of money, that will become present. That will become, once again, okay, I bought this phone 1 year ago for 50,000. What is it? Today the same model new phone is 40,000. If I sell it today, I'll get 30,000. If I give it on rent, I can earn 20,000 over next 1.5 years. Present value. You get it? Based on the situation, you will decide how to value the item. You get it? Inventory, you will record it at historical cost or realizable value, whichever is less. Are you getting it? All of these items which are replaceable, you will record it at current cost. Sometimes you will record it at present value. You do it in goodwill valuation. Present value of the future cash. Annuity factor ಮಾಡ್ತಿರಲ್ಲ. Same thing. A by 1 plus R root to the power n. Same thing. Did you understand this? Very good. By this we are done with all the theory, guys. There is nothing much left except for last one, estimate. What is estimate? Whenever those four valuation principles what we followed, it cannot be applied. You cannot value it using those. Then you do accounting estimate. What do you do? What is accounting estimate? It is followed when valuation principles fail. It is followed when valuation principles fail. Now, how do you apply accounting estimate? Very simple. Two words. Number one, past experience. Number two, present situation. Based on the past experience and present situation, you will arrive at an estimate. Based on the past experience and present situation, you will arrive at an accounting estimate. I'll give you an example for accounting estimate. Now, I am estimating the useful life of this phone to be 3 years. How did I tell 3 years? Before this phone, I had a phone. I have used that phone and I know how much of the utilization of that phone had happened. Based on that past experience of how long did that phone last and what is the efficiency and capability of this phone, I will tell this. Let's say that phone lasted for 2 years. Why I have to throw like this? Now, this phone I am not going to throw like that. This will last for 3 years. Past experience of 2 years. Present situation of not throwing. Put it together. New estimate of 3 years. Are you getting it? So, this laptop, this will last for another 5-6 years. After 6 years, let's say I'll sell this laptop. I'll get scrap value. That is an accounting estimate. How much will I get? Don't know. I will estimate. Before this, I had a laptop. I sold that after 5 years of usage and that laptop got me 4,000. That laptop was bought for 40,000. This laptop is bought for 80,000. So this laptop might fetch me 8,000. Might. That's an estimate. How is it made? Based on the based on the past experience and present situation. You understand this? Example for accounting estimate. Provision, you tell, no, provision for doubtful debts 2%. What is that? Accounting estimate. When you make your depreciation charge, that is accounting estimate. Useful life of an asset, scrap value of an asset, goodwill, you tell 3 years purchase. All of these are accounting estimates. Did you understand this? Depreciation, amortization, impairment loss, useful life, residual value, provision, everything is accounting. We are done with chapter 1 by this. Got it? So chapter 2, accounting process. Let me not waste too much time on theory types. Shall we start chapter 2 in our style? Start with journal entries. Fine. Battery ಆಗೋಯ್ತು. Already 12:30. So class will not get over at 12. So first time ಓಡ್ತಾ ಇದೆಯಾ? Oh, don't even ask. God. Yesterday I just finished my 10th standard. I'm like, oh my god, I'm a CA. Time is literally running. Lot of people, I feel like yesterday I was seeing you in foundation class. So soon you're in marathon. Sati, when the moment I blink, you're like in inter class. Once more I blink, you're in inter marathon. Once more I blink, oh my god, sir, I'm a chartered accountant. Sir, you took lot of time to blink second time, so we fast tag. Okay, yeah. Then we'll do a question on journals, shall we? Do you have to teach you the rules of passing journal entry, or can we start? Okay, there is a very interesting question. This has a little bit of adjustment on GST also. Maybe once we do this, if you would want, we'll do little more discussion on GST based journal. GST. No GST, no. Every day you send in the previous night message GST to your friend. Do you send? Good night, sweet dreams, take care. You don't send that. You don't send. Start today. Send GST. GN. GN andre? Okay. Fine. Shall we do 3A journal entry based question? I know you people find you to be much beyond this level, but still, I have to. Shall I? Come on, guys. Let's now solve question 3A from our RTP of January 2025 examination. This question is on journal entries. Let's pass journal entries. Yeah. Pass a journal entry in each of the following cases. Let's see the first one. A running business was purchased by Morgan with following assets and liabilities. When he purchases the business, he's actually not purchasing the business, he's purchasing assets and liabilities which are involved in the business. When he purchases that business, cash, land, furniture, stock will come. When all of them come, all of them are assets, they should be debited. Creditors and bank overdraft also will come. This is liability. When the liability is increasing, it should be credited. Whatever is the difference between debit and credit, that is the capital that is invested in that running business. It has to be credit. It has to be credit. So debit cash, debit land, debit furniture, debit stock, credit creditors, credit bank overdraft. Difference credit will be Mohan's capital. Shall we do it? Very good. Entry number 1, March 2024. Oh, sorry. Not this. 3A. 3A. This is the one. Morgan. Shall we solve this? Okay. Cash account debit. How much cash account debit? 20,000. Land account debit. 40,000. Furniture account debit. 10,000. Stock account debit. 20,000. Then credit items are creditors and bank overdraft. Creditors 10,000. Bank overdraft 20,000. I will give little space and then write creditors 10,000 and bank overdraft 20,000. Take the total on the debit. 20 plus 40 60, 60 plus 10 70, 70 plus 20 90, 90 minus 30, 60 is Mohan's capital. So this is running business purchased along with assets and liabilities. Understood? Let's see the second one. Sold goods to Gagandeep for rupees 1 lakh at trade discount of 20%. Trade discount should be adjusted. Trade discount should not be accounted. The value of the inventory is 1 lakh. If you sold it at trade discount of 20%, take your calculator everyone, type 1 lakh minus 20%, 80,000. So the bargained price of sale is 80. We've agreed to sell it for 80. He has agreed to buy it for 80. I should book my sales at 80, not at 1 lakh. If it was cash discount, I would have accounted. Because it is trade discount, I have adjusted. So the journal entry is debtor account debit to sales. Here the debtor's name is Gagandeep and I'll credit my sales. Sales will not be credited by rupees 1 lakh. It will be credited by 1 lakh minus trade discount of 20%, which comes to 80,000. If there was no GST here, I would have collected 80,000 from Gagandeep. But the question continues to say, we have charged IGST because Gagandeep is from a different state, I am from a different state. We have charged IGST. If both of us were from the same state, we would have charged SGST and CGST. If I was in a union territory, I would have charged UTGST and CGST. Got it? Now, how much will I charge? 12% of IGST. So I have to collect from Gagandeep not just 80,000. I have to collect 80,000 plus 12% of 80,000. Remember, GST is charged after deducting trade discount, not before. First you deduct the trade discount, then on the balance price you charge GST. So how much is the GST that I am supposed to collect? 9,600 is a liability by name output GST. Why? See, GST belongs to government. Get this? No, not me. I have sold goods to Gagandeep. I collect 80,000 for goods, 9,600 towards GST, 80,000 I should keep in my pocket, 9,600 I should deposit with government, telling this is Gagandeep's GST money. I am collecting and paying. I am only intermediary. I should tell Gagandeep's name, Gagandeep's GST number, address, invoice details and pay it to government. Till the time I pay, it is my liability. It is GST which is going to be output to the GST department. I am only an intermediary collecting from customer, paying it to government. So output GST is a liability. So how much money Gagandeep should give me? 89,600. Did you all understand this? The next entry, when I pay this output GST to government, will be output GST, output IGST account debit to bank account. When I pay it to government. Are you getting it? Let's see the next one. Third one. Goods distributed by way of free samples, 10,000. Why did I give free samples? Advertisement. Why did I give free samples? Very good. So we will write advertisement expense account debit. Advertisement expense should be debited. By how much? 10,000. Credit will not be sales. Why? You are not selling goods. I'll tell you why should you not write sales. If you by mistake write here 2 sales 10,000. In trading account, credit side where you write sales, this will go sit there. GP will be found as a percentage of sales. No. On that sales, when you apply percentage, GP barta hai. Hey, you have not sold goods. You didn't even recover the cost. How can you make profit? So GP lot of times is applied as a percentage of sales. To ensure GP computation will not be wrong, we should not write such goods given away other than by way of sale as sale. I am not talking about advertisement. Goods given away otherwise than by way of sale should not be credited to sales account. Be credited to purchase. Purchases, why do we credit purchase? We are reducing the goods that I purchased. When the goods are taken away as free samples, when the goods are taken away for drawings, charity, or when the goods are destroyed by fire, any of these circumstance, asset is decreasing, credit will not be sales, credit will be always purchases. And on this there will be no GST. On this there will be no GST adjustment. Did you understand this? Hell yeah. Very good. What's after that? Third one done. See the fourth one. Goods at of list price 40,000 returned by Gagandeep. So we had sold goods to Gagandeep. No, he returned it. So this is sales return. What is the entry for sales? Debtor to sales. Sales return. Sales return to debtors. Sales return to. So goods are coming back. It is represented by way of sales return account. I would write sales return account debit. To whom? Gagandeep. Am I right? What is the money? 40,000. Firstly, the moment you write 40,000, answer will be wrong. Why? They have told very clearly it is list price of 40. List price means what? In the price list that you give, it is 40,000. That's not the value at which you did the trade. When you did the trade, you gave 20% discount. When you take it back, you need to take it back at 20% discount. If not, you will be under loss. Are you getting it? It is like me. I went to a shop and I bought Colgate toothpaste, 100 rupees. I asked the uncle, uncle, I'll always come here only. Uncle will tell, hey, okay, beta, take 10 rupees discount. Gave it to me for 90 rupees. I will take the Colgate toothpaste and come to the end of the street. Uncle will go inside for breakfast. Auntie will come to the shop. The moment the auntie comes, I will go and say, okay, auntie, my mom told don't want toothpaste. There is there enough, it seems, at home. Take it back. Then auntie will say, oh, okay, but take your 100 rupees. Then I'm making 10 rupees profit. That's not how it will work. You get this? So that 40,000 rupees is their MRP price. They sold it to me at 20% discount. When I return, they give back to me after 20% discount. 40,000 list price, you do minus 20%. 30. Very good. 32,000 is the money that I give back to Gagandeep. But I won't give. Why? He has not given me that. Whenever I sold the goods to him, he has not given me money. No. Whenever he returns, I won't give you money. I'll deduct from the money that is supposed to give it to me. That's the reason I'll write sales return to Gagandeep. You understood? Gagandeep account will not be the amount of 40. It will be 32. But actually sales return is 32. 40,000 minus trade discount. Second point here is output IGST should be adjusted. Are you getting what I'm trying to tell? Now that GST also will get adjusted. I would write output GST debit. Why? Here I credited it. No. Now I am reversing it. So I will debit it. Get what I'm trying to tell? To that extent, when the sales return happened, it is not like sales return. It's like deduction in sales. So to that extent, I don't have to pay GST to government. Are you getting it? So how much is that? You tell. It is that 32,000 into 12%. That comes to 3,840. So actually my sales to Gagandeep is not 89,600. It is 89,600 minus 35,840. Only on so much money GST is collected and paid. Did you understand this? Come on everyone. Make some noise. Did you understand? At this specific point, you need to recall one concept from your subsidiary books. When I make this sale to Gagandeep, I'll pass sales entry. When I make this sale here, I pass sale entry. Along with the sale entry, I give a printout to Gagandeep with goods. It is called as invoice. It is called as when Gagandeep returns the goods to me, I am crediting Gagandeep's account. After I pass this journal entry, I'll take a printout of this journal entry and give it to Gagandeep, saying that I've accepted your sales return. That is called credit note. What is it called as? Who issues credit note? Seller. When is the credit note issued? On sales return. Understood? When he returns goods to me, Gagandeep will issue me debit note. I will give him credit note. Did you understand? One more concept from subsidiary books got revised. After this, there is one last transaction. Kuldeep became insolvent. Insolvent means he jumped into water, his body did not dissolve. No, insolvent means he is supposed to pay us 6,000 rupees. He is supposed to pay us 6,000 rupees. He has a liability of 6. He sold all his assets. He started paying all his liabilities. His assets are not sufficient to pay liabilities. His assets are not sufficient to pay. It is not assets are less, liabilities more than asset. Liabilities more than asset. Allah. Realizable value of the asset is insufficient to settle the liabilities. Are you getting it? Please don't tell liabilities is more than asset is insolvent. Liabilities cannot be more than asset. Equal no in balance sheet. So what does it mean? It means realizable value of the assets is insufficient to pay the liabilities. Are you getting it? This is CA foundation. That is first PUC. First PUC, that is correct. CA foundation, grow up a little. Okay. Then, so what do? Kuldeep is my debtor, Sundri debtor. He should give me money. When he gives me money, I will write bank account debit to Kuldeep account. Am I right? How much is he supposed to give? 6,000. But does he give me 6,000? He gives me a little bit of money and he gives me a little bit of headache. He says that he can only pay 50% of the money. He can only pay 50% of the money. So, if he pays 50 paise in a rupee, that is 50%. I'll write 6,000 to 50%, 3,000 rupees received. Sir, what about balance 3? Bad debts. Do you understand? Tada! This is the journal entry question from our Jan 25 article. Got it? Can we go to subsidiary books next? Yeah. And later when we find time, we'll discuss a little bit about GST. How to do GST in journal entries. Okay. So, come on. Let's see the topic of what happened. Yeah. Didn't revise. On recovery, the journal entry is bank account debit to bad debts recovery. We did not do any recovery here. You are asking a different circumstance altogether. No, oh, no, it doesn't know what. Okay, whenever we finish a question, we'll put a tick mark next to that question. So we just finished capital revenue. We finished journal entries also. So now we will do that subsidiary books revision, and we'll finish one question on sales book also, what is there in the recent RTP. After that, we will do rectification of errors, then break. What time are we taking break? Around 1:30? Whenever I say. Whenever andre okay. Whenever, wherever. ಅಷ್ಟೇ ಗೊತ್ತು, ಮುಂದೆ ಗೊತ್ತಿಲ್ಲ. I know only those two words in that song. Okay. Funny, let's do little bit of our subsidiary books. Little bit. Won't take too much time. ಏನಾಗ್ತಾ ಇದೆ? Time is running fast. Why are you talking? See, I'm not going to teach you journal entry rules and everything. That part we skipped. Yeah, how to pass journal entry, identify transaction, categorize it into accounts involved. Skipping, no. How to post journal into ledger also will skip. Is that okay? We'll start from trial balance. See, the door is open. Only the ones who want to be quiet can be in the class. The ones who want to talk, you can leave. Feel open mode trial balance. Focus. What is trial balance? Trial. Before you play the real, you play trial. Same thing. Before you do the balance sheet, you play one trial to check whether double entry system is correctly complied or not. If there is something wrong, you will get to know at this stage, not after you prepare the balance sheet. So that trial, what you do, checking whether the balances are right, is trial balance. It is a statement. It is a statement prepared comprising of all the ledger balances, comprises of all the as on a specific date to ensure that it is easy to prepare final accounts. If you don't prepare trial balance, no, whenever you start final accounts, whenever you want each item, you should go to that ledger. You should go to that ledger. You come back. Instead, all the ledger balances, when you close them, write it in one paper. Just that paper is sufficient to prepare final. If in case trial balance as a concept was not there, whenever they wanted you to prepare balance sheet P&L, question papers was supposed to be 30-40 pages. Why? They were supposed to give all the ledgers. Looking at that, you are supposed to prepare final accounts. Now, whenever you are supposed to prepare final accounts, question will be trial balance. So trial balance will help us prepare financial statements with ease. You can't even imagine the world without trial balance. I can't imagine my world without trial balance. Balance sheet is telling to trial balance. Yeah. So why is trial balance prepared? Three objectives. Number one, to check arithmetical errors. I told you if there is any error, we'll identify when we do trial balance. It doesn't tally. That means there is an error. Next one is it simplifies the preparation of final. Third one is it acts as a summary of all the ledger accounts. Got it? Very good. So when is trial balance prepared? No, it is prepared whenever you want to prepare final account. Got it? Let's say you want to prepare final accounts after one quarter. Then you need to prepare trial balance. Got it? So trial balance is prepared just before preparation of financial. Just before preparation of financial. So there are three methods to prepare trial balance: total method, balance method, total and balance method. You always follow balance method. You always follow total method. Mein what do we do? Ledger is there, no? Debit items, credit items. You don't find balancing figure. Take the totals, write them as it is. Balance method, identify the balancing figure in the ledger and all those balancing figures are posted. Total and balance method, very simple. We'll write the total debit, total credit, debit balance, credit balance, both the columns. You understood? But all the questions that we do will be usually on which method? Balance method. Okay. Very nice. So I'll not spend time on that. Can I skip that? Total method, balance method, total and balance method. Yeah. What if the trial balance doesn't tally? You'll call it suspense account and you'll write it there. You get it? So whenever you put suspense account, then the trial balance will tally. So don't tell, sir, trial balance was not tallying. I put suspense. Now also trial balance is not tallying. Then that means that I am suspect. I have a sus about how did you put that sus. So you should actually remove that suspense and then identify the suspense balance. You got it? So once you put suspense account, the trial balance will tally. It is actually not trial balance. You will tell, hey, trial balance alla, adjusted trial balance. Adjusted trial balance. It is not a trial balance. It was not balancing. We have adjusted it and made it become, what is it, tally. Correct? So there is an error in adjusted trial balance. Till the time we figure it out, it will remain as adjusted trial balance. The day we find out the error, we will rectify it. Okay? Till then it will remain there. Get this? So when the trial balance doesn't tally, what will you do with the difference? Whether it is debit or it is credit, put it to suspense. And later when we figure out, we will rectify the error from there. Understood? Then see, from journal you post it to ledger. From ledger you post it to trial balance and trial balance to final account. However, preparing journals and then doing ledger is a very hectic task. Journal you record historical information in chronological order, account wise. Then you categorize them and classify them in ledgers. If you imagine a business organization which has hundreds of transactions happening simultaneously, it's almost impossible to do journal. You will say, I am special, I want something special. Then there is a special books that come. It's called as special journals. What is it called as? Another name for special journals is subsidiary books. It is called subsidiary books, also known as special journals. So this is same thing like journals, but you keep one separate journal for each of it. Previously, what were we doing? One book that she has, no. In the same book, we're writing journal. In the same book, we're writing ledger. In the same book, we're writing journal entries. What's happening is there is a sale transaction. It should be written there. There is a purchase transaction. That book. Payment. That book. Depreciation. That book. At one time in one book, how many people can write? At only one person, no? So she's writing one transaction. There are 100 transactions waiting for her to be writing. So she'll be overburdened with work, and efficiency will come down. Mistakes can become more, and that book, if it's lost, everything is lost. So now what do? We'll tear that book into 4 books, or let's say 8 books. One book she will keep record only of sales. Another book she'll keep only record of sales return, purchase, purchase return, cash, petty cash, bills receivable, bills payable. We'll split that. So now I get transactions. I'll give her only sales transactions to be recorded. I'll give purchase transactions here, cash there, petty cash there, bills receivable there. So simultaneously, when she's writing sales transaction, someone else is also writing purchase transaction. So work will become more fastly recorded into books of accounts. And let's say there is something wrong in bills receivable. I don't have to stop your work. All of you will continue your book. I'll only take bills receivable book and then check where is the error. And it will become easier to find the error also. Are you getting it? That is subsidiary books. What is it? Subsidiary books is dividing one journal into several parts so that multiple people can record multiple entries at the same time. It will become highly efficient. It will become simpler, and moreover, expertise also will come. Now we will become expert in recording purchase records. Someone will become expert in AP, accounts payable. Someone will become expert in AR, accounts receivable. So it will be easily become expertise can happen. And some places it can be automated. Usually you would have heard no people working in AP department, AR department, cash department, but you won't hear people working in sales account department. You know why? Because whenever I make sales, I'll generate one invoice in the computer. I will connect this invoice generation software to my accounting package. The moment I generate the invoice, automatically the journal entry will come in my books of accounts. It can be automated. Not everything can be automated. Certain things can be automated. So wherever automation is possible, we should do it. So we divide it so that the efficiency will become better. Understood? Very good. So subsidiary books are primary books of entry. These are alternative to journals. Why do we prepare them? For following advantages. Read them. Number one, like I told you, it can be divided. Next one. Third one. After that, last one. Did all of them were explained in that example that we took? Next. But when do we prepare subsidiary books? Daily basis. Like how we do journal. How we do journal. On daily basis it is done. Small business follow journals. Big business follow subsidiary books. Got it? Then next thing that we need to know is how many subsidiary books do we have? Sales book, purchase book, sales return book, purchase return book, bills receivable book, bills payable book, cash book, petty cash book, journal book. In sales book, you write all sales transactions, which are credit and which are of goods. Which are of goods. If it is cash or if it is asset, you won't write. So what do you write in sales book? Read record of goods sold on credit. Understood? We record all the transactions in sales book at the end of the period. Total of the sales book is transferred to sales account. The end of the year or at the end of the period, sales book total is transferred to sales. Sales account will have total of sales book and total of cash sales also will come from cash book. So sales account will have total sales. Total sales is credit sales plus cash sales. Credit sales from sales book, cash sales from cash book, together total sales. And when you write an entry in the sales book, it has to be like this: date column, invoice column, if available. If not available, leave it. Particulars, you will write the details of the party who's purchasing the goods from you. Write the value of the goods purchased. First to deduct trade discount. First to deduct, then add GST, then add freight. GST will come between trade discount and freight. GST will come between trade discount and it should be not before trade discount. It should be not after freight. Freight will be added at the end. Trade discount will be deducted in the beginning. GST will be before freight or after trade discount. Understood? Okay. Very good. Purchase book exactly same. Please read. When do we what do we write in purchase book? Record of goods at the end of the period. Total from purchase book is transferred to. Everyone understood? Again same. First to trade discount, then GST, then freight. Got it? Purchase return book and sales return. Previously, if the entry was made in sales book, you will make the entry in sales return. Previously, if the entry was made in purchase book, then you can make the entry in purchase return. Otherwise, no. Understood? This book is also called as return inwards book. Read quickly. Record of goods returned earlier sold on. Total of this book is transferred to sales return account. Got it? Next point is, here you open one column called credit note. What were you opening here? Invoice. What do you open here? Purchase return book, same to same, but the column name is debit note. Understood? And what do you write in cash book? All cash transactions. What do you write in cash book? It doesn't matter whether it is capital or receipt, whether it is what to say, revenue or capital. Whether it is capital or revenue, sorry, whether it is capital or revenue, whether it is income or expense, whether it is goods or asset, all cash transactions will come in. All cash transactions will come in. Petty cash book is to record all the kuti payments. Bills receivable, bills payable is promissory notes and bills. Okay. Then next one, last one, petty cash book. Petty cash book, you don't have to mug up the order here. There is no need to mug up the order. And cash book can be three types. How many types? Simple, double column, triple column. Simple column cash book. Simple cash book. How many columns will be there? One. Andre one column andre day to particulars biಟ್ಟು one column. What is that column? Amount column. Wow. Cash column, huh? Bank column. Depends. Depends. If in my business I don't accept payment through bank, you come and say Paytm, I will say TM Pay. I won't accept payments online. I accept only cash. So I will have single column cash book, only cash column. However, I say cash we won't touch, sir. Under kasu samana. I won't touch. Only payment through Phone Pay, Google Pay, Paytm. Then my simple cash book will have bank column. The simple cash book will have two column cash book or double column cash book. What are the two columns? Cash and discount or cash and bank? Depends. I do cash business. I don't do payments through online. I will give discount, cash and discount. I won't give discount. If you want to pay cash, you pay cash. If you want to pay through online, you pay online. But discount can be. Two column is cash and bank. Are you getting it? If I say I won't take cash, you pay online, I will give discount also. Bank and discount. It depends. Are you getting what I'm trying to tell? Triple column cash book means cash, bank, discount, all three. Okay. And whenever you prepare this cash book, very important thing to remember. In discount column, no, don't ever do totally. Leave it just like that. Why? There the debit balance and credit balance should be posted separately. Debit is discount allowed. Credit is discount received. They are two different items in P&L. Don't total it. Don't find the balancing figure. And whenever a check is received, first treat it as cash received. Write it in the cash column on debit side. When the check is deposited, then write it in the bank column debit side. Credit in the cash column. Did you understand? Should I repeat? When a check is received, write it in the cash column. Understood? When it is deposited, credit it in the cash column and then debit in the bank column. Always write that. Even if the check is deposited on the same date, please do this. They expect you to do this. Please do this in cash book question. Okay? Hell yeah. Very, very good. And whenever there is a contra entry, always write alphabet C in ledger folio column. And dates are important in cash book. Don't skip. Next point. Sir, should we write debit, credit? Should we write particulars or receipt payment? Interesting question. Shall I give the correct answer? When you use the word cash book, you should not write debit, credit. When you use the word cash account, you should write debit, credit. Second point. When you use the word cash book, write receipts, payment. Don't write particulars. When you write cash account, you should write particulars, not receipts and payment. So when you write particulars, then you should write debit, credit. When you write receipt, payment, you should not write debit, credit. Cash book, receipt, payment, no debit, credit. Cash account, debit, credit, particulars. Got it? Did you get this? Yeah. That's how it should be done logically. There is no question, unfortunately, in the RTP. Maybe if you still want, we can pick one from the past exam or RTP and do on cash. Otherwise, if you are very comfortable and confident, we can skip. Petty cash book. Don't ever mug up the names. Not required. If the question comes on petty cash book, which has not come till date, if it comes, if they give, say, carriage in the question, prepare carriage column. In the question, if they give postage and stamp column, prepare postage and stamp column. In the question, if there is no postage, don't have to prepare postage column. They don't have to be in the specific order also. Can be jumbled up. If the question has that expense, you will open it up. If the question doesn't have that expense, you don't have to open that column. Got it? So based on the question, you will tailor make your PTK. You don't have to mug up the format. This is not. Got it? Fantastic. I think by this we are done with our accounting process chapter 2, except that we need to do a question on sales book, and we will also discuss rectification of error. Okay, break Ediklama. We'll take a break here. Fantastic. It is 1:10. Take a break. I'll expect you all back in the class by 1:45. Don't expect long break. Marathon. If we come back late, we will only end the evening late, no? So come back by 1:45 so that we can start immediately at 1:45. Let's start with subsidiary books and rectification of errors, and then do the further part after that. How long do you want? Till 3 o'clock. Then half an hour, no? Breakfast break usually used to take. Lunch break also should be half an hour. Adge madbeka. Okay, be back by 2 o'clock. 2 o'clock, I'll lock the door when I start. If you're coming after 2, don't come. Let's now solve question 4A from our RTP Jan 2025. This question is on subsidiary books, which is sales book in this case. Before you start this question, remember in sales book, you only write credit sale of goods. If it is cash sales or if it is relating to asset, it would not be entered in sales book. And in sales book, you need to write the column as date column, invoice number column, particulars followed by amount column. If in case there is trade discount, packaging charges, GST, preferably open one inner column where you do all the computations and then post it to outer column. Because in this question they've not given us the details of invoice number, I prefer to skip it. And remember, first multiply units with value per unit, you will get the total value. First deduct a trade discount, then add GST, then add packaging, freight or transportation charge. Remember, first trade discount, then GST, then transportation or freight or packing charge. Okay, let's start. Alpha, prepare sales book of Messrs Alpha of Kanpur for March 2024. There are so many days: March 5th, March 12th, March 18th, March 28th. Don't read it again and again. Just write March 2024 in the heading. Go on writing just the date when you write that specific transaction. Got it? First, 5th of March. What is the transaction? Sold goods to Messrs ABC. 10 pieces of chairs each at rupees 5,000 plus trade discount 5%. So it is, the name of the party is mentioned and they have not mentioned that it is cash transaction. So it is a credit transaction. You agree with me that it is a credit transaction? So I would write 10 pieces into 5,000. I would write here 5th of March, Messrs ABC, 10 chairs into rupees 5,000 per chair. How much is 10 chairs into 5,000? Trade discount has to be provided at 5%. Deduct trade discount at 5%, which comes to 2,500. Have they given any information about GST? No GST. Save it for CA Inter. Write 47,500 here. And that's the end of first transaction. Can we go to the next one? What is happening after 5th of March? 12th of March, we sold goods to Messrs PQR. 25 pieces of tables, basically 25 tables at 2,000 rupees each table. So I would write 12th of March, Messrs PQR, 25 tables into rupees 2,000 per table, which comes to 50,000. Trade discount 10%. 10% of 50,000, 5,000. 5,000. Trade discount 5,000. Don't write 45,000 in the inner column and 5,000 in outer column. Okay, you would write 5,000 deduction, 45,000 is the value of sale. After 12th of March, we have 18th of March, sold to Messrs MTV 5 pieces of recliner chairs at rupees 11,000 each. Ashtena. Yeah, surprising. Very good. Transaction is not to be recorded. Sir, why? It is sold. Payment received through cash. Because the payment is received through cash, this transaction will appear in cash. It will not appear in sales book. Are you getting it? Read the next one. 28. Sold to Messrs LMS 50 pieces of cupboards, 10,000 each. So 50 into 10,000. Shall I write it? LMS cupboards 50 into 10,000. 5 lakh. How much is the discount? 20%. So deduct 20% discount 1 lakh. To write 4 lakh in the outer column. The total of the sales for the month of March we posted to sales account is 47,500 plus 45 plus 4 lakh. 4,92,500. Did everyone get it? That's it. Fantastic. This is solution to question 4A. Easy one, but you should be prepared to do this one with GST also. Not very difficult. After trade discount, before freight if any, add the GST amount. Okay. Now let's start with the topic of rectification of errors. Shall we start with rectification of errors? Yes. मौसम अभी बिगड़ने वाला है. Not really. It is a fun chapter. I'll first give you an overview of the chapter, then we'll do a question from our RTP. Your favorite. Remember, whenever we say error, error is an unintentional mistake. Error is an unintentional mistake. So it happened by mistake, okay? It did not happen with intention. You didn't plan and then you didn't plot and then you execute an error. No, it happened by accident. And you have to learn how to correct that. So rectification of errors is the objective. To do that, we need to know the type of the error. There are two types of errors. One, non-clerical errors. Two, clerical errors. The non-clerical errors means errors which would exist even if it is not accounted by clerk. Even if it is automated, this error can happen. That is non-clerical error. If it happened because the clerk is accounting it, it is a clerical error. Non-clerical error is a principal error, not PAL. Okay, PLE, principal. Get it? So principal error means you have recorded a capital transaction as a revenue transaction or a revenue transaction as a capital transaction. You purchased goods, you write purchase account debit to cash. You wrote furniture account debit to cash. You wrote it to the value of the asset. Or you purchased asset, you should write no that respective asset account debit to cash. Instead of writing that respective asset, you debited it to purchase. Again, what error? Principal error. A capital item is wrongly treated as revenue, or a revenue item is wrongly treated as capital. That becomes principal error. Did you understand the difference between principal error and non-principal errors? Okay. See, even if you automate the accounting, this error can happen. Another one can be repairs. When you incur repair expenditure, what is the entry for repairs? Repair account debit to cash. Instead of writing repair account debit to cash, repairs is incurred on machinery, you wrote machinery account debit to cash. Every time you make some repair, will the value of the machinery become more? Will the size of the machinery become big? No. When you do painting for the house, you should write painting charges account debit to cash. You should write building account debit to cash. Just because you painted 2 BHK flat became 3 BHK. No, it doesn't increase the size or the value of the asset. It should have been charged to revenue. If you don't do it correctly, it becomes principal error. See what is principal error? A transaction recorded in contravention of accounting principle. What principle? Capital and revenue principle. Got it? We had seen this capital revenue long ago. How to determine as capital and revenue. Same discussion. Example. Come on. 1, 2, 3. Start. Read. Asset purchase. No. Purchase book. Hey, asset purchase. Asset account. Goods purchase. Purchase book. Just because one word is common, will you write? They've done it. Repair expense. Debited to. So this is principal error. Then the next type of error is clerical errors. Clerical errors means because the accounting is done by the clerk, this error has happened. If the accounting was not done by the clerk, if it was computerized, if it is automated, these errors will not happen. So you can very safely assume that whatever errors you are reading right now in the clerical error section, this will appear only theoretically. Practically, when you start doing accounting, these errors won't appear. Why? They will be taken care of because it's all automated. When you type half-hearted journal entry, I'm going to say you type the debit side of the journal entry, credit side you don't type. System will not accept that journal entry. System will not accept that. Totaling error, casting error won't happen. It will automatically take the total. It will never take wrong total. It will not do posting total from ledger to trial balance. When you post, it will take the same total. It's all connected. No, under the neuro schema, it can't give you the wrong answer. Are you getting it? But in the manual accounting, these errors also used to exist. What are they? One, error of omission. Error of had lunch, everyone. What did you have for lunch? Karthik? Mushroom pulao. Pailwan pulao. Ala, pailwan pulao chakde. No, we this said. Oh, nice. Green color itala. Very good. So error of omission. Yeah, mushroom pulao, that pulao place, it's green in color. So whenever you say error of omission, there are two types of error of omission. One, complete omission. Two, partial omission. What is complete omission? Complete omission is like this. Hey Karthik, no, it's not me. Green color, no, blue color. Pant, chaddi. Your hands are on your face like this. Okay, not you. Somebody else. Okay, what do you mean by complete? Completely. Transaction is omitted, not recorded. Debit to Bardila, credit to Bardila. You didn't write anything. What is it? Completely not recording a transaction in books of accounts. Very easy. What to do with this? Pass the entry. They have not at all recorded. We should actually pass the entry. So example, asset purchased, not recorded. Repair expense, not recorded. Very simple. You can give any example. Depreciation, not recorded. Anything. So there is another called partial omission. This partial omission is slightly a problem. It is like this. Like imagine, okay, Pawan, you ate an apple. After you ate the apple, a worm will come out of it. You feel bad? You feel bad? You'll say, I won't eat apple. Oh, after you ate the apple, a worm came out of the apple. You feel bad? Yes. The more worst thing is half a worm coming out of it. So partial omission is more annoying than complete omission. Complete omission may completely entry is not written. But partial omission may what will happen? A transaction is recorded partly. If you don't record, it's okay, we can write. They've written half. Correct? No, you ate half apple. Sorry, half worm. Not recording part of the transaction in books. So they've written debit. They didn't write credit. Let's say asset is purchased. They wrote asset account debit. Then yes, delivery bantu asset. So you took the delivery of the asset. Because you took the delivery of the asset, you forgot to write cash account credit. That's it. So you wrote asset account debit. That's it. What is it? Partial omission. Or you wrote it in the subsidiary book. You should post the total to the ledger account. Did not post. So this becomes error of partial omission. Read this. Number one. Recorded in but not posted to, or repair expense debited to but not recorded in. Fantastic. Come to the next one. Error of partial omission and complete omission is over. Next one. Error of commission. This is weird. You have recorded it, but you recorded it wrongly. For example, there was a scientist who wanted to bisect a frog and also have his breakfast. He packed the frog and the breakfast and then he went to the lab. He thought first he has to read the theory and later he can do the bisection. So he was reading the thesis of some research and then he thought he'll have the breakfast along. He finished his breakfast, also finished reading the thesis. Later he thought he will bisect the frog and open the box to see his puliogre in the box. So that is another problem here, which is error of commission. What has happened in error of commission? She is explaining. So error of commission means you have recorded the transaction, but you have recorded wrong. You are supposed to record this account, you recorded this account. So yeah, vegetarian became non. Okay, yeah, correct. Yes, I was just thinking. So transaction is recorded, but in the wrong account. But in the, like, you are supposed to write Pawan account debit. The moment you type PA, some other name came, like Bhavani account. Someone's account you know. See, there were two persons, like Pawan Enterprises, Bhavani, and then there were 3-4 customers in the ledgers. So you wrote it to some other person's name. You get what I'm trying to tell? Can this happen that you recorded the same transaction but in the wrong person's name? Yes or no? So you're supposed to debit bank. You type B, building account came. Building account debit. So possible. So this is the error here. Transaction is recorded at the wrong account, or sometimes you recorded the correct account. When you're supposed to write 4,545, you type 4,455. It is recorded in the wrong account or at the wrong amount. That becomes error of commission. Please read what is error of commission. Transaction, amount, or in wrong account or wrongly balanced. Totaling time also you did some error. So any of this will become error of commission. Read the example. Goods purchased from Dolu wrongly credited to. They look very similar, no? Yun Chetty, own shirt, own Chetty, own shirt. Color. So you got confused whom to write. Dolu came, purchased goods from you and left. You had to write Dolu, you thought it is Bolo and you wrote it to Bolo account. Or purchased goods for rupees 4,500. But you recorded at 5,000. Can this happen? Yeah. They do a lot of weird entries like this. Purchase of goods wrongly entered in sales book. So purchase happened. He's supposed to enter. He's supposed to take the books. Then someone will call. You're talking to them and then he'll open some other book. In the wrong book, he will make the entry. Have you seen that? So you would have come across that adjustments. No. Purchase of rupees 500 was wrongly passed in the sales book. Wrongly passed through sales book. Different. We'll deal with it. Okay. Don't worry. So errors of commission means either wrong account or wrong amount or wrong total. Last one is compensating error. Last one is compensating error is something even more amazing. Compensating error, what will happen is you didn't just do one error. You followed it up with one more error. No, both errors together. It looks like you did not do any error. Did not do any, but actually you did two errors. Actually you did. So whenever you received cash, you should debit. No, by mistake you credited. Whenever you paid cash, you should credit. No, you thought when I received cash, I credited. So when I give cash, I should debit it. So you debited it. Now, actual error is one transaction of 1,000 and one transaction of 800. Now, actually difference is 200 units. Because one error has got compensated because of another error to make it look like as if there is no error. But there are actually two errors, which is actually difficult to find. When something doesn't match by 200, you check all the items which have 200. No, here the items of 1,000 and 800, there is an error. So this is not self-revealing error. It doesn't reveal by itself. Surprise. No, you would have to find it. Hide and seek. So most difficult error to find is compensating error. Will you please read compensating error? Read. Read the example. You will get confused. No, they've done everything ulta. When you purchase the asset, you should debit. They've credited. When you sell the asset, you should credit. They've debited. Full fantastic. Read the next one. Cash received. Both the things they've done wrong. You get it? Next, after this types of errors, we'll just try and see how do these errors impact our trial balance. Because of the impact that these errors will cause on trial balance, we can classify the errors into two categories. One-sided, two-sided. One-sided errors actually affect trial balance. Because of this one-sided errors, trial balance will not tally. However, when we say two-sided errors, in spite of this error, our trial balance will still tally. Repeat, because of one-sided errors, trial balance will not tally. But if it is two-sided errors, in spite of this error, trial balance will still tally. Are you getting it? Now, whatever we read till now, omission, commission, partial omission, compensation, let's classify them into one-sided and two-sided, shall we? Okay, first one, one-sided error. Example, note that. So tell me the first one. Principal error, one-sided, two-sided. One-sided or two-sided? Two-sided. In spite of this, trial balance will still agree. So when trial balance tallies, that does not mean it is free from errors. It can still have principal error. It can still have. Sir, how is it two-sided, sir? You are supposed to write purchase. You wrote furniture. One side, purchase should have been not debited. You have debited. Second one, furniture should have been debited, not debited. So two sides. There are two sides of the error here. I repeat. Purchase of goods wrongly debited to furniture. Purchase of goods wrongly debited to furniture should have been not debited. You wrongly debited it. Am I right? One side of the error. The other side of the error is purchaser should have been debited, but it's not debited. So this error when you do, trial balance will still tally. By looking at the trial balance, you cannot identify principal. By looking at the trial balance, you cannot identify. In spite of principal error, trial balance will still agree. Agree means tally. Got it? Am I going fast? You will ask me at any point if you want me to repeat something or slow down. Very good. Then let's go to the next one. So error of principal is two-sided. Help me with complete omission error. Two-sided, one-sided. Two-sided. In spite of error of completion, trial balance will still agree. Trial balance will still. What are the two sides? Debit side also you have not written. Credit side also you have not written. Understood? Very good. What is after that? Error of partial omission. ಅಲ್ಲ ಬಿಸಿ ಕ್ಲಾಸಲ್ಲಿ ಒಂದು ಸ್ಪೂನು ಸರ್ಜರಿ ಮಾಡ್ತೀನಿ. Trial balance will agree or not agree in spite of because of partial omission. Trial balance will not agree. Trial balance will. Very good. Partial omission. No, one side you written correct and other side you have not. Balance agala. You get it? Next, after that, what about error of commission? Whenever there is error of commission depends. Yeah, you should check whether it is one-sided or two-sided. It can be one-sided, but it can also be two-sided. Fast aita. Compensating error will be usually two-sided error. Compensating error will be usually two-sided error. In spite of compensating error, trial balance will still tally. Trial balance will still tally. Trial balance will still agree. Both mean the same. Don't think you told something, I told something, I told something else. No, I told the same thing. Different use of language. At any point of time, you would feel like you want to note down some part of this. Remember, which chapter was it? Make a note in your page that trial balance, rectification of errors. You make a note. Once they upload it, you can take that part, take a screenshot or write down or whatever you want to. Okay. Don't stress yourself right now to write down everything. You might not be able to write down everything. Going at a little faster speed. Let's go to the next part. In order to rectify the error, you need to identify the error. If you don't identify your mistake, how can we rectify it? To rectify the mistake, the first step is identifying the mistake. Am I right or no? Whenever I drink tea, my eye used to pain. Whenever I drink tea, my eye used to pain. So I stopped drinking tea, my eye stopped paining. So is the pain in the eye because of the tea? I thought so. After some days, I started drinking tea. Again, I started paining. Then I thought eye pain is because of tea. No, the problem was not there. The problem was after I make the tea, the spoon used to be in the glass. When I drink, that spoon used to poke into my eye. So you should identify the problem. When you identify the problem, right, the solution will be correct. So here also, whenever you prepare trial balance, it's not tallying. What do you do? Stop preparing trial balance. No. So ಇವಾಗ ಬರುತ್ತೆ ನೋಡಿ ಟಿ ಹೆಂಗ್ ಮಾಡೋ ತೋರಿಸ್ತೇನೆ. So we need to identify the error to rectify, and the stage at which we identify the error will decide the rectification. The stage at which I will identify the error will decide the rectification. Error can be identified instantly. The moment you do the error, then only you understand it is an error. What to do? Scratch it and then rectify it. So that is stage 0. There is no questions on this in your material. Scratch, how to rewrite the entry, there is no questions in the material. Then comes stage 1. What is stage 1? You did the error. After some time you understood, oh, what I did is wrong. When? Little later, but not too late. Little later, not too late. Too late is after trial balance. Not too late is before trial balance. After you did the journal entry wrong, at the ledger stage or at the journal stage only you understood, not after you prepared trial balance. Now what to do? You need to further classify it into one-sided or two-sided. If it is one-sided, you can't pass journal entry. One item was correctly written, one item was not written. That one item what was not written, you write. If it is supposed to be debited, you debit it. If it is supposed to be credited, you credit it. It becomes one-sided error. We only do adjustment. If it is two-sided error, both the sides are there, no, we can actually pass journal entry. We can actually pass. Understood? Suspense won't come here. You know why? Suspense will come when the trial balance doesn't tally. Trial balance prepare ಆಗಿಲ್ಲ ಇಲ್ಲಿ before trial balance. ನಿಮ್ಮ ಅಪ್ಪ ಅಮ್ಮನ ಮದುವೆ ಫೋಟೋನಲ್ಲಿ ನೀವೆಲ್ಲಿ ಇರ್ತೀರಾ? Exactly. You get what I'm exactly no. So how will there be suspense account in error before trial balance? Trial balance is done. Stage 2 you are doing rectification. Then it will come. Agastya is an it is an exception. Let's not talk about Agastya Pandey all time. Come on here. Focus after trial balance. So trial balance is prepared. Trial balance is prepared. After you prepare trial balance, if you identify the error, you need to tell them, is it one-sided or is it two-sided? If it is one-sided, we don't just do adjustment. Lead. If it pokes your eye, it starts bleeding, so tissue. I'll tell. You know Archimedes? You don't know. That's the reason you don't know why is food. Okay. Archimedes came out with a thesis. He told an item, if it puts out the exact amount of its weight's water outside, it will sink. So if it puts the exact amount of weight outside, it sinks. Otherwise, it floats. So I have a tea bag which floats. Just make it sink, I need to put something which will put the exact amount of water outside. Okay. Listen. One-sided error. If it is one-sided, then we have to do adjustment. But if it is after trial balance, when the trial balance doesn't tally, suspense has come. So that suspense will be involved in the journal entry. For example, let's say there is furniture purchased of 10,000. You forgot to write furniture debit 10,000. Trial balance, credit side there is 10,000. Liability for furniture. Debit furniture 10,000 is not there. You write suspense 10 and close the trial balance. Now, in your trial balance, there is suspense of 10. In that suspense place, furniture should come. Suspense already has debit 10. You credit suspense by 10 and debit furniture by 10. You credit suspense by 10 and debit furniture by 10. So it is a one-sided error. Furniture was supposed to be written, not written. Liability for furniture was written. So in this error, we write the journal entry as furniture account debit to suspense account. So though it is one-sided error, it will have journal entry with suspense. And anyways, two-sided error though will be journal entry, but without suspense. Will it have suspense? First one is a suspense thriller movie. Second one is not a suspense thriller. It is a rom-com. Then stage 3. Stage 3 is too late. After final accounts, trial balance over, trading P&L, balance sheet over, balance sheet you printed, gave it to investors also. After that you understood, oh, that I've done error. So now can you rectify? Now there is a problem in rectification. You can't take the paper which is in someone's hand and then wipe. Sorry, you can't take the paper which is in someone's hand and then correct. No. So what should you do? Should correct in this year. Error has happened last year. Correction should happen this year. Now listen to me carefully. Whenever you do rectification of the error which happened in the last year, it should not make current year statement wrong. Like this. Yesterday when you did coffee, you forgot to put sugar. Today's coffee, will you put 2 spoons extra sugar? Yesterday's coffee became kashaya. Today's coffee will become paisa. You shouldn't do that. So what you do is, if you identify last year's error in the current year, when you do rectification, you cannot use the accounts which will impact profit and loss. In the current year, after final accounts, after preparation of final accounts for the previous year, in the current year, if you identify an error of previous year, in the rectification entry what we pass here, we cannot use accounts that will affect P&L. We cannot write purchase, we cannot write sales, purchase return, sales return, stock, any other expense or income account cannot be used. It will be replaced with profit and loss adjustment account. Did you understand why do we do it? Let's say last year purchase of 10,000 was not recorded. You did not realize last year. You wrote it to suspense. In this year when you identify, if you write purchase account debit this year, you know what will happen? This year's trading account will go wrong. This year's GP will go wrong. This year's COGS, this year's GP percentage, everything will go bad because you made an error last year. Are you getting it? Last year's error should not make current year financial statements bad. So what do? We route it through an account called as P&L adjustment account. We will learn the extension of this in CA Intermediate Accounting Standard 5, net profit or loss, prior period items and changes in accounting policies. There we will call this kind of item specifically with a name called PP, prior period item. What do we call them? Prior period item. Item of previous year arising, item arising in current year because of an error or omission in previous year. That has to be disclosed separately in P&L. It cannot be just like that written in P&L. We'll do a question on this. The Jan 25 exam question is, Jan 25 RTP question is nice. It has beautiful adjustment on this, and it also has one error in the heading, not just error in the entries. So you would have done something like that. And steps to pass the rectification entry, your favorite part. You should learn when you are learning the topic, but you should not do in the exam. Step 1, wrong entry. Step 2, reversal of wrong entry. Step 3, wrong entry plus correct entry. That will be your rectification entry. Am I right? I hope you people have learned this. Yes. Now let's not waste much time. What will we do? Straight away we'll start doing questions from our RTP. Are we ready? Come on guys. Let's do RTP Jan 2025 Satvik question. Give me a moment. You can read through the question if you want till then. Mr. Satvik. ಏನೋ ಮಾಡಿದಾನೆ ನೋಡಿ ಅವನು ಏನು ಮಾಡಿದಾನೆ. See, that water bubble came out. No, if it was filled to the brim, that water would have spilled out. Any object, then you will say, sir, not that class. Happened? Not working. Okay, shall we start with this? This is question 4B. Interesting question. Actually, very interesting. Sometimes they give a very easy question in our RTP. This time they have given a good one. Will you write it with me or I'll write and you will see? You'll write with me. Okay. If you want, you can write with me. If you want to just listen and understand because you come to class without any book in hand, I am okay. I won't ask why did you not get the book to class. Kelala. If you come so far, I believe that you have it in you, what is required to go ahead to enter. Come on. Adding more pressure. Illa, I'm giving you compliment. Yeah. Oh, motivation. ಎಲ್ಲ ಕಡೆ ಮೋಟಿವೇಶನ್ ಆಗ್ಬಿಟ್ಟಿದೆ. ಎಲ್ಲರೂ ಮೋಟಿವೇಶನ್ ಕೊಡ್ತಾರೆ. That guy, third standard, what difficulty does he have in life? He is giving us motivation. Very, very ಕಷ್ಟವನ್ನು ನೋಡಿ ನೀನು ಧೃತಿಗಿಡ ಬೇಡ ನಿನ್ನ ಕಷ್ಟವನ್ನು ನೋಡಿ ಪ್ರಪಂಚವೇ ಗುರುತಿಸುತ್ತದೆ ಶುಭರಾತ್ರಿ. What difficulty have you seen in life? Coming home, doing homework and sleeping is your difficulty. And you are giving life motivation to people who are 40, 50, 60. Okay, I'm not talking about me. Let's start. Come on, guys. Let's now solve question number 4B from our Jan 2025 RTP. This question is on rectification of error. Beautiful question. Start reading. Mr. Satvik was unable to agree the trial balance. Oh, nice. Because of that only has come to us, no? Last year. Oh, very early. When was he not able to tally the trial balance? Last year. And wrote off the difference to P&L account. Cheh. Whenever trial balance doesn't tally, you should write it to suspense. He is wrongly written it into. For this, he has to do one rectification entry. You usually forget. What do? We leave 1, 2, 3, 4 lines. Come to 1, 2, 3, 4, 5, 6, 7. Adjust these 7 entries. Sorry, 8 entries. But forget that he has done one error even before beginning these errors. He's done one error even before beginning these errors. Whenever the trial balance doesn't tally, the difference in trial balance should be transferred to suspense. Is wrongly transferred into P&L. I'll tell you what is it, and I'll also explain this once again at the end of this particular problem solution. If he writes it to suspense, every time I pass rectification entry, that suspense will get cleared. If he's written it to P&L, from that P&L, that balance has gone to capital. Now, whenever I write rectification entry, I am creating suspense. I am not eliminating suspense. So what should I do? At the end of all the rectification entries, find the total of suspense account balance. This suspense account balance should have been there in suspense account at the beginning of this error, but it is not there. Why? He did not transfer the difference in trial balance to suspense. What did he do? Instead, he chose to transfer it to P&L account. Because he has transferred this exact amount to P&L, capital has gone up by the same amount. Now we should reduce the capital, or we should adjust the capital with the exact suspense amount. In short, if I have to tell, after you do all 8 rectification entries, find the balance in suspense, transfer that balance to capital. Why? Previously, if you would have created suspense on rectification of 8 entries, this suspense would have become 0. Because he has not previously transferred it to suspense, on the passing of these 8 entries, you have freshly created suspense. So transfer it to capital. Why capital? Previously it was transferred to capital. Now you transfer this to capital. Impact in capital will get nullified. Understood? This is exactly like how you do with regard to P&L adjustment. In stage 3 rectification, identification of the errors after final accounts, what do? Every place where there is nominal account, basically item affecting P&L is there. Purchase, sale, purchase return, sales return, expense, income. You replace it all with P&L adjustment and take the total of P&L adjustment, transfer it to capital. Take total of suspense account, transfer that also to capital. When should you transfer the total of suspense to capital? When the suspense account is not opened. Instead, the balance is transferred to P&L. What if they are told in this question, difference is written to suspense? Then that additional entry of transferring suspense to capital will not arise. I gave you an understanding of what is to be done. I'm really hopeful that you have understood. If you are hopeless, then don't worry. After I solve all the 8 adjustments, I'll explain it once again and you'll understand. Okay? Very good. Whoever has understood in this level of explanation only, when you like to Haley, you have understood. If you have not understood, dislike idya YouTube not there. Dislike to Haley, you did not understand. And at the end I will teach, then dislike na like. Okay, read. Next year, he appointed a chartered accountant who examined the old books and found the following mistake. Could have come previous year only. Okay, they have given the errors. Shall we rectify them one after the other? See the first one. Purchase of a scooter was debited to conveyance. Conveyance means traveling expense. When you buy the scooter, scooter is asset, not expense. Should have written scooter account or motor vehicle account debit to bank. What has he done? He's written conveyance account debit to bank. This is principal error. Is this? You should have debited asset. You have debited expense. Conveyance account debit to cash is the entry that is passed. Correct entry that should have been passed is scooter account debit to cash. Scooter was supposed to be debited. It was not debited. Shall I debit scooter now? Come on, let's debit scooter. Yeah, scooter account debit. How much is the value of the scooter? 30,000. I would write 30,000. I have wrongly debited conveyance. I should have not debited conveyance. Because I have wrongly debited conveyance, I will credit conveyance account now. But conveyance account is an expense account. I am supposed to decrease the conveyance expense of previous year, but I am rectifying it this year. So in rectification at stage 3, that is errors identified after final accounts, I cannot be crediting an item affecting P&L. So I'll replace my conveyance account with profit and loss adjustment account 30,000. I'll write conveyance, scratch it, and then write P&L adjustment so that you know it was supposed to be conveyance, but it has now become P&L adjustment. However, when you write in the exam, you need not write conveyance, scratch, and then write P&L adjustment. You can straight away write scooter to P&L. If you still ask, sir, why did you write? If I write scooter to P&L, you know P&L, but you don't know at what place is P&L adjustment coming. Just for you to know, I'm writing it. You know, after this, they've given further, Mr. Ratan charges 10% depreciation on scooter. See, if you would have recorded the scooter purchased at the beginning of the year, by the end of the year, you would have charged 10% depreciation. He did not record scooter account only. Instead, what did he write? Conveyance expense. So because he did not record the asset, he has not recorded depreciation also. Now that we rectify the error and say that, che, it is not expense, it is scooter, and we record the scooter at 30,000, we should provide depreciation entry also. What is the entry for depreciation? Very simple. Depreciation is an expense. It should be debited to depreciation account, credited to scooter. This is error of complete omission. This is error of entry was not at all passed. Shall we pass? So we will write the accounting entry. Depreciation account debit to scooter. But depreciation is a nominal account. It will affect profit or loss. May I write? Any item which is passed by way of a rectification entry after final accounts will affect current year P&L. It should be eliminated by P&L adjustment. So instead of depreciation, I'll write P&L adjustment. How much depreciation? 10% of 30,000. 3,000 is debited to P&L adjustment, credited to scooter. We're done with this entry. Instead of passing these two entries, me recording my scooter at 30 and depreciating it by 3,000, I can choose to record my scooter at 27,000. Here, credit P&L adjustment 30. Here, debit P&L adjustment 3. Instead, I will credit P&L adjustment by 27,000. Did you understand this? Instead of recording the scooter at 30 and depreciating it by 3,000, I can choose to record my scooter at 27,000. Did you understand? So, lot of times in the material, this entry will be provided. It is totally okay. Or you can choose to write this entry followed by this entry. It is also fine. I'll give you another piece of information which I want you to focus and listen. Will you listen? In this question, they've given it all in one single line. Purchase as a scooter, purchase of scooter was debited to conveyance, 30,000, depreciation 10%. They've given it together, but they need not give it together. They can give purchase of a scooter was debited to conveyance account 30,000 year. Depreciation is to be charged at 10% on the assets can be given at the last line here. Just before they give past rectification entries. That's possible. Whenever they give such an adjustment, then what to do? You will not be knowing to write this way entry in the beginning. So what to do? Write this first entry in the beginning. Later at the end when you read depreciation adjustment, at the end you read this. At the end you write this entry. You will still get full marks. Don't worry. Understood? So you can write either ways. You can write either ways. Write asset entry and then do depreciation entry, or straight away write the depreciated value of the asset entry. Got it? Can I go to second error? What is the second error in the question? The total of return inward. Return inwards means what? By way of return, the goods are coming in. So previously the goods had gone out. So this is sales return. Sales return. Sales return. How much? Total of 12,400. What was not posted to the ledger. They should post, no? They have not posted. Shall we post it now? For July month, 12,400. Very good. Let's write the second adjustment. So sales return should be debit or credit? Sales credit, because the goods are going out. Sales return, the goods are coming back. Sales return should be debited. I'll debit sales return only to realize that this is rectification of error after final accounts. Sales return account, sales account, purchase account, expense accounts, income accounts cannot be used. I should replace this sales return account with P&L adjustment, 12,400. Credit will be returned to debtors account, 12,400. Did you get this? Entry will be P&L adjustment account debit to debtors. Okay. Very nice. What is after this 12,400 entry? Third one. A credit purchase of goods from Mr. X for rupees 20,000 was entered as sale. This is purchase. If they don't record, we can record. Firstly, they have not recorded purchases. They have wrongly recorded it in sales. See, when you purchase goods, let me complete. Credit purchase. So it is purchase of goods. Do you agree with me? I should debit purchase account. I have not debited purchase account. So I will now debit purchase, which I should not do. I should transfer to P&L adjustment. Next thing, instead of writing purchase, they have wrongly written as sale. Sale account is wrongly credited. It should have been not credited. So I will again debit sale also. It should also be not done. Purchase account should be 20. Sale account should be 20. I'll replace both with P&L adjustment account. I'll repeat once again. It is purchase of goods. I should have debited to purchases. I have not debited to purchases. So I will debit now. I have wrongly credited it to sales, which again I should have not done. I'll debit sales. 20 purchase, 20 sale together becomes 40. P&L adjustment, because purchase and sale will affect our current year P&L, which you should not. After that, what have they done? Mr. X account also would be wrong. Why? Entire transaction is recorded wrong. No. You agree with me? When we wrote purchase account, I should have done purchase account debit to X. No. I have not written purchase account debit to X. So I'll write 2X now. And when I wrote sales, I have wrongly debited X. I should have not debited. I should credit it now. So X account should be written with double the amount. What is the double the amount? 20 plus 20, 40. And here 40 will appear here. Sir, I did not understand. When you write purchase account debit, you should have written X account credit by 20. You did not write 20. So you would have to credit it by 20. You wrongly recorded as sale. Then you debited X account by 20. No. That debit 20 should have been not there. To reverse that debit 20, credit once. To record the credit 20, credit once. Or in another way, I was supposed to write debit side 20. Sorry, I was supposed to write credit side 20. I wrote debit side 20. From debit side 20, take a U-turn, come back by credit 20. You come to 0. Again credit 20. You go to credit 20. You have to reverse it. Got it? Hell yeah. Fantastic. Let's go to the fourth one. Shall we? What's happening in fourth one? Receipt of cash from Mr. Preetish. When you receive cash, entry is cash to Preetish, no? Was posted to Ravish. Error of commission. Error of entry recorded in the wrong name. So you should have recorded cash to Preetish. You recorded cash to Ravish. So Ravish account should have been not credited. You wrongly credited it. So debit Ravish account. You are supposed to credit Preetish. You have not credited Preetish. Give credit to Preetish account. Same amount, 10, 10. Got it? You are supposed to credit Preetish. Entry was cash to Preetish. You did not write Preetish. You wrote credit Ravish. You wrongly credited Ravish. You will debit Ravish. You are supposed to credit Preetish. You will credit Preetish. Got this? Fourth one. That name also looks something is wrong. Ravish. Ravi, okay. Ravish, no one will keep Ravish. I've never heard. First time keltaradu. Preetish. Preeti, okay. Preetam, okay. Like it's like this 8ish, 7ish, 9ish, Preetish, Ravish. Like Ravish types. Receipt of cash from Mr. Chandu was posted to the debit office account as 5,000. When we receive cash, we should write cash account debit to Chandu, no? Chandu should be credited. Chandu was wrongly debited. So wrong debit reverse madake onsati credit. Right credit record madake innonsati credit. So credit Chandu account with double of 5,000. 10,000. Shall I do it? Yes. Observe Chandu account credit by 5 plus 5, 10. Debit. Suspense. Everyone understood this? Paka. What is after this fifth one? Come to sixth one. While carrying forward the total in purchase account to the next page, 55,950 was written instead of 65,950. The correct amount is 65,950. 55 is written instead of 65,950. Now, what is correct amount? 65,000 is the correct amount. What have I written? 55,950. I have written less or more? Less. Purchases has been undercasted. Correct amount 65,950. Wrong amount 55,950. I should take it from 55,950 to 65,950. I should increase my purchase account balance by how much? 10,000. I will debit. I will debit my purchase account. Shall I debit my purchase account? Yeah, purchase account will be debited by 10,000 because it is error after rectification. I'll replace it with P&L adjustment. Credit will be suspense. Did you understand 10? Hell yeah. What is after this sixth one? Sale of goods to Mr. Rohan for rupees 20,000 was omitted to be recorded. It is sale of goods. Record ಮಾಡಿದ್ರೆ omit ಮಾಡಿದ್ರೆ. So shall we record it now? Very good. What is the entry for sale? Rohan to sales. Rohan to sales. But sales cannot be written. Replaced with P&L adjustment. 2020. Rohan account debit to P&L adjustment account 2020. Understood seventh one? Come on, let's go to eighth one. Eighth one is the last one as per the adjustments. But we need to do two more entries. I'll explain them once again to you. Freight paid on machinery was 5,600. This freight of 5,600 should not be written to freight account. It should be added to machine. Do you agree with me? Because when you learn depreciation chapter, you would have understood the cost of the asset. Entire expenditure incurred till the date the asset is ready to be put to use should be added to the cost. So 5,600 rupees should be added to the cost. What have they done? Was posted to freight account. They wrongly wrote to freight. Okay, amount adru correct. Adu wrong. Firstly, they should have written freight. Sorry, machine. They wrote it to freight. Nextly, they should have written 5,600. They have written 6,500. Understood? Check. Freight was wrongly debited. Shall I credit it? Credit. Credit freight. How much was it wrongly debited by? 6,500. Credit 6,500. Freight account should not be credited. No. It will be replaced with P&L adjustment 6,500. It was supposed to be debited to machinery. I will debit by machinery. How much? 5,600. Sir, there is 900 difference. That is suspense account. Everyone understood this? Suspense account. Freight of rupees 5,600 which was supposed to be debited to machinery was not debited. So I debited machinery by 5,600. It was wrongly debited to freight at 6,500 which I credited by 6,500. Later replaced it with P&L adjustment account. Any difference arising wrote it to suspense account. Understood this? By this we are done with eighth one. Hey, all of them are done. We need to do two more entries now. First one, because whenever the suspense arose in the last year, they wrongly wrote it to P&L. If they would have written it correctly to suspense, here when we do all the errors, our suspense would have got closed. Now whatever the balance is in suspense, now it will come in balance sheet. Are you getting it? So I'll close this suspense to capital. Why? Last time when the error was identified, they identified total suspense balance. They've written it to P&L. From P&L it has gone to balance sheet capital. So I'll transfer now this one also to capital. It will get adjusted. Help me with the calculator. Everyone take the calculator. First entry, is there suspense anywhere? No. Second entry, is there suspense anywhere? Third entry, is there suspense anywhere? Fourth entry, suspense. Fifth entry, debit 10,000. Take in your calculator plus 10. Debit is plus, credit is minus. Did you all take plus 10,000? Then come on here. There is credit 10,000. It becomes 0. You take minus 10. Did it become 0? Then do we have suspense anywhere? Yes, here plus 900. Correct? So there is suspense account only balance of 900. If you have to learn it once again, I'll tell. See, first journal entry is suspense to Chandu. In suspense account, you should write to Chandu account 10,000. And the next time you have suspense is P&L adjustment to suspense 10,000. So in suspense account, you'll write by P&L adjustment account 10,000. In P&L adjustment account, you should write to suspense. How much? 10. Got that? Hell yeah. Then the third time entry is machinery account debit, suspense account debit to P&L adjustment. How much is it? 900. So here I would write by that 900 rupees. No, sorry. It is suspense debit to P&L adjustment. I am sorry, to P&L adjustment 900. Am I right? Here I would write by suspense 900. Identify the balancing figure in suspense account. 10,900, 10,900, 900 balancing figure that should be transferred to capital. That should be transferred to, if you do plus minus, whatever number comes, no, that has to be made 0. To make it 0, what should you do? Think of it and pass the journal entry. So by capital is the entry. So basically the journal entry is capital account debit to suspense. Capital account debit to suspense. How much? 900, 900. Being suspense closed by transfer to P&L account incorrectly last year, because of which the capital has become wrong, now corrected by closing the suspense account by transferring it to capital. Got it? Similarly, wherever you written P&L adjustment account, that will not go to P&L. That will not go to, that should also be straight away adjusted to capital. Why? Because of these errors, last year profit was wrong. Because last year's profit is wrong, last year's capital is wrong. Now we'll correct the capital straight. We'll not adjust our profit. You get it? Help me, yeah. P&L, where and all do we have P&L? First entry, do we have P&L anywhere? Yes. How much? Credit 30. Take your calculator, minus 30. Credit is minus, okay? Debit is plus. Oh, too strong a color. Take a diluted color. Is this okay? Okay? Or still lighter? Okay. 30,000 credit, minus 30 in the calculator. You take plus 3,000. Basically a minus 27. Am I right? Instead of taking these two entries, if you would have taken this, you would have got minus 27. No, don't take minus 27. It will become minus 54. Okay, minus 27 you understood. Here, debit 12,400. So plus 12,400. Okay, plus 40,000. Here nothing, here nothing, here. Plus 10,000. Minus 20,000. Again minus 6,500. What did you get? 8,000. 8,900 minus or plus? Plus. To make it 0, what should we do? Minus. Minus means credit. So credit P&L adjustment account by 8,900. Debit capital account by 8,900. That's the end of the story. Did you understand? Take it in the calculator. If it is plus, you should do minus, credit. If it is minus, you should do plus, write it debit. If not, prepare a ledger account. Not a big deal. Observe, I'll teach you ledger account also. First one, scooter to P&L. In P&L, buy scooter 30,000. In P&L, you should write buy scooter. How much? 30,000. First entry done. Come to second. What is there in the first entry is second sub entry. P&L to scooter. So in P&L, I should write to scooter. How much? 3,000. I would write here in P&L to scooter 3,000. Done? Hell yeah. So by this we're done with the first one. Come to second one. Entry is P&L to debtors. So in P&L I should write to debtors. How much? 12,400. In P&L I will write to debtors. Second point, 12,400. Done. After that, third one. Am I going very fast? P&L to Mr. X. Am I right? In P&L account I should write to Mr. X 40,000. I would write in P&L to Mr. X 40,000. I'll go to fourth entry now. Observe the fourth entry. Ravish to Pritish. Is there P&L in this? No. Fifth one, suspense to Chandu. Is there P&L? No. Sixth one, P&L to suspense 10. Already we wrote. And Rohan to P&L. In P&L, what should I write? By Rohan 20. In P&L, I'll write by Rohan 20. Got it? What do you have after that? By Rohan 20, by Rohan 20. Fifth one, Allah. Sorry. Sixth, seventh one over. Then machinery debit, suspense debit to P&L. How much P&L adjustment? 6,500. Shall I write there buy machinery 5,600 and buy suspense 900? Buy machinery 5,600. Buy suspense 900 to anyways return. What is after that? Capital to suspense. This doesn't affect P&L. This is the balancing figure entry that I just passed. Check the balancing figure here. Which side is more? 40, 52, 55, 65 here. 65,000 here. 65, 400. 50, 55, 56. Deduct 65, 400 from the same. 8,900. This will be transferred to which account? Capital. Entry is capital to P&L. Here I wrote capital account debit to P&L. Yay. Understood? Fantastic. Okay, I understood your doubt. You don't even have to tell. I'll tell you where did you find this doubt. Here no, but purchase wrongly recorded as sales. No. Second entry. 1 second. Hello. Return inwards. Okay, posted to the ledger. Let me come here. When you say the total of return inward book of July 2024, 12,000 was not posted to the ledger. Okay, there is a very interesting discussion here. When they tell to ledger, what does it mean? When they mention to the ledger, what does it mean? Both actually mean different things. Both actually means different things. Should I explain further? To ledger means what? Debtors accountable bardil. To the ledger means they have not returned to that sales return book, and debtors is assumed. It is assumed to be a complete omission. When they mention it is not posted to ledger, it means it is from sales return book. It should go to debtors account. It's not written in debtors account. When they say to the ledger, that means total is not written. You get it? A similar one can be treated like here, instead of writing debtors, they would treat it like debtors accountable bardil. Sales return is not written. Another point is, observe here, we're talking about total. We're talking about total will be not transferred where? When we talk about total, do we transfer individual transactions to debtor, or do we transfer the total to debtors? Sorry, will we transfer individual transactions to sales return account, or do we transfer the total amount to sales return account? Total. So when they talk about total, they're talking about total sales return amount not transferred to sales return account. They're talking about total. The error is not in debtors account. Error is in sales return also. Let's just see once. I think this should how it should be. But this can be questioned. The debtors account might have been correctly written. Debtors account might have been correctly written. This is 3 alva. No, 4. 4A, 4B. The debtors account can be skipped. You can write suspense. 4B. Change agata. Avaga change. 4B no. 4B. P&L to suspense. So the error is in actually total amount. No. So sales return is not written. So debtors account is correctly there. This will be suspense account. This will be suspense account. So when they use the word total is not posted to the account and total, when they tell, what does it mean? When they use the word total, okay, listen to me. Sales return total will be transferred to which account? Sales return book in the total will be transferred to which account? Sales return account. No, so that they have not done. Debtors account error, and we cannot assume that the mistake is only in debtors account. This I did not. It was unforeseen. Morning 11 o'clock I told no. That is this one. They told in the lunch break. So if I want it at 5 o'clock, I should tell now. Take 2 hours to dig, and then take the water, then make the fire, and then heat, and then make the glass, then pour. Take little. Okay. Total of the sales return will be posted to sales return account at the end of the year. The total they have forgotten to post. At the end of the year, total they have forgotten to post. We will now post. So the moment we do that, here I wrote no 2 suspense 12,400. So in suspense account, it should appear as by P&L adjustment 12,400 second month. Yeah. Sales return. Yes. The problem is only in sales return. Sales return. What is the journal entry? Suspense to sales return. No. Sales return to suspense. In suspense account, I'll write. Hey, what was the entry? Third one, no? Second one. P&L adjustment to suspense. So in suspense account, I should write by P&L adjustment. Sariyagi. By P&L adjustment. Second one, alva. Amount involved is 12,400. When I write this total will change, no? Yeah. Madana. Yes, that's what I'm telling. I'll do it. 2. So the total here, can I say it is 22,400? From 22,400 deduct 10,900. What do we get? 11,500. Am I right? I didn't see that word. Sorry. Okay. Now in suspense account we written 2 capital 11,500. Here the entry will change. Suspense account debit to capital account. How much? This doesn't change suspense. This doesn't change P&L. Doesn't change P&L. P&L it doesn't change. P&L the second one here written 2 debtors. No. Instead of writing 2 debtors, I'll write 2 suspense account. Do you want me to solve this from the beginning? $12,400. Understood this? Rest everything is same. All you need to remember is, Kelri please, Matarbidi. The total of the sales book is posted to sales account. Total of purchase book to purchase account. The total of sales return book is posted to sales return account. What have they done? They have forgotten to post the total. So we will write it to sales return account. Debtorsally, no mistake. What if the same question they had given that it's not posted to the account they have given? The account means sales return account. If they would have told not posted to account, to means from sales return it will go to debtor. So in debtors it's not written. It would have meant to account or to their account means it is not recorded in debtors account. Understood? ಅದನ್ನೇ ಹೇಳ್ತಾ ಇದ್ದೀನಿ. If they mention total is not posted to the account, error is in sales return account. If they just mention not posted to account, from sales return where will you post? Debtors. From sales where will you post? Debtors. From purchase and purchase return to creditors. Error would have been in purchase account, creditors account in that case, or debtors account in this case. Understood? You want me to throw more light on this? No? You got it? Understood? Doubt? Can you ask? Can you make a sentence and ask your doubt? I will answer surely. Okay. Let me help. Give me a moment. Can I have some silence? I'll help. I'll repeat. I expect only one thing, that you people should not talk when I'm explaining this. I feel like I made a note of this somewhere here. I can show that so that we can save class time. If I don't find it, I'll make you write it all. Okay, I don't think no point in wasting time. Shall we quickly write that down? Bhavesh, that's not allowed. I told you some time ago. No, keep it inside. I told you some time ago. And you're doing it and you're saying, no, 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 not what? No, not allowed. What are you doing? Just not no, nothing, nothing. I will tell. I'll make you write. Book is there, pen is there. Write it. Don't text it to her. Everything you convert it into subject and then say topic related only, no? Okay. Total of sales return book is to be transferred to sales return account. Total of sales return book is to be transferred to sales return account. As what is this? This is on second one, no? Adjustment 2. As the question states that total of sales return is not transferred to the account. What should we do? We have to now transfer such total to sales return account as part of rectification. There is no error in debtors account. Clear? If they would have not mentioned the word the account here, if they would have told total of sales return is not transferred to account, you tell me sales return will affect debtors. Sales return should be transferred to debtors account. Sales should be transferred to debtors account. When you make the entry in sales book, where is the other side of the entry? In debtors account. When they would have told sales return was not transferred to account, it means it is not written in debtors account. Would have done the rectification in debtors account in that case. Do you understand now? You can make a note of this point for further reference so that you can avoid confusion later. Stop talking. Ask me what's your doubt. This one. Got this? Everyone's done. Can we go to the next one now? If in case they are not transferred that what do you say difference in trial balance wrongly to P&L, maybe we would have not written this entry also. We would have not written this entry. Would have stopped at suspense. We are writing this entry because they have wrongly transferred the total of the suspense to P&L. Should I give a note on that also? Should I give a note on that? No, everyone's clear till here. So can we now go to the next topic of bank reconciliation statement? Come on guys, what we'll finish BRS in the next 15-20 minutes. Slowly I can hear some ukush pukush sound which should not come. Doubt? Understood? Come on, yeah. Observe. Bank reconciliation statement. BRS. So, what is bank reconciliation statement? As the name mentions, look at the word. It is a statement. It is a statement. Then why do we prepare this? So it is a statement. Got it? Then why do we prepare it? It is prepared to reconcile. See, the next question is, why is BRS prepared? Look at the second word there. Reconciliation, Nodi. It is to prepare to reconcile. What do you mean by reconcile? Reconcile means to identify the reason for difference. One moment. Come on. What do you mean by reconcile? To reconcile, I mean identifying the reason for differences. So, whenever we talk about bank reconciliation statement, we're talking about two statements. One statement prepared from the perspective of the account holder. I prepare a statement, that is cash book. And the other statement is prepared from the perspective of the banker. So, banker prepares a statement called passbook. I prepare a statement called cash book. Because we're two different persons, I'll record the transactions when it happens according to me. He will record the transactions when it happens according to him. So because we are two different persons, no, there can be difference between the times during which we are writing the transactions in the book. Because I see the transaction at a different time and he see the transactions at a different time, we record it at different times, and if there is a difference, that is okay. But other than because of time, there should be no difference. Other than because of time, there should be no difference. So what do you mean by to reconcile? The word reconciliation statement, reconcile means to know the reason for difference. Does it mean? What will you do knowing the reason for difference? Two people are fighting. You want to know why are they fighting? Why do you want to know why are they fighting? To tell whose mistake is it? It's your mistake. You need to correct this. It is your mistake. You need to correct them. So to identify the error and rectify the error is the objective because of which we want to know the reason for difference. What we do here, no, in foundation BRS, that's not how it is done in reality. In reality, how it is done is very different. We will know both the balances. Here, what do we do? They give one balance and they want us to find the other balance by doing add or less. Reality, that's not how it is. Let's say you started a business and you have your cash book. According to your cash book, you have the balance. And banker will give you cash statement, bank statement or passbook. That also balance is there. No more passbook. It is only bank statement now. So both the balances will not match. So you need to identify the difference. What usually appears to you in the exam is they give the differences. Are you getting it? They'll give you one balance, you find the other one. In reality, both the values will be available. You need to identify the reason for difference. Are you getting it? Among those reasons for differences, if any of the reason is an error, you have to do rectification like how you do in chapter 2 unit 8, what we just finished. You get it? So objective of BRS is not to find passbook balance or not to find cash book balance with the other balance available. In reality, what happens? You would know both passbook balance and cash book balance. You want to find the difference between these two and the reasons for difference between these two. Why do you want to know the reasons between these two? Among those reasons can be an error, and among those reasons, when there is an error, you have to rectify that error. So this chapter of BRS is actually extension of rectification, but it is specialization. Specialization in rectification is limited only to banking and cash transaction. This is nothing but actually rectification of errors chapter. Extension of rectification to find out and rectify the errors in cash book only. Got it? Is there something? Very nice. So what do you mean by to reconcile? To know the reason for difference. Shall we see what do you mean by difference and how can there be difference? To identify difference, there has to be two books. One, passbook, other one, cash book. Cash book is the account that I maintain. As a businessman, I keep a record of all the transactions, that is cash book. And when I say cash book here, I am giving reference to bank column of cash book. What am I giving reference to? Bank column of cash book. And when I say passbook, it is a statement of account prepared by banker. It is a statement of account prepared by banker from banker's perspective. Whenever the transaction affects him, he records it here. Between both of them, there can be differences. What can be the reasons for difference? Let's see each of them. The first one, I have issued a check to somebody, and the person to whom I have issued the check, he is not deposited with the bank. Let's say I gave the check to my supplier here. I wrote the entry, supplier account debit to bank. My bank balance decreased in my tally. So in my accounting package only. But that that supplier is still in front of me. The check is in his hand. How will the banker get to know that the check has been issued? The banker won't write the entry. Banker will write the entry only when the check comes to him and only after he clears the check. Till then, banker has not written the entry. I have written the entry because I have recorded a payment. My bank balance has gone down. Because the banker has not recorded the payment, banker's bank balance is much higher. You understand the difference? That is the first reason for difference. What is it? Check issued but not deposited, or check issued and deposited by the customer but it is not cleared by the bank yet. The second reason for difference is check received but not deposited, or check received and deposited but not cleared. What does this mean? My customer has given me a check. My customer has given me a check. The moment I received the check, I'll keep the check here. I'll write the entry bank account debit to customer account. I wrote the entry in my books. The moment I debit bank account, in my ledger account, bank balance has gone up, but the check is still with me. When I have the check with me, how will my banker increase my bank balance? I have to send this check to bank, but it's already 3:45. Bank is closed for the day. I'll send this check to the bank tomorrow. Banker will collect the money and deposit it to my account day after tomorrow. Till day after tomorrow, my balance has gone up. No, as per the bank, it's not gone. That difference is there, no? That is this. What is this? Check received but not deposited, or deposited but not cleared. This is because the same transaction is seen from two different people in two different times. I saw the transaction today. Banker will see the transaction after 2 days. The time gap, there will be difference. You agree with me? Very next. Very good one. Next one. Direct deposit by customer into bank account. My customer didn't want to bother me. He went to the bank and directly deposited the money in the bank. So banker has increased my bank balance. I don't know about it. I have no clue that my customer has deposited money. I did not write any entry. My bank balance has not increased in my cash book. But in the passbook, the balance has gone up. There a difference? Yes, that is the third reason for difference. Then next one is, because I've been doing all of these transactions frequently, I've become quite busy. So I asked my banker to make payments on my behalf directly. I tell my banker, pay my electricity bill, pay my water bill, pay my internet bill, and pay my rent, pay my interest expense. I've told banker to make some payments on my behalf. So without even asking me, he makes the payments on standing instructions, auto debit. Like Prime subscription, every 3 months automatically money gets deducted. Automatically when the money gets deducted from my account, my bank balance has gone down, but I have not passed any entry for it. So according to me, my bank balance has not gone up, still higher. But according to the banker, the balance has gone down. There is the difference though. That is another reason for difference between passbook and cash. Are you getting it? Next one comes to be receipts collected by banker on standing instructions. Like how I instructed my banker to make payments on my behalf, I have also given instructions to my banker to collect money on my behalf. My banker will collect interest on my behalf. My banker will collect dividend on my behalf. Banker has collected, banker has increased my bank balance. I have not recorded the entry, because of which there is a difference here. Got this? Other than this, there can be 2, 3 more. Number one, banker, why did he do all of this? Because he will give me services and he will charge me money for the same. Banker has recorded charges. He straight away deducted from my bank balance. I have not made entry. So in my cash book, the balance is much higher. The passbook, the balance has dropped. So this is another reason for difference. What is this? Bank charges recorded in passbook only. Similarly, banker will give me interest for parking my funds in the bank. When the banker gives me interest, banker credits it to my bank account automatically. When he does this, my passbook balance has gone up, but in my cash book the entry is not written, because of which again there is difference between passbook balance and cash book balance. You agree with me? Then banker is a human being, I am a human being. Banker can make mistake, even I can make mistake. So there can be errors in cash book, there can be errors in passbook. These are the 9 reasons for difference between balance as per passbook and balance as per cash book. Whenever you take up BRS, you will be having balance as per cash book, also balance as per passbook. You need to figure out the differences between them. Check transaction, idide illa, illide illilla, illide illilla. Write them like this. And for these, you would have to do rectification if there are errors. That is practical, but theoretically it's different. What do we do here? Very simple. They'll give differences, they'll give one balance. You need to figure out the other balance. You get what I'm trying to tell? Fantastic. That is like checks in hand that we record as cash and we deposit with the bank. That is only for cash book accounting. In real time accounting, no, you don't do that. The moment check is received, you record it as a bank. No, okay. The moment you send it, you record. No, not when it is cleared. At least when you send it to bank, you record it as bank account debit to cash, but it's still not cleared by the banker yet. Okay. Now let's do this question on BRS and later I'll teach you the next part. Let's see if they've asked with amended cash book or without amended. I think the question here is without amended cash book. Let's solve it without amended cash book and then I'll teach you the concept of amended cash book. How does it come? Why does it come and everything. Shall we? Not getting any response. Are you all sleeping? Yes, sir. Okay, from the following particulars of Iqbal, prepare BRS. Have they asked amended cash book? No, they have not. So shall we do this simple question from our RTP Jan 2025? Are you ready? Come on, let's start with question number 5. Couple of pointers for you to know whenever you're doing BRS. Remember, you don't have to write add items, less items separately. You don't have to write like add heading and then write 4-5 add items and then less. No, go with the flow. On the add, on less, so on less, so on that. You write them in the same flow, and don't have to maintain one inner column, one outer column. Write them everything in the straightaway outer column only. Next thing, if in case the question starts with overdraft balance, don't try to change all the add items to less and all the less items to add. Start with minus balance. Keep the numbers negative, not the word. Then life will become very simple. Let's start. Hello. Let's now solve question number 5 from our RTP Jan 2025. This question is on bank reconciliation statement. From the following particulars of Messrs. Iqbal Enterprises, prepare a bank reconciliation statement. So I have written in the books of Mr. Iqbal that Iqbal Enterprises. It's not in his personal books. Messrs. is like respect to the entity. Can we now start with question number 5 from our Jan 2025 RTP on BRS? Yes, start reading the question. From the following particulars, prepare BRS, sir. Okay, bank overdraft as per passbook as on 31st of March 2024 was 8,800. Unless they don't give cash book, unless the cash book balance is missing, we will always start with cash book balance. Only when cash book balance is missing, we'll start with balance as per passbook. Is there cash book balance here? No. Even at the end, if they give cash book balance, we'll still start with cash book balance. Have they given cash book balance? No. Because they've given passbook balance, I have no option but to start with balance as per passbook. But they mentioned that it is overdraft balance. Don't write overdraft balance as per passbook, right? Bank balance as per passbook. How much is the amount? 8,800. Amount will be minus 8,800. If you write here overdraft balance as per passbook, then you have to write positive number there. Overdraft is minus means it is positive. No, bank balance is minus means overdraft. So start it this way. Then read each of the transactions, see what has happened, and then try to identify the cash book from the passbook balance. Checks deposited in bank 5,800, but only rupees 2,000 is cleared. Adjustment is not for 5,800. Adjustment is not for 2,000. Adjustment is for difference. 5,800 you deposited into bank. When you deposited 5,800 rupees worth of checks into the bank, your balance as per cash book, C for cash book, increased by 5,800. But only 2,000 were cleared. So the extent of 2,000, P for passbook, increased by 2,000. So cash book increased by 5,800. Passbook increased only by 2,000. Can I say the difference is 3,800? So the extent of 3,800, checks have been deposited but not cleared by passbook. So cash book has gone up by 5,800. Passbook has gone up only by 2,000. How much is the difference? 3,800. Now the difference between them is 3,800. You need to ask yourself a question. Can you see the P? No, you cannot see the P. In order to see the P, either you would have to P up or you would have to C down. What's in your control? P in this case. Why you starting with passbook? P means passbook, C means cash book. So we're starting with balance as per passbook. What do you do? P up, add. How much? Difference, yeah, 3,800. So add. Checks deposited but not cleared, 3,800 will be added. Got it? Next one. Checks you have issued is 2,500, 3,800 and 2,000. Add 4,500, 5,300, 8,300, no? Together during the month. So when you issued so many checks, no, your cash book balance has reduced by 8,300. 8,300, no, to the total. During the month, the check of rupees 5,800 is still with supplier. So basically 2,500 and 3,800. No, no, no. 5,800 is you have two checks. 3,800 and 2,000 rupees together. The first 2,500 check is there. No, supplier has cleared it. Passbook balance came down. But for the balance 5,800, passbook balance has not come. So basically here the adjustment is for 5,800 because 5,800 rupees is the check which is issued but not cleared. For what amount do you do adjustment? Check issued but not cleared, or checks deposited but not cleared. How much is the check issued but not cleared? Check is issued, cash book reduced by 5,800. Not cleared, passbook has not reduced by 5,800. Are you getting it? Can you see the P? No. In order to see the P, either you have to P down or you have to C up. What's in your control in this case? Starting with balance as per passbook. So what do you do? P down. Common sense. Yeah, P down. Minus 5,800. Understood this? What is after this? Dividend collected by bank. Banker has collected dividend of how much? 1,250. Was wrongly entered as 1,520. Oh, how much did you collect? 1,250. So you should have recorded 1,250. No, was wrongly recorded in cash book as 1,520. How much is the difference? 270 rupees you recorded more in cash book. Passbook went up by 1,250. Cash book went up by 1,520. Passbook went up by 1,250. Cash book went up by 1,520. Cash book has increased further by 270, which it should not have. What do we do? Either C down or P up. What's in your control? P. What do we do? P up by how much? 270. Shall I add 270? Everyone understood? Cash book, they have recorded 1,520. But passbook has increased only by 1,250. Passbook is further increased by 270. Sorry, cash book is further increased by 270. Changes in passbook, you add that. Got it? Next, what do we have? Corporation tax, rupees 1,200 paid by bank as per standing instructions, appears in passbook only. So there is some tax paid by bank. You given the instruction to banker to make the payment. Banker has made the payment. The payment is recorded in passbook. Passbook balance went down. Cash book you did not record. So cash book may not recorded. Cash book balance is not reduced. Passbook payment is made. Passbook balance is reduced. Can you see the P? No. In order to see the P, either you have to P up or you have to C down. You both have to be in same line for you to see. Correct? No. Light travels in a straight line. Now what do we do? P up. Correct or not? Shall I add? What happened? Add 1,200. Is this difficult? Okay. Interest on overdraft 930 was debited by bank in passbook. Okay, listen. The entry for interest has been made in the passbook. It is overdraft interest. It is not interest on the bank balance. Bank passbook balance has reduced by 930. Bank cash book balance has not reduced. Can you see the P? No. So in order to see the P, either you have to P up or C down. Where are we making changes? P. What do we do? P up. Add up. How much? 930. Got it? What's interest on overdraft is an expense. Passbook balance will reduce. It is not you have positive balance and they've given you interest. Like you've taken loan from the bank. They have charged you interest. They have deducted your bank balance further down. Then what do we have? Direct deposit by Mr. Rajesh Trader 400 not entered in cash book. So one of your customer has directly deposited 400 in bank. Because he deposited 400 in the bank, bank balance as per passbook has increased. Cash book balance has not increased. Where are you making changes? Passbook. What do we do? How much? 400. I'll write here less 400. Last item, amount transferred from fixed deposit account to current account. 2000 appeared only in passbook. When made fixed deposit, that fixed deposit is time deposit. No, time has matured, the money has come back to your bank account. So passbook balance has increased, cash book balance is not. Where are you making changes? Passbook. What do I do? Deduct. I will deduct 2000 rupees. What do I arrive at? Take, if it is minus or plus, just write that amount and write balance as per cash. It doesn't matter whether it is positive or negative. How much? Minus 8800 plus 3800 minus 5800 plus 270 plus 1200 plus 930 minus 400 minus 2000. 10,000. 10,800 is minus. See, listen to me carefully. Please stop talking. Either you write bank balance as per cash book 10,800 or you write overdraft balance as per cash book 10,800. If you want to write 10,800, here you write overdraft. If you write bank balance, don't write it as what to say positive number, write it as negative number. There is another way of writing it. Other way is credit balance as per cash book. How much is credit balance as per cash book? 10,800. Multiple ways of presenting the same answer. Or you can write balance as per cash book 10,800 credit. Balance as per cash book 10,800 credit. Got this? Is everyone with me? Very good. So in this particular question, what we did is they gave passbook balance, we found cash book balance. They can give it other way around, but they can also further ask us to identify the correct bank balance to be written in the balance sheet. You tell me which balance is correct. Balance as per cash book is correct or balance as per passbook is correct? No, it is balance as per cash book subject to rectification. In this BRS process, we identified these differences. No, 1, 2, 3, 4, 5, 6, 7, 8. In this, some of them are timing differences, but not all of them are timing. Some of them are arising because of time. One person sees a transaction at one specific point of time, the other sees it later. If it is because of time, it is okay. If it is otherwise than because of time, then there is a problem. Then there is a, for example, let's see, this checks not deposited, sorry, checks issued but not cleared, all of them are okay. Dividend is an error. See, dividend is received, it is entered in passbook, it should enter in cash book. No, if they don't enter in cash book, it is an error of complete omission. It is an error of complete omission. Wake him up there. No sleeping in class. If you want to sleep, go home and sleep. If you want to sit in class, stay awake. And here, warning, come to this side edge. You, the one in front of you. There. Yeah, come to this side edge. No talking. Come one row ahead. Get up. Or you want to go? Kelsa idya? One in front. Stand. Any problem? You will not talk to your neighbor. You also. ಕುತ್ಕೊಂಡ್ರೆ ಮಾತಾಡ್ಬೇಡಿ, ಮಾತಾಡ್ಬೇಕಂದ್ರೆ ಕುತ್ಕೊಂಡ್ಬೇಡಿ, ನಿಮ್ಮ ಇಷ್ಟ. You want to sit or you want to talk? Sit and talk is not the option. Combo illa. Or like, sir, we'll sit here and talk, you continue. I am not giving you that option. Okay, dividend collected and recorded only in passbook. What will happen? It's an entry made in the passbook. It should have been entered in the cash book. What is this? Sit. Sit. You get it? In the exam also sleep like this and write like this and all. I've seen people write. Agala sir, Agala, don't do that. Don't do all that. It will not work. You get what I'm trying to tell? When you're studying at home also, don't read like this. Won't work. Won't work. Till the time you change, it will continue. So change early so that the results change. What is this? Yeah, you guys have been studying for so many years today. Should we still teach how to study? Have you ever seen me teach like this, or not just me, any faculty teach like this? See, okay, see, today we'll do BRS. As have you seen anyone teach like that, or have you seen anyone teach like this? Huh? And we are not writing exam. When we only do it, do you think you should do? You are more concerned, no? January langeno agala nimga agastashte. My one more new year will come maximum. Do you? Happy New Year will come. Careful. You didn't realize half of your 2024 went in CA Foundation preparations. So January 2025 has to be a new year to you. Make it a new year. Don't put water on the entire efforts of last 6 months, please. Your 6 months. Yeah, half of your 2024 went in CA Foundation, CA Foundation, CA Foundation, CA. 2025 should not waste anything more than 10-12 days on CA Foundation. Enough. Okay, find a new reason. Enter. Listen, this will become an error of omission in cash book. We need to record it in the cash book. We cannot call it a reconciliation item. We should call it a rectification item. The cash book balance, whatever would have been given, would be incorrect. We need to add this dividend to that, and that balance will be called as balance as per adjusted cash book. From that adjusted cash book balance or amended cash book balance, we'll do BRS. So what appears in BRS is only timing differences, not all differences. What appears in BRS is only not all differences. But in the exam, you still write everything here unless they ask you to prepare amended cash book. Let me give you an overview of what is amended cash book. Okay, so when is BRS prepared? Whenever they want, they can prepare. Yeah, actually, whenever the management wants, whenever they feel passbook balance and cash book balance is not matching, they can prepare. But mandatorily has to be prepared at the end of each year. It has to be mandatorily prepared at the end of. Why? At the end of each year, you prepare balance sheet. In balance sheet, you'll write bank balance. That bank balance is there, no, in the balance sheet asset set. Supporting document in other passbook. So passbook balance is telling something else. Cash book balance is telling something else. You need to substantiate, no, how is this cash book balance correct? You need to check it with the passbook. Check this is the difference, and this is timing difference. Substantiated. You can show that. If no, then rectify that error first. Rectify the errors if any, and then record. Understood? Okay. Observe the next part here. Which balance to show in the balance sheet? Balance as per cash book or balance as per passbook? Neither. Balance as per amended cash book. Balance as per amended cash book balance is balance as per cash book plus or minus non-timing difference. Plus or minus. In BRS you do timing differences. In amended cash book you should do non-timing difference. Now the question is, what do you mean by non-timing differences? And what do you mean by timing differences? Differences between passbook and cash book arising otherwise than because of a reason of time is non-timing. Example, checks issued but not cleared, timing. Checks deposited but not cleared, timing. What is say direct deposit by customer not recorded, error, non-timing. Are you getting it? Bank charges not recorded in cash book, error. Bank interest not recorded in cash book, error. Errors in cash book, error. All of these are non-timing differences which need rectification. What do they need? Come on, let's see this. I'll give you errors. You tell me whether they are timing or non timing. Will you? Checks, read the question first. Checks issued but not deposited, or deposited but not. Tell me what is this timing, non timing? Pakka. Very good. Timing. Next one. Checks received but not deposited, or checks received and deposited but not cleared. ಸ್ವಲ್ಪ ಡೌಟ್ ಇದೆ, ಸುಮ್ಮನೆ ಇದೀನಿ, ಕನ್ಫರ್ಮ್ ಆದ್ರೆ ಗ್ಯಾರಂಟಿ. ಓಕೆ, ಟೆಲ್ ಮಿ ಟೈಮಿಂಗ್ ನಾನ್ ಟೈಮಿಂಗ್ ಅಂದ್ರೆ ಟೈಮಿಂಗ್ ನಾನ್ ಟೈಮಿಂಗ್ ಅಂತ ಡೌಟ್ ಇದೆ, ಅದಕ್ಕೆ ಐ ಆಮ್ ಆಸ್ಕಿಂಗ್ ಯು. If I am clear that it is non-timing and it is an error, then I will pakka do rectification in amended cash flow before I send it to balance sheet. Okay, so this is a timing difference. Like we have given, we have received, we have entered, they'll receive it later. Next one, direct deposit by customer into bank account. Non-timing. Customer has directly deposited it to bank. I should record in cash book. If I don't record it in my cash book, it will become error of complete omission. Am I right? Next one. What's after this? Payments made by banker on standing instructions not recorded in cash book. non-timing difference. This is an error. Then if I don't record it, it will become error in cash book. What's after that? Receipts collected by banker on standing instructions not recorded in cash book. Non-timing difference. Again, why? Error. See, banker has collected the money. Banker has recorded it in passbook. Don't you think I should record in cash book? If I don't record in cash book, it will become my error. Sixth one, bank charges recorded in passbook only. Bank charges are there, should be recorded in cash book also. It is recorded in passbook. I have not recorded it, it will automatically not come. I should only record. Timing andre ಏನು ಗೊತ್ತಾ? It is there in one book today, it is not there in the other book today, other book as of now. Give little time, it will automatically come. If the banker has recorded bank charges, if I don't record, I sit and then stare at my cash book, will the entry automatically come? I have to enter. Unless I enter that bank charges entry, it will never come in the books of accounts. You get it? So it is a non-timing difference. It's an error of complete omission. Needs rectification. Tell me about the next one. Bank interest credited in passbook only. Non-timing difference. Again, this is an error requiring rectification. How about errors in cash book? The name itself says no error. It is a non-timing difference means error. Errors in passbook, timing difference. Why? If the banker has done the error, banker will correct it. I cannot correct it. I just have to wait. I just keep waiting, it will get corrected. Can you go to the bank and then say, okay, I will sit, I will make double entry in your accounting package? No, you can't make the entry in their books of accounts. What can you do? You can maximum write one letter. Excuse me, ma'am, you've given me wrong credit of 10,000 rupees. Please take it back before I withdraw. Or you wrongly deducted this much of amount from my account. So you can only request and write a letter. Can you do rectification in their books? No, you cannot. So errors in passbook is timing difference. Errors in passbook is timing difference. So basically, timing differences are only three. Timing differences are only checks issued but not cleared, checks deposited but not cleared, errors in passbook. Other than this, everything else is errors in cash book. These have to be rectified. If they ask, if they don't ask, okay, write it in BRS. How to do amended cash? Very simple. Add items debit, less items credit. Add means debit, less means credit. In the amended cash book, start with bank balance as per cash book. Add items you write debit, less items you write credit, balance as per amended cash book. Start with the do BRS to arrive at passbook. Are you guys getting it? That's the end of the topic of BRS. If you would want, I will pick a question and then do it with amended cash book. Today, let's do a question on amended cash book. So let's see, where do we have this question? Give me one moment. Let me find the question. And I want silence in this process because I am not dancing. I am trying to find the question that you asked me to find. Let's go to bank reconciliation statement. Do you see anything here with amended cash book? With amended cash book, we have a question from our question 2A. From which attempt? Yeah, from November 19. Can we do that? Or the other option is we can do December 21 exam question. Both are 10 marks questions. 2A or 2C. 2C, December 21, more recent. We'll see both. We'll see the question and decide. Oh my god. I'll do December 21 question. I'll give this question as homework. This you try at home. You can ask me doubt if you want. Or you want me to do both, I'll do both. It's just waste of time. Shall we do this December 2021 exam question? Make a note in your book also. We're doing December 2021 examination question. December 2021. December 2021. Question 2C. This is a 10 marker. Cash book of G. They have not told the gender, Mr. or Miss, or is it some enterprise? Nothing is mentioned. 2021, no, December 21. Number 21, question 2C, 2A, 2B, 2C. Let's solve this. Can we start? Is this okay? Who asked the question? Is this question okay? You want me to solve that also? You tell me later. After I solve this, you tell. Come on, guys. Let's now solve question 2C from our December 2021 examination of CA Foundation. This question is on bank reconciliation statement with amended cash book. According to the cash book of G, there was a balance of rupees 4,45,000 in his bank. Oh, in his bank on 30th of June 2021. On investigation, you find that. Okay, this is balance as per cash book. Balance as per cash book, will write it in amended cash book as balance brought down 4,45,000. Is that what they've given? I'll do the adjusted cash book. This is only for errors rectification, non-timing differences. After I do all of this, I'll arrive at balance as per adjusted cash book. That balance as per adjusted cash book or amended cash book will appear in my BRS. For that, I'll do changes to find balance as per past book. So what will appear in BRS is timing differences. Timing differences. What will appear in amended cash book is non-timing difference. Non-timing difference means error in cash book. Non-timing difference means error in cash book. So let's read them. Checks amounting to 60,000 issued to creditors but have not been presented for payment till date. Timing difference is not our error. Check has been issued to the creditor. When the check is issued, I made the entry in my cash book already, because of which my cash book has gone down, because the entry is not made in passbook. Why is the entry not made in passbook? The check is not yet cleared. So balance as per cash book has reduced, balance as per passbook has not. Where are we making changes? Cash. What do I do? Add. How much would I add? 60,000. So I will write in my amended cash book as add. Checks issued but not cleared, 60,000. Everyone understood? This is the timing difference. Come to the second adjustment. Checks paid into bank. What is the second one? Checks paid into bank. Basically, checks deposited into bank. Amount into 1,10,500. Out of which checks amounting to rupees 55,000 only collected by bank up to 30th June 2021. See, out of 1,10,500 deposited, 55,000 is cleared. So 55,500 is not cleared. Do 1,10,500 minus 55,000. See, 1,10,500 deposited. Cash book increased by 1,10,500. Cleared 55. Passbook increased by 55. Difference is 55,500. Meaning, to the extent of 55,500, cash book balance has increased. Passbook balances. I'll repeat. To the extent of 55,500, cash book balance has been increased. Passbook balance has been not. This is timing difference. This is temporary difference. This is not an error. There is no need of rectification. There is only need of reconciliation. Where are you making changes? Passbook or cash book? Cash book. What should I do? Reduce. Shall I reduce it by 55,500? Shall I? I would write here less. Checks deposited but not cleared, 55,500 as minus. Got this? What's after this second one? Third one. A dividend of rupees 4,000, rent amounting to rupees 60,000 received by the bank and entered in the passbook but not recorded in cash. 4 and 60, banker has received but we didn't record in cash book. Clearly an error of complete omission. We have to record it in amended cash book. This is rectification to be made. This is not reconciliation. It's an error of omission. See, if you would have thought about BRS, it would have been 60 and 4. Passbook balances increase 64. Cash book balances not. Cash book you add. In amended cash book you debit it. Or in other way, it is receipt, no, 4,000 and 60,000. Not recorded. This receipt has been not recorded. Now record it. You would write 2 dividend, 4,000, 2 rent, 60,000. They are 2 different items. We'll write them separately. Let's not club them together. Understood this? What's after 4 and 60? Third one done. Come to fourth one. Insurance premium up to 31st December 2021 paid by the bank 2,700, not entered in cash. This is just like that. For no reason they've given up to 31st December. We are not going to do months basis, nothing required. Remember, 2,700 is paid by the bank. Banker has recorded it, but we have not recorded in cash. It's an error of omission. We have recorded in cash book. You get this? Passbook has gone down, cash book is not. Don't tell it's a less item in BRS. It is a payment to be recorded in amended cash book, credit side or the payment side. You got it? Is this an item of rectification or reconciliation? Rectification. This is an error of omission. Non-timing difference. I would write here by insurance premium 2,700. Did you all understand? What is after this insurance premium? The payment side of the cash book had been undercast by 500. So payment has been undercast by 500. This is an error. That much you understood. So payment has been reduced by 500. Record payment of 500 now. Undercast means reduce. No. This is payment side. Payment side they have not recorded 500. Undercasted. Now what to do? Record that payment of 500. Easy. Clear? Anybody has a doubt? Anyone wants me to repeat? What's after this? Bank charges of 150 shown in the passbook had not been entered in cash. Error of complete omission. You have not recorded this transaction. Rectification or reconciliation? Rectification. Amended cash book or BRS? Amended cash book. Bank charges. Payment or receipt? Payment. On the payment side, I would write here by payments. So this is a different one. I'll write by bank charges. Got it? What's after that? A bill payable of rupees 20,000 had been paid by the bank but was not entered in the cash book. So this is basically a bill, like we have one bills payable. I did not make the payment. I called the banker and told you pay this. The banker has paid. Banker has reduced my passbook balance. I should enter no in cash book. I have not entered in cash book. It's an error of omission. Error of, shall I record it now? Okay. Tell me, rectification, reconciliation. Rectification. Non-timing difference, timing difference. Very good. Amended cash book or BRS? I would write here by bills payable. How much is the amount? 20,000. Everyone understood 20,000? Very nice, yeah. And bills receivable. See, whenever they've given 2 points like this, read them separately. Don't try to read everything together and write the net amount. No. Read first part, overwriting, then read the next part. Bills receivable of rupees 6,000 had been discounted with the bank at a cost of rupees 100, which had also not been recorded in the cash book. Oh, what did I do? I have one bills receivable. I sent it to bank for discounting. Bill value is 6,000, discount is 100 rupees. 6,000, 100 rupees discounting charges if they take, how much money will they give? 5,000, 5,900 they would have deposited into my passbook. My passbook balance has gone up, but I did not enter in cash book. This is not a reconciliation item. This is a rectification item. I should have entered. No, I have not entered. This is an error of complete omission. Shall I enter it now in my cash book? Receipt or payment? Receipt. Is this a timing difference or non-timing? Very good. Bill discounted. Not recorded. I'll record now 5,900. Anything left in the question? That's it. Now take the total here. Write debit side total 5,14,900. Identify the balance carried. This is the corrected bank balance which should go to balance sheet. 5,14,900 minus 2,700 minus 500 minus 150 minus 20,000. 4,91,550. In my balance as per amended cash book, I'll start with 491,550. This balance. That's what I'll start with. Our BRS after amended cash book starts with balance as per amended cash book. It will not start with balance as per passbook. Got it? Help me. 491,550 plus 60,000 minus 55,500. 4 lakh. That is the balance as per passbook. This is a 10 marker question. We have a similar question. Do you want me to do one more? Yes? Okay. But I told you the question. Will you try that? Have you made a note of the question? Which question is that? Okay, I'll tell the name of the question. So, but this you understood, no? This is December 21, question 2C. This is December 2021, question 2C. I'll give you that question, other question that you should try. The other question that you should try is question 2A from November 2019. November 2019, question 2A. Will you try? You want a tea break? What time? Now. We'll do one valuation of inventory question and then take break. Pretty easy question. No drinking in the class is not allowed. You take the break, you finish it, and then you come sit in the class. What time did we start? Around 2.5 hours. Okay. I am worried. Like you will threaten me, no, sir. If you don't give break, no, tomorrow will not come to class. ಆಯ್ತು ಬರಬೇಡಿ ಎಕ್ಸಾಮ್ ಹೋಗ್ತೀರಾ ತಾನೆ ಹೋಗ್ಲೇಬೇಕು ತಾನೆ ಓಕೆ ಯಾ ವಿಲ್ ಟೇಕ್ ಅ ಬ್ರೇಕ್ ಆನ್ಸರ್ which one I showed no throughout okay it is 4:30 take a break see you all back in the class by 4:45 15 minutes is that okay 4:45 5 ಬಂದ್ರೆ ಬಾಗ್ಲಾಗ್ತೀನಿ 4:45 take a break. Come on everyone, welcome back to CA Foundation CA Foundation Marathon Revision. We were discussing the topic of BRS, no? We did one question on amended cash book also. Now let's start with valuation of inventory. In the beginning of our syllabus discussion, I told you transaction and event. I taught you how to recognize transactions and how to measure them and how to record them. This topic is an event. This is an event. It is not a transaction. Purchases is a transaction, sale is a transaction, valuation of inventory is an event. At the end of the year, you need to find the value of the inventory to be recorded in books of accounts. Because if you don't find the value of the inventory in terms of money, and if you don't record it correctly, full gross profit go in the. If GP is not right, NP is not. If NP is not right, capital is not right. Capital is not right. What is right there? Nothing. Got it? So valuation means representation in terms of money. What are you trying to represent in terms of money? You're trying to represent inventory in terms of money. Inventory can be classified into three categories. Number one, raw material. Number two, work in progress. Number three, finished goods. If in case I'm selling shirt, I make shirt by buying cotton, making it into thread, weaving it into cloth, cutting and then stitching it into shirt. So shirt is finished goods which is kept in the ordinary course of business for sale. Got it? So the traveler explorer shirt with the inspirational traveler image on it is the finished product that I'm selling. To make this finished goods, I use the cotton thread weaved into a cloth that is work in progress, which is in the process of being produced into finished goods. I'll tell this thread one fine day you will also become a shirt. Just have to believe and then hustle till that day. You get it? And before it became a thread, I will tell this work in progress thread. One fine day you were just a piece of cotton. You remember that? Today you are a thread. One fine day you will become a shirt. So take pride in how far you come and be hopeful about how far you can go. So the cotton that I buy is what we consume in production of goods. Cotton is raw material, thread is work in progress, shirt what I sell will become finished goods. We are trying to learn how to value all of them. Okay, very good. So the value of the inventory at which it should be recorded in books of accounts is of our greater significance, and this will help us determine our income. How does it help us determine our income? Observe. We know that GP is sales minus COGS, and we know that COGS is opening stock plus purchase plus direct expense minus closing stock. If in case I take that closing stock at wrong value, then my COGS will be wrong. When my COGS is wrong, my GP also will be wrong. Ooh. Another way, if you observe trading account, you write debit side opening stock and purchases, followed by sales on the credit side, direct expense on the debit side, closing stock on the credit. You take the total on the credit, post it to debit and find GP on the debit. If this total on the credit side is wrong because the closing stock value is wrong, total on the debit side is wrong, GP also will be wrong. See, this closing stock will decide GP. Wrong closing stock, wrong GP. Sometimes if you want to show more profit, just increase the value of closing stock and you'll get more GP. But there is a problem. You know what is the problem? This closing stock will become next year's opening stock. To the extent you increase current year GP, your next year GP will go down. So how do we increase? I'll show this to you. I don't know if I've showed it to you in your regular class. This is a stock sheet. So this is one of our client sheet. That day I opened it to show you people in the class. So this is how the inventory of a particular entity will be recorded. This is excess. This is from our state stock reconciliation that we did for a client in the past. So raw data is like this. We pick this literally from the inventory management system. So from the inventory system of the company, the software, where entire inventory, whatever is there, they would maintain in one software, no? From that software, if you take the entire data into an Excel, it comes like this. So you can tell this is their Malleshwaram branch, this is in the service workshop. So we can select where is it, like let's say Malleshwaram is one of the places. There's an, oh, this is exclusively of Malleshwaram. So they will show what is the product number, what is the name of the product, how much quantity of the product is there, how much quantity is displayed, what is the value of each product, multiply madi, value also will be formed. Value per unit, number of units and multiplication. So this is the inventory as per the software. We physically inspect the inventory and then check whether this inventory is there in the Godo. If it is not there, ask them why is it not there. Then if there is any reconciliation, inventory issue entry is passed, but inventory is not issued yet. So that is excess. Or what would have happened? We have dispatched the inventory to a customer. We did not pass the invoice yet. Why? We have sent it to them. They will see. If they say that this is the one that they want, then we'll pass the entry. If not, they'll return. Like goods sent on return or approval basis. We'll adjust all of that and ultimately match this with that. Once it matches, that will be the inventory that will take to our which item? Balance sheet. In this case, when we did, there was excess. Means what? In the stores, we found this inventory extra. This much of inventory was there in the store, but not there in the record. That's a question that we should ask. They should answer. How is it so? It has to match, no. And this is the shortage. There was a shortage. This is not there. This is a very old one, about 1.5 years ago. So maybe next time if it is there, I'll show it to people much in detail. So this kind of stock sheet we'd have to evaluate, and we prepare something cute and sweet like this in your exam. But trust me, it won't be so cute and sweet in the realistic world when we try to find the value of inventory. Let's go back to the presentation, what we were seeing here. All that I was trying to tell you here is, if in case these are the values of our items in the trading, you tell me how much is GP. 125 total on the credit, 125 total on the debit. Quickly find GP, balancing figure. 125 minus 55, 70,000 is my GP. Let's play with these numbers. I will take 25,000 to be the correct value of closing stock. I will increase it from 25 to 30. I wrongly took 30. I am making it as an error now. Then my total will become 130 on the credit side. Total on the debit side will become 130. You tell me how much will be my GP now. It will become 75. So what did I do? I increased the value of my closing stock. That in turn increase the value of my GP. Get it? So by increasing the value of closing stock, we increase our profit. So people can use this to do window dressing. People can use this to do. Alternatively, let me take my inventory not to be 25 but 20. I'm decreasing it by 5. Then what is the total on the credit? 120. Total on the credit 120. You are one step ahead of. How much will be GP? So GP went down to 65. So our conclusion is very simple. Yeah, with increase in closing stock, profit increases. With decrease in closing stock, profit decreases. Observe. With increase in closing stock, profit increases. With decrease in closing stock, profit. Did everyone understand this? And this will in turn impact our next year's opening stock. With increase in opening stock, profit decreases. With decrease in opening stock, profit increases. Ulta impact. Are you getting it? I don't mind, I can show it to you all day, but all I want you to remember is previous day if you have Tanglana left, it will become next morning's Chitrana. Basically, the closing stock of the current year will become opening stock of the next year. So if the current year closing stock is overvalued, next year's opening stock will be overvalued. If the current year closing stock is undervalued, next year's opening stock will be undervalued. See, let's take these numbers. You tell me, instead of taking 10, if I increase it, before that, find GP. 125 total on credit, 125 total on debit, 70 is balancing. Let's change our 10,000 opening stock to 15,000. 125 will remain same. 125 minus 15 minus 40 minus 5. GP will no longer be 70. GP will become 65. Observe, when I increase the opening stock, what happened to GP? Decreased. When I increase the closing stock, GP will, understood? Vice versa will work. I have a easier shortcut for you to remember this. But before the shortcut, if you want to see this, this is how it is. When opening stock increases, profit decreases. When opening stock decreases, profit. Okay, the easier way to remember is very simple. Yeah, you know this movie Om Shanti Om. In Om Shanti Om, not this track. There's another track, no, in which all the heroes come, all the heroes, so many people come. Every 10 seconds, people keep coming. They don't come free of cost. They charge money for coming into the song. Get it? So Om Shanti Om, OSO. So when people keep coming into it, profit keeps decreasing. Remember it like this. OSO, Om Shanti Om. Profits keep decreasing. If you know this much, then rest of it is easy. Opening stock overvalued, profits will decrease. Opening stock overvalued, profits will. What if I make it opening stock undervalued? Profits will increase. Ulta. Same. What if it is closing stock overvalued? Sorry. What if it is closing stock overvalued? Profits will ulta. Correct? No, profits will increase. What if it is closing stock undervalued? That's it. You just need to remember one line and rest of it will be opposite of it. Opening stock overvalued. Om Shanti Om, only profits will become less. If you remember that because of Om Shanti Om, profits come down. If you change O to U, up. If you change O to C, profits will increase. If you change two things, it will remain same. Easy. Or if you want to remember it without this, closing stock increase, profit increase, closing stock decrease, profit decrease. Opening stock increase, profit decrease, opening stock decrease, profit increase. It will work either ways. Understood the significance of inventory in profits? On this, there can be some kuti questions that can come. You should please be aware of that. Next thing is ascertaining financial position. This is important in valuation of our inventory. We need to value our inventory as per accounting standard 2. We need to value our inventory as per accounting standard 2. As per accounting standard 2, you tell me, boys and girls, is valuation of inventory an accounting policy or an accounting estimate? Accounting estimate. Very good. Wrong answer. It is accounting policy. We discuss in accounting policies example. Valuation of inventory is an accounting policy. So when we try to value our inventory, we need to follow paragraph 5 of AS2. Which paragraph of AS2? Paragraph 5 of AS2 will tell inventory should be valued at cost or NRV, whichever is less. Cost or NRV. The reason is conservatism. If the inventory that you purchased, when you sell, if you are going to realize lesser money, you need to book that loss today. You bought the inventory at 100, you are able to sell it at 120. So cost 100, NRV 120, you can make profit of 20. Don't record that profit right now. Record that profit of 20 only when you make that profit. However, you purchase the inventory at 100, you can sell it only at 90. You make loss of 10. Record that now only by expected loss. Book it now. How do we book the loss without making the sale? Very simple. Closing stock, don't write 100. Purchase 100, closing stock 100, no profit, no. Purchase 100, closing stock 90. So total debit side becomes 100, total credit side 100, 10 rupees loss. Did you understand? So we won't wait for sale. We'll record the loss now only. Pakka. Very nice. Yeah. What is it that you should know now is what and all does cost include? Cost includes three things. Number one, purchase price. Number two, cost of conversion. If it is raw material purchased to be converted to finished goods and sold. Third one, any other directly attributable expenditure which is incurred to bring the goods to its present location and present condition. I'll repeat, three costs are included. Number one, cost of purchase. Number two, conversion cost. Number three, any expenditure incurred to bring the goods to its present location, and there is a detailed discussion on what are other costs. Administration and selling and distribution cost is not included. Normal loss is to be included. Abnormal loss is to be excluded. Storage cost is to be taken if it is part of production. That is all for the purpose of detailed discussion. But for exam purpose, just don't worry. If you know this much, it is good enough. Okay. Conversion cost also, there is a detailed discussion that we should do. One thing that I would want you to know, when we talk about cost of purchase, what do we do with tax amount? Tax should be included, not included? Depends upon the fact whether input tax credit is available or not available. If input tax credit is available, then don't include the cost, don't include the tax in the cost. If input tax credit is not available, input tax should be included in the cost. Did you understand? We'll do that one discussion on GST. Remind me slightly later. We'll do couple of small examples on input GST, output GST, SGST, CGST, UTGST. How does it work? What is IGST? What is input? What is output? What is ITC available? What is ITC not available? What is the journal entries that we should write in each of the cases? Yeah, set top. That's it. A journal entry to write how much to pay, how much to not pay. We'll do one small discussion there. This will get covered. And like how we did previously, trade discount should be first deducted, and then only we'll consider the value. Ah, yeah, very nice. Yeah. After this is something that we'll not discuss. Okay. Then this identification of the value of NRV, whatever is there, no, cost or NRV, whichever is less. This has to happen per item. This has to happen item wise, not in total. If they give 5 inventory items, give cost of 5 items, NRV of 5 items. Don't do total cost, total NRV, whichever is less. Individual item, cost or NRV, whichever is less, and then do total. But that methods of valuation of inventory, on this there is a question in the recent RTP. We'll solve that also. Methods of determining the valuation of inventory. You should check, is the inventory items ordinarily interchangeable or is it not ordinarily interchangeable? What do you mean by ordinarily interchangeable? For example, this glass, what you see here, is it ordinarily interchangeable? Yeah, this glass can be easily replaced with this glass. Both of them are exact same design. Both of them do the same work. So if I am selling glasses, you know what will I do? I'll find the cost of this glass, multiply with number of glasses that is there in the godown. Understood? If you go to Reliance Trend, Max, same shirt, there'll be 100 shirts. They find the cost of one shirt, multiply it with 100 shirts. Tuck, 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 ready. That is inventory ordinarily interchangeable. Second case. First one, not ordinarily interchangeable. One product and other product are not same. For example, instead of going to Reliance Trends, you go to Lalita Jewelers. You see chain there. You ask the value of one chain. They will tell the value. Multiply with number of chains that is there in the blue. Can you find? No. Each chain value is different. Get this? There we follow specific identification method. What is the method? Specific identification. Fantastic. See, if the inventory is not ordinarily interchangeable, what method do you follow? Specific identification method. What if it is ordinarily interchangeable inventory? Considering historical cost, you can follow first in, first out, last in, first out, simple average, and weighted average. How many methods do we have? First in, first out, last in, first out, simple average, and weighted average. However, as per accounting standard 2, atta itta jana, madhyadalli kona, you cannot follow leaf on sap. What should you follow as per AS2? Either FIFO or VAM. Either FIFO or weighted average method. You cannot follow LIFO, cannot follow simple average method. They both are considered incorrect. Shall we do a question on FIFO or VAM? This is a question on VAM. Your recent RTP. Patafat will finish it. I'll take 5 minutes. Can I? Question number 6A. Madana. Okay, have a look. Let's now solve question number 6A from our Jan 2025 RTP. This question is on valuation of inventory. Start reading. Following are the details of material inventory bought and used by manufacturing company. The opening balance is nil and there is one purchase, one issue, one more purchase and two issues. You are required to find the value of the inventory applying weighted average method. Which method are they expecting us to follow? Let's follow weighted average method. So to begin with, what do you have? Opening balance of the inventory is nil on 1st of January 2024. I would write here 1st of October, 2024, the day before Bhai's birthday, Bhai ka birthday. So 1st of October, what is the balance of inventory? Zero. Hey, zero, no? Zero, zero. On the same date, what did you do? You buy. How much material did you buy? 200 units. Each unit is rupees 60. So you will write in receipts column. Receipt is inflow, issue is outflow, balance is whatever is there after receipt and issue. So on 1st of October, you bought 200 units at the rate 60 per unit. 200 into 60 becomes 12,000. Am I right? Now you didn't do anything else on this day. So on this day, on the closing time, your balance will be 200 units at 60 rupees per unit is 12,000. Got it? What is happening after this 1st of October transaction? Bhai ka birthday. 2nd of October. Whose birthday? Shastri ji. Issued for use. How much? 100 units. How many units did you issue? How many units do you have? 200. You have 200. In that you give 100. 100 units are issued at rupees 60, 6,000. Out of 200, when you issue 100, you are left with still 100. How much is each unit? 60. 100 into 60, 6,000. You had 200 units, you issued 100 units, you still left with 100 units. This is 2nd of October. What's after that? 3rd of October. See, whether you follow simple average, weighted average, FIFO or LIFO, all that starts mattering when you have more than one variant of inventory. When you have only one variant of inventory, it doesn't matter which method. All the methods look. Got it? So 3rd of October, how many units did you buy? 400 units at rupees 80. So I would write 3rd of October receipt. What am I going to write? 400 units at the rate 80. How much is 400 into 80? 32,000. Now it matters. Now observe carefully. Now, before this receipt, I already had 100 units at rupees 60. Do you agree with me? Now I additionally bought 400 units. I am going to tell I had 100, I bought 400, I now have 500. I had 100 units, I bought 400 units, I have together 500 units. I had paid 6,000 rupees for my 100 units. I paid 32,000 for my new purchase. Together 6,000 plus 32,000. I have 38,000 worth of inventory with me. I'll add the amounts and write because this is weighted average. And then find the rate. If it was simple average, I would have taken 60 plus 80 divided by 2. If it was FIFO or LIFO, I would have written two liners. 166,000, 480, 32,000. I would have written as two separate liner inventories. Because I follow weighted average method, I won't show 2-3 variants of inventory. I have only one variant of inventory. I have only one variant. 500 units, 38,000. 500 units if I pay 38,000, how much is it per unit? 38,000 divided by 500. The value of each unit has become 76. It is the weighted average rate per unit. What am I doing after this 3rd of October? Issued for use 200 on 4th of October, the date where we finished the entire cake that was left. How many units? 200 units. Each unit is of value 76. 200 into 76. 15,200. See, I had 500 units. In that, I have issued 200 units. How much will I be left with? 500 minus 200, 300. Each unit will be there at the same rate of 76. 300 into 76, 22,800. Did everyone understand? What is after this? Next transaction is on 7th of October, where I further issued 200 units. See, 7th of October, I further issued 200 units. Let me write here 7th October 200. What is the rate? Same 76. 200 into 76, 15,200. I had 300. From that I issued 200. I'm left with 100 units at 76 rupees, which comes to 7,600. This is my closing inventory as per weighted average method. Easy time pass question, no? Not up to your standards. But that's the answer. Got it? But we'll do one question of your standard also. Adjusted selling price method. Not up, actually easy only. Pretty. You understood not ordinarily interchangeable, ordinarily interchangeable? Yes or no? Ordinarily interchangeable, considering historical cost, these are the four methods. If you don't want to consider historical cost, but you still want to find the value of inventory, you have a method called as adjusted selling price method. What is it called? Here we don't keep a track of how much money did we pay to buy the inventory. Here we know the selling price. We know the, now in my go down when this inventory is there, I know the MRP of this. What price can I sell? From this MRP, I will deduct my standard profit margin. Let's say my profit margin is 30%. MRP is 100. So I don't have to remember 70. MRP 100 is there. I'll remember 30% profit margin. From 100 rupees, 30% if I eliminate, I'll get 70 rupees easy. Sir, when do we do this? When it is too difficult to track the cost of the inventory under FIFO, LIFO, SAM, BAM. Sir, which kind of industry does this? FMCG. Fast moving commodity goods. You have huge volume of very less value. Toothpaste, you have huge quantities. Each packet is 50 rupees. Too small to keep track of cost. So what do? You don't keep track of cost. You remember, Colgate products, whatever I sell, 15% margin. Pepsodent products, whatever I sell, 18% margin. Dabur products, whatever I sell, 20 to 25% margin. Patanjali product, 50% margin. So I keep track of the margins what I have. Usually it will be same. ITC same margin irutte, and HUL one margin will be there. You get no, based on the brand. Nestle one margin. All these FMCG companies will give a fixed margin of profits. Anyone who's in the business of FMCG products, you would know. So what you do? You go to your store, count the value of the inventory at MRP. At what value? Deduct the margin, you get the cost. Simple. Easiest way to value the inventory. Got it? Everyone? That's adjusted selling price method. Shall we do a question on this? There's one right here. Have a look. From the closing information, calculate historical cost of closing inventories under adjusted selling price method. There are three numbers. They want you to find one number. Shall we do it? Everyone's ready? Come on, let's solve question 6B from our Jan 2025 RTP. This question is on valuation of inventory. 6B is on adjusted selling price method. From the following information, calculate historical cost of closing inventory. So they basically want us to find the stock at cost. Which stock? Closing stock. How do we do this? See, based on the information that they've given, first I'll find closing stock at selling price. I'll find closing stock at, in the closing stock at selling price. If I eliminate profit, it will become closing stock at cost. Closing stock at selling price adjusted with profit will give me closing stock at cost. Adjusted selling price method means find the inventory value at selling price, adjust the profit margin in that selling price, find the cost. What does adjusted selling price method mean? Find the stock at selling price, adjust the profit, basically deduct the profit to find cost. Cost plus profit is equal to sale. Sale minus profit is equal to cost. Once again, what is it? Cost plus profit is equal to sale. Sale minus profit is equal to. Let's read this information and write it in the way in which we want it. Purchases made during the year is how much? 10 lakh. Okay, let me write purchases made during the year as 10. Purchases. What is the value of purchases that I made? 10 lakh rupees. This is at cost. Purchases, what we just wrote, is at cost. What is after this? Sorry, sales made during the year is 15 lakh. Sales is at selling price. No, I would write sales at selling price, it is 15 lakh. At selling price it is 15. What is after that? Opening inventory is nil. Nil means zero. At the beginning of the inventory we had nothing. The day I started my business I had no inventory in my. Later I purchased 10 lakh rupees worth of inventory. Now I made sales of 15 lakh and I still have inventory of 2 lakh at selling price. Who's telling it? I don't know the name. Selling closing inventory is how much? 2 lakh. At what price? Selling price, meaning whatever the stock that is there in his godown. If he sells it, he'll get 2 lakh. 2 lakh is not cost. We should find the cost. We should find the cost. Closing stock is 2. So listen to this guy's story. Selling When I started my business, I did not have any inventory. I purchased about 10 lakh rupees worth of inventory. I made 15 lakhs of sale. I still have 2 lakhs worth of inventory here. So 15 lakhs is the MRP of inventory sold. 2 lakhs is the inventory that is still there in the godown. 15 plus 2, 17 lakh is the selling price of inventory purchased. Do you understand? I have nothing opening stock. So whatever I have sold is from purchases. Whatever is left is also from purchases. I'll repeat. Did I have any inventory when I started my shop? No. So whatever I have sold is from purchases. Whatever is left with me is also from purchases. If 15 lakh worth of stock is sold, 2 lakhs worth of stock is still remaining. Can I say purchase of goods at selling price is 15 plus 2, 17 lakh? This inventory which I bought for 10 lakh can be sold for 17. I have sold 15 lakh worth of stock. 2 lakh is still remaining. Everyone understood? Now, a simple cross multiplication will give you the answer. If the cost of the inventory is 10 lakh, selling price is 17 lakh. If the selling price is 2 lakh, how much is cost? Very simple. इष्टके इष्टाद्रे इष्टके ಎಷ್ಟು इतने में इतना तो इतने में कितना ಇವಳಕ್ಕೆ ಇವಳೋನಾ ಇವಳಕ್ಕೆ ಎವಳೋ do it ಇಂತಕಿ ಇಂತ ಐತೆ ಇಂತಕಿ ಅಂತ do 2 lakh. Take your calculator, follow my instructions. 2 lakh multiplied by 10 lakh divided by 17 lakh. 1.18 lakh ante. 2 lakh into 10 lakh divided by 17 lakh ಮಾಡಿ ಅಂದ್ರೆ oh my god 1,17,647. That's the value of my inventory. If you don't like this, I have another slightly complex method. Can I? 10 lakh worth of inventory is sold for 17 lakh. How much is the profit? 7 lakh. Am I right? 7 lakh divided by 17 lakh. 41 point. You understood? No. 10 lakh worth of inventory, I'll sell it at 17 lakh. How much profit will I get? 7 lakh, no profit. Divide 7 lakh by 17 lakh. 41.17 percentage. No. From this 2 lakh, deduct 41.17%. 2 lakh minus 41.17%. Deduct the profit. You get same 1,17,647. Easy. Don't try to identify profit percentage in this. Sumne complication. They've asked you to find cost. Find the cost by cross multiplication. That okay? That's it. Easy one. Would you want to make a note of this? Would you want to make a note? If you want to, please do. If not, I'll take you to the next one. So what did I do? I took 2 lakh. I multiplied it with 10 lakh. That 10 lakh I divided by 17 lakh. And that's how I arrived at 1,17,647. Did you understand? 2 lakh into 10 lakh divided by 17 lakh is 1,17,647. Pakka? Cross multiplication. Or you can do ratio proportions. Product of means is equal to product of extremes. 10 lakh is to 17 lakh is equal to question mark is to 2 lakhs. Pakka? Anybody has doubt? No. So what we would be doing next is we'll understand how to do stock reconciliation. Yeah, there are two systems. What you read now is method. What is it that you read now? This is method. What is this? This is system. So to maintain inventory, there are two systems. One system is periodic. Another system is perpetual. What is perpetual system? Under perpetual system, you keep proper records. You keep books of accounts. For example, what you did here. This is perpetual system. What is this? Every day you maintain stock. For example, in this question, they had asked us what is the inventory on 7th of October. Instead, I will ask you a question. What is the value of inventory on 2nd of October? Can you tell? Yeah, 2nd of October, you had how much inventory? 100 units at rupees 60 per unit. Am I right? I'll ask you what is the value of my inventory on 3rd of October. Can you tell? I'll ask you what is my inventory on 4th of October, 5th of October, 6th of October, 7th of October. You can tell on any given date. A proper record. You maintain detailed record for every unit that comes inside and every unit that goes outside. Some people don't maintain this. This is too difficult for them to maintain. So they follow periodic system. They follow. So what is perpetual system? Based on book records. They maintain detailed records. Important. Write this down. Again, this you would have to read after class today. Periodic and perpetual. Lot of times the question has come on this topic. Lot of times the question has come on this topic. You won't even believe. Let me show how many times has this been asked in the exam. Just come to the index here. September also they'd asked. September 2024. Oh, hi. Bye guys, have a good time. I'll talk to you later. They're also writing examination with you people. They're part of the fast track batch. ಅವರಿಗೆ ಸ್ವಲ್ಪ ಭಯ ಕಡಿಮೆ. So they've seen very less. So they have that privilege of opening the door and seeing. No, I think. No. ಅವ್ರಿಗೂ ಭಯ ಇದೆ. Okay, let me show valuation of inventory. Observe, yeah. See, valuation of inventory. How many times have they asked this? Perpetual and periodic difference between. See, in November 19, 5 marks difference between, just a difference between answer and periodic inventory system they had asked. When that COGS formula output baridu, you need to write theory also. Once in November 22, that's a theory question, 2 marks, true or false. They asked one time, then that's again a 2 marker. They've asked again in September 2024. 2 times it's been asked. What is that? Write difference between periodic and perpetual inventory systems. What happened? They won't ask this time. ಹಂಗೆ ಮಾಡ್ಕೊಂಡು ಹೋಗಿ ಬ್ಯಾಕ್ ಟು ಬ್ಯಾಕ್ 2 ಸತಿ ಹೊಡೆದ್ರೆ ಏನ್ ಮಾಡ್ತೀರಾ? Travis said back to back centuries. What did you do? Nothing. Okay, so please do read this part, will you? This is not Ashish Chanslani. Okay, hello. Okay, इस क्वेश्चन पिछली बार आया था तो इस बार नहीं आएगा. One sin, which one? This one. Please don't do such trend analysis. Please don't do it. Okay, study this part. You please study. What is happening? They sent one message. They got one reply. Over. Shall we focus here, please? See, I told you under perpetual system you maintain the detailed record. You write each day's issue, each day's receipt. On any given day, you can tell the closing stock. Under periodic system, you don't do that. You do COGS formula. You know COGS formula? Yeah. What is COGS? Opening stock plus purchase plus direct expense minus closing stock is equal to cost of goods sold. Cost of goods sold can be found by another formula. Sales minus profit. I'll repeat. Opening stock plus purchases plus direct expense minus closing stock is equal to COGS. Is also equal to sales minus gross profit. What we do is we remove that word COGS. We'll write opening stock plus purchase plus direct expense minus closing stock is equal to sales minus gross profit. Opening stock, I know last year's closing stock. Am I right? Purchases, payments, whatever I have done, looking at that, I'll understand purchases. Or creditors ledger, if you do, you'll get it. Or all the invoices, total amount, purchases, you write. Direct expense, cash book payment, write direct expenses. Opening stock over, purchase over, direct expense over, closing stock, Gutila. That's what we're trying to find. I'll come to this side. Sales, I will know. Debtors account total, cash book ali cash sales. Take it together. Sales also is available. GP, percentage of sales is found as GP. Apply that. Closing stock formula dali balancing figure. This is incorrect way of doing it. But the problem is you can't maintain the detailed records, or you have not maintained the detailed record. What to do in that case? You find opening stock, you find opening stock by last year's closing stock, purchases from cash book and creditors, sales from debtors account and cash book, and GP as a percentage of sales. You put everything in trading account, find closing stock as balance sheet. Or see it this way: trading account, opening stock, purchase, direct expense, sales, closing stock, GP. You get it? Opening stock, last year closing stock. Purchases, either you would have paid cash or there would be creditors. Together you will write here. Sales, either you have received cash or debtors. Together you write sales. On that sales, you put percentage, you get GP. Closing stock is found as balance. You tell me, is this correct method? Unscientific, incorrect method of accounting. But if you have not maintained records and you still want to find the value of inventory, this is the option. That, my friends, is this method. In this method, we do that physically inspection to check whether the inventory is correct or not. If in case there is some inventory lost, you will not be able to identify. Some inventory is lost, you can't find, it will become difficult. Under this method, it will become nice. You know some value as per the record. You will physically also inspect. Whatever is the mismatch, you will understand where did this inventory go. Here, you can't do what to say record only. Physically, you count, that only you write as inventory. What is there is only written. So, no reconciliation possible. So, under perpetual system, you can have control. Under periodic, you can't have control. Are you getting it? When it is impractical to follow perpetual, we follow periodic. Perpetual is detailed table. Periodic is applying COGS formula. A little bit of theory, but it is good to know. Last time they had asked for 5 marks. Okay, now friends, very good. The last part of your inventory chapter is stock reconciliation. What is it? Now we need to find the value of the inventory by physical verification to write it in my books of accounts. But lot of times what happens is you can't count it on the year end date due to several reasons. I want to count my inventory to write. I go to count that day they are doing full business. They'll say, sorry sir, we can't close the shop on 31st March for you to count. I will say, okay sir, you continue doing business, I will continue counting. Can I count? I'm counting from this side. After I counted something, they've taken it, they've issued it. After I come here, they bring some inventory and then keep here. I can't count. So if I want to count number of people inside the class, I should first make all of you sit and I should close the door. Then I start counting. Take one gun, like 1, 2, 3, 4, 5, 6, 7, 8, 9. He was moving, he didn't die in one bullet. So that's how I count. If the inventory is moving, I can't count. No. You get what I'm trying to tell? So, but if the business is running, you can't stop the movement of inventory. So what does the entities do? They wait for a date other than 31st March. You send a request to the client saying, sir, we need to do physical verification of the inventory. They will say, sir, 5th of March, sorry, 5th of April is Sunday. 5th of April, I will close the warehouse. You can come for the stock. Now tell me, what date do I prepare my balance sheet? 31st March. What date am I counting the inventory? So when I count everything, I'll get the inventory as on 5th April. Can I write 5th April inventory in 31st March balance sheet? Can I prepare balance sheet for 5th April? I am doing counting on 5th April. I want to prepare balance sheet on 31st March. How do I do it? Very simple. I count it for 5th April and I come home. When I come home, I'll call them and tell, sir, 1st of April to 5th of April, whatever transactions have happened, you tell me. Purchase and sale. After 31st March, you added purchases, deducted sales, you are added 5th March, 5th April. I'll do ulta. I will add sales, deduct purchases to arrive at 31st. I will reverse what is, I will undo what has happened. So what do you do? 31st of March, they add purchase, deduct sales, they come to 5th April. From 5th April, when I come back to 31st March, I'll undo it. I will add outflow plus inflow. I'll arrive at 31st March. This is called backward reconciliation. What is it called as? I'm coming back in time. Get it? The other way is, instead of 5th April, my client can tell, sir, please come on 25th March and then do counting. Can I do counting on 25th March? If I do counting on 25th March, I will ask them, sir, 25th March to 31st March, whatever has happened, you send the details to me. I will add all the purchases from 26th to 31st, deduct all the sales at cost. I will arrive at 31st of March inventory. Do you understand this? So this is two forms of reconciliation. These two forms of, if the stock is counted on a day after year end, the stock is counted on a day after year end. You counted on 5th April. I need to come back to 31st March. It is called as backward. If I've counted the inventory before year end, I need to go forward to 31st March. It is what is a forward reconciliation. What to do in the case of backward reconciliation? Very simple. 31st of March is the year end. I've counted the inventory on 5th of April. I start with 5th of April's inventory, and what do I do? Whatever has happened between 31st and 5th March as a purchase which was previously added, now I will deduct it. Inflow of goods will be deducted. and whatever has outflow between 31st and 5th, I will add. You understand? In the backward, what to do? Less inflow, add outflow. Are you getting it? Let's say, let's make a video from here till here. You are going forward. You do one thing. You take apple. Okay. You bite. You put the apple into your mouth, and then you spit the seed, and then go forward. Now let's play this video reverse. What do? You take the seed into your mouth. You put the apple out of your mouth, and then you walk back. So apple inflow, seed outflow. Correct? When you're doing backward, seed inflow, apple outflow. Understood? Okay. Very good. If it is forward, same thing. Add inflow, deduct out. See here. But one thing very important to be remembered is sales and sales return is there. No, that should be adjusted for profit margin and then taken to outer column. And purchase less purchase return is what we do when we write it to outer column. Okay. Fantastic. Then what about forward reconciliation? Like I mentioned, 31st March is the year end. We have counted the inventory before, that is 25th March. We need to go forward. What to do? I'll take stock as on 25th March, so that I'll add inflow, I'll deduct outflow. Inflow is purchase, outflow is sales. Got this? Okay. Very nice. Yeah. So today's homework, please do try couple of questions on this, and you might get stuck. You come back. So you tell me what are the specific ones that you would want me to solve in the class. If there is any specific question that we'll take up in tomorrow's class. In the recent RTP, though, there is no question on this. But September 24 exam, there was a question, and even the last RTP had a question on this. And you need to know couple of topics very importantly along with this. Number one, goods sent on return or approval basis. Number two, consignment basis. I'll give you an overview for you to know. Let's start with goods sent on return or approval basis. In goods sent on return or approval basis, there is only sending of goods at the beginning. Ownership is still there. We transfer the effective possession of the goods. We are the owner, but we don't have it in our godown. Are you getting it? It is a sale only when they accept or the time to return has lapsed. If they have not accepted and if the time has not lapsed, inventory is with them, but it is yours. Inventory is in their godown, but it is yours. So I have sent the goods on return or approval basis. It is in customer godown. I am finding my value of inventory. I counted the inventory in my godown. I have counted all of this. This is mine. But what is not there in my godown, what is there in customer's godown is also mine. So that has to be added. That has to be, are you getting it? Very good. Now, another point is, what if I have received the goods on return or approval basis? It is there in my godown, but it's not mine. But when I physically counted the inventory, I've already counted this. So I should deduct. But at cost, remember that profit adjustment. Second thing is consignment. What is it with regard to consignment? Consignment is again a principal and agent relationship. Let's say I am consigner. I am consigner. I have a consignee who sells the goods on my behalf. I have sent the goods to consignee to sell the goods on my behalf. I have not sold. I only sent. I have ownership. Possession is with them. They have not sold. I am trying to find the value of my inventory. I counted the inventory in the godown. Whatever is in my godown is mine. But whatever is there in consignee's godown is also mine. I need to add that into my inventory. Understood? Next point. I have received goods on consignment from somebody. Someone else has sent goods to me for me to sell. Now that inventory what they have sent is there in my godown, but that's not mine. But when I counted the inventory, I counted that also. So what should I do? Deduct it, because I have the possession of it with me on the date of stock count, but that is not my inventory. Everyone understand this? Okay. Fantastic. Yeah, that's with regard to stock reconciliation, what you should know, but you would have to practice problems on this. This one topic what I would have loved to do problems in the class, but I'm keeping it for tomorrow. I want you to try solving problems on this, and if you get stuck, you tell me. Tomorrow anyways we'll do one question on stock reconciliation. I would want you to try before I solve. Is that okay? Okay. Very good. Yeah. So can we now step into the next topic of all fine? Hey, he came till here. I thought he'll hit me now. And he's like, he came to say, I will leave. He's like, yes, that would have become truth. Would have told me no, don't go. Take care. Can I see you tomorrow? Ah, yeah. Bye. Okay, yeah. So the usual tradition is like this. We at least do till depreciation. And we can touch bills of exchange also. Let's do it till then. Shall we? Come on. Let's start with the topic of depreciation. Are you with me? Very good. What is depreciation? What is depreciation? Systematic. Starting ಹೇಳ್ತಾ ಇದ್ದೀರಾ sir, starting trouble ಅಲ್ಲ. We know starting sir, but we don't know after. We know ending is called depreciation. Systematic allocation of depreciable amount over the useful life of the asset. Whenever we buy an asset, we have a specific cost for that asset. This cost of the asset, listen, yeah. Instead of buying the asset, I can take it on rent. If I take the asset on rent, I rate rent to P&L account. So let's say I didn't buy the machine, I took it on rent. P&L account debit side I rate rent. P&L account credit side I'll write revenue that I earned from that specific asset. Matching concept. But if I buy the asset, what do? That asset will go to balance sheet asset side. Revenue on that asset is appearing in P&L account. There is no matching. So what do? This asset is there, no. I'll cut it into small parts. That small portion I'll write it to P&L account every year. Why? I am allocating the cost of the asset over the useful life during which I am taking the benefit from that asset. Because from that asset there is benefit in this year, from that asset there should be cost also in this year. If not, I can't find correct profit. Are you getting it? So it is systematic allocation of depreciable amount over the useful. What is depreciable amount? Total depreciation over the useful life. Total cost of the asset minus the scrap value will give me depreciable amount. Observe this. So I'll take as per schedule 2 of Companies Act 2013, depreciation is systematic allocation of depreciable amount over the useful life. Observe, why do we charge depreciation? Boring reasons: wear and tear, obsolescence, change in fashion, change in customer trend, all of this, reflection of time, decrease in market value. Objective, like I mentioned, no, we need to do matching concept. We need to find the correct profit. We need to know the cost of production. So we basically provide with our depreciation. If you don't provide depreciation, asset will be appearing in the balance sheet at a huge price. One fine day its value will become zero, literally, but in the balance sheet it is still there at historical cost. We should not suddenly make that asset from 10 lakh to zero. From 10 we should make it 9, 8, 7, 6, little we should reduce. If you keep the asset at 10 lakh, you earn 2 lakh rupees revenue from that. Entire 2 lakh will become profit. You will do party with the 2 lakh rupees. One fine day, you know what will happen? Asset will become zero. Entire profit you used up. You don't have any money for replacing the asset. Instead, you made 2 lakh revenue from the products made out of that asset. From the 10 lakh, you wrote 1 lakh to P&L account as depreciation. Profit became 1 lakh. You have earned revenue of 2 lakh, but profit is only 1. You will know, oh, 1 lakh rupees cash that I have is not profit. I should save it for replacement of the asset. Getting it? To create that sense of funds for replacement of the asset, depreciation helps. Understood? Is it too fast? Okay, there are several factors that you should consider in computing depreciation, and the factors that is supposed to be considered for depreciation we'll discuss is all given by accounting standard 10 PPE, not accounting standard 10 fixed assets. Old accounting standard was fixed assets, new accounting standard is PPE. So what do you mean by PPE? ಅದು ಗೊತ್ತು, ಎಕ್ಸ್ಪ್ಯಾನ್ಷನ್ ಕೇಳಿಲ್ಲ. What do you mean by PPE? Property, plant and equipment is tangible items. First point, it should be tangible, should be able to touch it, and these tangible items should be used for any of the four purposes. For any of the four purposes, tangible. Number 1, yeah, production of goods. Number 2, rendering of services. Number 3, administration purpose. Number 4, renting. It should be used for one of these four purposes. What are the four purposes? Number 1, used in production of goods. Number 2, used in rendering of services. Number 3, rental purpose. Number 4, one among these four purposes you should be able to use this asset, and its expected useful life should be longer than 12 months. or greater than 12 months, then it is property, plant and equipment. Read, what is PPE? A tangible item held for use in production of goods, use in rendering services, rental purpose or administrative purpose, and expected to be used for longer than 12 months. Then it will become PPE, property, plant and equipment. And this kind of property, plant and equipment will be recorded at three items which will be included into its cost. Number one, purchase price. Number two, directly attributable cost. Number three, estimated cost of dismantling. Estimated cost of dismantling, there will be no questions in foundation, but you should still know, it's part of your syllabus. Purchase price is the money that you paid to buy the asset. Directly attributable cost is the expenditure that you have incurred till the time the asset is ready to be put to use. Ready to be, after you buy the asset, transportation, freight, octroi, assembly, installation, trial run, all the cost together is directly attributable. What do you mean by estimated cost of dismantling? At the end of the useful life of the asset, you need to remove that asset. For that, you might have to incur some expense. That is estimated cost of dismantling. That is to be incurred at the end of the useful life. To discount it to today's date, whatever arrives, time value of money you should estimate it to discount it to today's date. That you add, that becomes the cost of the asset. Everyone understand? Does it make sense a little? Very good. But estimated cost of dismantling, you don't worry. And focus will be right now shifted to methods of depreciation. This is where the questions will come from. There are several methods, but what methods are there in your syllabus, we'll discuss first. I'll tell you what is allowed as per accounting standard 10 also. The methods that is there as per your syllabus is straight line method, WDV method, then production units method, machine hour rate method, production units method, machine hour rate method, depletion method. These are the methods that is there along with sum of your digits. As per accounting standard 10, you are supposed to follow SLM, WDV or production units only. First three methods are approved by AST. Others are not. You will not follow others. You will only be following how many as per accounting standard 10 PPE, straight line, diminishing balance and production. How to pick this method of depreciation? What is the basis? The method of picking the depreciation depends upon the pattern of usage based on which the economic benefits is taken over the useful life. Pattern of usage based on which the future economic benefit from this asset is taken. You get what I'm trying to tell? If in case you expect the future economic benefit from this asset is going to be straight line, year 1, year 2, year 3, year 4, benefit derived, what you say, what you should be saying as future economic benefit from that asset is a straight line. Every year the economic benefit is same, then the method of depreciation will be straight line method. Under straight line method, how do we find depreciation? You know it. We take original cost, we deduct scrap value, divide it by useful life. You take original cost, you deduct scrap value, you divide it by useful life, you will get the depreciation for each year. And such depreciation what you found for year 1 is same as depreciation for year 2, same as depreciation for year 3. Depreciation changed in each year, charged in each year of useful life is same. You getting it? If they give depreciation as percentage, remember such percentage is applied on the original cost, not on the decreased value. Got it? Next comes our WDV method. Is it passed? Okay. Next comes our WDV method. Under diminishing balance method, we believe that the utility of the asset is high in the earlier years, it is low in the later years. Year on year, the utility of the asset is decreasing. Then what to do? Charepandi. We'll apply one method of depreciation which will give high depreciation in first year, lesser depreciation in later years. What is that method? WDV method, which gives higher depreciation in first years, lesser depreciation in later years. How do we find depreciation under this method? We know no depreciation first year is more, second year is lesser than first year, third year is lesser than second year. How do we find? Percentage of depreciation will be applied on the written down value, not on the original cost. I agree. I accept it. What you told. The percentage will be applied on WDV. But how do we find this percentage? 1 minus nth root of residual value divided by cost of the asset. 1 minus nth root of residual value divided by cost, where n is number of years of useful life. No, percentage is same for all the years, but it will be applied on WDV. You need to find that part. They tell no 12.5. This is how you find. N is number of years of useful life. Residual value is value at the end of the useful life. Original cost is the cost that you buy. Usually this percentage will be given. Never asked in the exam for you to find, but still part of the syllabus you should know. So I have mentioned it here. Is that okay? What will we do now? Let's do one question on this. Shall we? There's one question in the recent RTP where they've asked us to depreciate an asset. I think there is change in the method also. They adopted WDV. Usually they were following SLM. Let's see, whatever it is. Madana, shall we? Original cost to WDV. There is change in method of depreciation. Remember, whenever the pattern of usage, what is it? Pattern of usage is there as a basis for determination of depreciation. That pattern of usage can change. You are expecting the pattern to be straight line. Which method did you follow? Then the pattern of usage declined. Change it to WDV. This pattern is there, no? It is expectation, it's not reality. You expect it to be straight line. You expect it to be depletion. You expect it to vary with production. So remember, accounting for depreciation is done based on the pattern of usage, on the basis of the expected economic benefit from that asset. If that expected economic benefit changes, you can change the method of depreciation. Can you change the method of depreciation? Yes. One question, you correct answer. Okay. Change in the method of depreciation. Is it change in accounting policy or is it change in accounting estimate? Change in accounting estimate. Change in accounting. Why? Depreciation is picked based on scrap value, based on useful life, based on pattern of usage. All the three are accounting estimates. All the three are accounting based on three estimates. If you find one number, that is also estimate, no? Am I right? It's change in accounting estimate. Did everyone understand this? Fantastic, yeah. So whenever there is change in accounting estimate, remember, you should give prospective effect. What effect? Prospective means from that moment you change. What is retrospective? You should change from the beginning. Oh, not possible. Prospective, change from now. Change from now. Okay. Shall we do this question? Is everyone with me? Deep Lakshmi. That should be what? Looks like some nickname. Looks like some nickname. Okay, maybe Deepa Lakshmi. What? He does some deep sea diving or very okay. Yeah. I don't know sometimes how ICA does this. Once you guys won't believe, in CA final question paper, if I'm not wrong, there was one amalgamation question. They had given the name as Namo and Raga. Namo Limited took over Raga Limited. They had given like that. Unwanted controversy. Why? This is not Instagram reel. You should not catch attention in the news for wrong reasons. Okay, shall we solve this? Come on, yeah. Let's now solve question number 7 from our Jan 2025 RTP. This question is on depreciation topic. Start reading. Messrs. Deep Lakshmi purchased a brand new second-hand machinery on 1st of April 2020 for rupees 1,60,000. After buying it for 1,60,000, they've incurred overhaul expenditure and erection charges of rupees 40. See, you didn't buy a new machine. When you buy a second-hand machine, you need to open the entire machine and then check each part. Whichever part is not working, you replace it with a new product, new part which is working. That's called overhaul. When the asset is about to die and its useful life is over, you give it a new life. That is called overhaul. You, in fact, it's almost like buying a new asset. You check every small nut, every small bolt, every small portion of that machine, replace it if required. Are you getting it? So that 40,000 is capital expense because it is incurred before the asset is put to use. So that cost of the asset that you bought is 160 plus 40, 2 lakh. This is purchased on 1st of April. Before I write anything else, let's quickly see the end of the question and see what do they want us to do. You are required to prepare machinery account for the years 2020 to 2024. So they want us to do it from 2020 to 2024. 4 years they want us to do ledger. Whenever question comes on depreciation, please don't use your second PUC skill set, starting the ledger account and straight away computing the numbers whenever required. Please don't do it. This is not second PUC. Number of adjustments are not limited like your 12th grade. Always do working note and then do the ledger. Common complaint from student is, sir, doing working note takes time. Without doing working note, passing exam takes time. You get it? Do working note. And whatever you're telling, no, it takes time. It is okay. Amount of time that is spent on working note, same amount of time you save when you do ledger account. Once working note is done, all the numbers that you want is there. Just have to put the totals into ledger. When you're doing ledger, you don't need question paper, you don't need calculator. You're just posting numbers. So just think you're doing a favor to me and then do working note in the examination. Will you? Let's start. 1st of April 2020, 2 lakh rupees asset purchase. But they've asked ledger. They've asked ledger. Working note is working note. Working note is not answer. So what you do is, the moment you start with the answer, leave the first page for answer. Ledger. Second page you do working note. After you do working note, come back and fill the ledger. So for the evaluator, he will see ledger first. For you, you did working note first. Is that okay? So let me write here, 1st of April 2020. I have purchased a machinery for 1,60,000, incurred 40 on overhaul. Can I write 2 lakh as the cost of the machine purchased? Very nice. What's happening after that? Another machine was purchased on 1st of October 2020. Same year. Same year. So I would write 1st of October 2020, purchase of another machinery. What is the name of the machine? Another machine. 80,000. You don't have to name them machine 1, machine 2, machine 3. Second hand machine, another machine, new machine. What's happening after that? On 1st of October 2022, the machinery installed on 1st April 2020, second hand machine, was sold for 1 lakh. When are we selling? 2022. Which year are we? 2020. So 2020, 2021, 2021, 2022, we should do accounting. Then in 22, 23, we will sell. Till then you would have to wait. Okay. I need to provide for depreciation till that date. They're telling, under the existing practice, company provides depreciation at 10% per annum on original cost. Original cost means SLM. Original cost method, they're providing depreciation at this rate. And this continues till 1st of October. And on 1st of October, I sell that second hand machine. I buy another new machine for 30,000. Right now, we'll go till 1st of October 2022. Shall we? What is the method of depreciation? Original cost. What is the rate of depreciation? 10%. Come on, let's provide depreciation till 31st of March 2021, end of the year. On 2 lakh asset, I'll provide 10% depreciation. For how long? Full year. Why? When did you buy it? April. When are you depreciating? 31st March. Full year this asset is there with us. So shall we give full depreciation? 2 lakh into 10%. This another machine is there, no, 80,000. That is not there for the entire year. We bought it only on 1st of October. Depreciation has to be provided for October, November, December, January, February, March. 5 in the mind, 1 in the hand. After 5, 6. 6 by 12. 80,000 into 10% into 6 by 12. How much do we get? Total depreciation 24. Find the value as on 1/4/2021. 2 lakh minus 20. 1 lakh 80. 80 minus 4, 76. Put them together, 256. Everyone understood 2 lakh 56? Okay. Now, remember the sale. When is it? 1st of October 2022. Not in this year. This year is ending on 31st of March 2022. Next year it will get sold. Shall I give full depreciation for this year? Remember the method? Straight line method. Depreciation is applied on original cost. How much will be depreciation? 2 lakh into 10%. 20. Here, shall I write same 4,000? No. 4,000 is for 6 months. So I should do 80,000 into 10%. But this time no 6 by 12. Because it is there from April to March. Full year. 8,000. How much is 76 minus 8? 68. This 160. Here depreciation 28 in total. Help me with the total balance of WDV. 2,28,000. This year there is sale. This year there is, when are you selling? 1st of October 2022. Depreciate it till 1st of October and then sell. Depreciate it till the date of sale. Find the WDV on the date of sale and then sell. I would write here 1st of October 2022. Can I depreciate? Don't depreciate both the assets. Depreciate only the asset which you are selling. Which asset are you selling? The asset which was bought on 1st of April 2020, the second hand machine. Only this will be depreciated. Shall I? Very good. Help me find depreciation amount. 2 lakh into 10%. Into how many months? April, May, June, July, August. How many months is that? Please do 6 by 12. 2 lakh into 10% to 6 by 12. 10,000. See, this 1,60,000 worth of asset is depreciated by 10. It should become 0. If I write 1st of April 2023, this should be 0. How will it become 0? I have to deduct it by 1,50,000. See, 1,60,000 minus 10 is how much? I would get here 1,50,000, no? If I don't want to write 1,50,000 there, I would have to write minus 1,50,000 here. Then it will become 0. This is sale. But this is cost price of the machine sold. But selling price is different. Don't try to do repair here. Here you just send it outside. In this working note, we just send it outside. 1,50,000 sent it outside. So this column will become 0. Now open another working note. And here you please write. You tell me. 1st of October. Cost of machine sold. 1,50,000. Now tell me what is the selling price. Was sold for rupees 1 lakh. Was sold for rupees. Here I would write sale price 1 lakh. 1,50,000 worth of machine is sold for 1 lakh. So have you received more or less? Less. Sale price is less. Cost is more. That difference of 50,000 is more. Understood? Okay. Write a journal entry for this. It will help you later when we do ledger account. So whenever you received cash, you debited bank or cash. How much cash did you receive? 1 lakh. What is the value of the asset going out? Asset going out should be credited. Am I right? Asset that went out is 1,50,000. Cash that came in is 1 lakh. Difference of 50,000 debit, loss. P&L account debit. If it was profit, it would have been 2 P&L account. Profit credit, loss debit. Am I right? Don't try to fit this working note into the main table. Any sale transaction, bring it out at cost and then account it as a separate transaction later. Got it? This journal entry, what you wrote here, is going to help you when you do the ledger account. So please always write this. There's no marks for writing this, but this can help you in writing the ledger, which will get you marks. You get it? Not every ball will help you get the wicket, but certain number of deliveries that you bowl will set up the batsman in such a way that later you can pick his wicket. Understood this? Let's go to the next one. On this date when you sold this, you bought an immediately another asset. See, another machine is bought for 30,000. So what do you do here? On 1st of October, 1st of October only, no? Another machine was bought on 31st December. When did you buy it? End of the year, 31st December. I will write purchase. How much is the value of new asset? 30,000. Did you understand this? Here depreciation 10, here 1,50,000 total. I'm just writing this to be the total column. This is the most important column in my entire working note. What is that? Total column. You know why? When I do ledger, I will only look at the total column and pass the entries in the ledger. I don't need individual asset column. I only need total column. Artha agtidya? Now, I need to charge depreciation on 31st of March 2023. Shall I? Don't try to do depreciation on the total. You need to do depreciation on individual columns. First, shall I start with second hand machine? On this, no depreciation. Why? Machine is only not there. How will you charge depreciation on that machine? This machine, another machine, it is there for full time. Shall I charge full 80,000 into 10% depreciation? 80,000 into 10%, 8,000. And this machine, 30,000. How much percentage depreciation? 10%. Shall we charge 10% depreciation? Yes, but it was bought only on 31st December. January, February, March. How many months? So I'll do 30,000 into 10% into 3 by 12. How much depreciation do we get? Can I say total depreciation to be 8,750? Now help me find the balance of the value of asset. This is 0. This is 68 minus 860. This is 30 minus 750, 29,250. Together 89,250. Understood? Easy. 2023. Under the existing practice, they are following original cost on 1st of April 2023. That is the year that we just wrote. What are they doing? It decided to adopt WDV method of depreciation at 15. So from now they are going to follow WDV. I'll write 31st of March 2024 less depreciation. At what rate? 15%. So apply 15% on 60,000, 15% on 29,250. See, when we adopted, we are applying on 60 and 29,250. We are not changing it from the beginning. This is prospective. This is, if we say retrospective, from the first year we need to recompute the depreciations and then do. That you don't have to do. How much do we get? 60,000 into 15%. 9,000. 29,250 into 15%. Can I say together depreciation is 13,388? Yes. Here I would write 1st of April 2024 balance. This is 0. This is 51. This is 29,250 minus 4,388. How much is it? 24,863. Add them together, you will get 75,863 to be the value. If you are done with this working note, you are 2 minutes away from finishing the problem. Till now, whatever time you took is only the build up for the solution. Now, execution of solution. The stage is well set that you can ace 10 marks in next 2 minutes. Whatever you did, for this don't expect marks. For this entire working note, you might hardly get 2 marks, 3 marks. But this working note from here, whatever the total amounts are there, post it to ledger to get the remaining 8 marks. Are you getting it? It takes 10 minutes to go from 0 marks to 2 marks. It takes 2 minutes to go from 2 marks to 8 marks, 2 marks to 10 marks. Understood what I'm trying to tell? Don't try to aim only on that 8 marks and then say I'll get 8 marks in 2 minutes. Agal. Straight away you can't do that. Understood? I hope everyone has written this alongside. Okay, some of you have written this alongside. Fine. Can I start with the ledger? They've asked us to do ledger from 2020 to 2024. My focus is only on this column. So what do? Shall I highlight it to another color? I'll make it yellow. Yeah, will you see this column only and answer it for me? In 2020, what's happening? Purchase of 2 lakh. Am I right? So this is my machinery account. I would write 1st of April 2020 to bank account 2 lakh. See, positive item debit, negative item credit. Positive is increase in the value of the asset, debit. Sale, depreciation, decrease in the value of the asset, credit. Understood that? 2 lakh over. What's after 2 lakh? Purchase 80. So purchase 80 on 1st of October. Shall I write debit side 80 to bank account? I'll write here 1st of October 2020 to bank account 80. Everyone understood this? Tell ya. So 2 lakh over, 80,000 over. Then what do we have? Depreciation of 24. Depreciation is decrease in the value of the asset. What is the journal entry? Depreciation account debit to machinery. So in my machinery account, I would write on 31st of March by depreciation 24. Understood? Take the total 2 lakh 80, deduct 24,000, you get 2 lakh 56,000 as balance. This will be written in next year, 1st of April 21 as balance brought down 2 lakh 56. If you observe here, you have exact 2 lakh 56 as balance. Next year you have only one thing, depreciation of 28. Shall I do depreciation of 28? Here I would write 31st of March 2022 by depreciation 28. Write 2 lakh 56 and deduct 28. You get 2 lakh 28,000. That is the balancing figure. In 1st of April 2022, that is balance brought down 2 lakh 28. Observe here also we have 2 lakh 28,000. Shall I write this depreciation of 10,000 now? Help me, what is the entry for depreciation? Depreciation account debit to machinery. In the machinery account, I would write here 1st of October by depreciation 10,000. Here, after I write this by depreciation 10,000, 30%. Then there is sale. This is slightly tricky. Don't try to adjust this right now. 150. We have done working note for this machine sold. See here, entry cash debit, P&L debit to machinery. In machinery account, buy cash, buy P&L, buy cash 1 lakh, buy P&L 50. I will write here on 1st of October 2022, buy cash, buy P&L, buy cash 1 lakh, buy P&L 50, cash or bank. Understood? 1 lakh 50 sale, together 1 lakh 50. Put them together, 1 lakh 50 is the cost of the asset sold. Say too fast. What's after this 1 lakh 50? There is purchase of 30,000. Shall I write two bank accounts? Purchase, machinery account debit to bank account. Machinery account debit to bank account. 30,000. And what do we have after that 30,000 purchase? We have depreciation 8,000. Depreciation is an expense. Entry is depreciation to machinery. In my machinery account, I'll write by depreciation 8,000. Everything is done. Identify the closing balance. 2,58,000. 2,58,000. Find it. What do we get? 89,250. That should become the opening balance for last year. Check the working note. You would have had exact same 89,250. See, charge depreciation of 13,388. You should get 75,860. Shall I charge depreciation 13,388? 13,388 depreciation charge is expense. Debit, asset value decrease. Credit, entries depreciation to asset. In asset account, I'll write by depreciation 13,388. Take the total 89,250. Right here, deduct 13,388. 75,862 is the closing value. You have 75,862 here. 75,863. 1 rupee rounding off difference. Got it? That's how you do accounting for sale of an asset alongside with change in method of depreciation. Is this easy? Very good. And talking about other methods of depreciation here. Production units method. Shall we come back to production units method? Observe production units method. Under this, with the change in the level of production, there will be varying depreciation. When you do high production, depreciation will be high. When you do even high production, depreciation will be even more high. When there is decrease in production, depreciation will also be less. More use, more depreciation, less use, less depreciation. Am I right? Hell yeah. Very good. Let's say I bought one washing machine. You tell me how many years will a washing machine last? How many years will it last? 5 years. So talking about home. Just imagine I put that washing machine in a PG and then say PG service, when you use the PG, washing machine free to use. Why it will not even last for more than a year. Are you getting what I'm trying to tell? In fact, you when you come to class, you'll ask your friends, 1 kg clothes 5 rupees. If I'll wash it in my PG and then bring 5 rupees pocket money agate. You collect clothes from your friends, you go take it to PG, and everyone is sleeping in the night, you wash those clothes and then you bring them to class and then give it to your friend. Yeah, passive income. You can generate that. So there, see, that machine will not last for 5 years. It lasts only for 1 year. However, let's say you alone live in a house, you bought one washing machine. It will last for 15 years. How many clothes will you wash? You will wash it once in a week. Number of clothes that you put to wash, you don't have to use the machine every day. It will last for more than 5 years in that. However, in a family of 2, little less. In a family of 4, even less. In a family of 10, 10 you cannot call it family. 10 will be like mini zoo. So football team. Correct, no. So as number of people will become more, no, the utility will become more, the period of the utility will become less. So production units method says that depreciation follows the production units. Higher the production, higher the depreciation, lower the production, lower the depreciation. Do you agree with me? So what we do in this case is, we will not measure the useful life of the washing machine with number of years. We will tell how much or how many clothes can be washed. We will say it can wash 50,000 kgs of clothes in its lifetime. Are you getting it? Or it can be run for these many times. The machine can be run for 50,000 times. If you use up 50,000 times of the machine in 1 year, it will last only 1 year. If you use it over 4 years, over 4 years. So basically you're telling how much is the useful life of the asset. This asset can be used to produce 10,000 units. Now it's up to you whether those 10,000 units will be produced in 1 year, 2 years, 3 years, or 4 years. First year you produce 1,000 units, depreciation will be proportion to 1,000. Second year you produce 2,000 units, it will be double of first year's depreciation. Third year you produce 500 units, it will be half of the first year's depreciation. Get it? So observe this. Under this method, useful life of the asset is measured in terms of production units, and depreciation is dependent on units of production during the year. You agree with me? Very good. Observe the method of depreciation's formula. How do we compute? We identify depreciable amount, that is original cost minus scrap value. Multiply that with number of units produced during the year. Number of units produced divided by total useful life in units. Divided by total useful life in one of the very simplest and easiest methods to do depreciation under. Ledger can also be prepared, but usually not asked. Easy. You write the value of the asset one side, depreciate, closing balance, opening balance, depreciation, closing balance, opening. Okay. In the similar lines to production units method, you have another method called machine hour rate method. Very similar to production units. Here, the useful life of the asset is not measured in units. It is measured in machine hours. See, listen. How many years will a laptop survive? You told 5 years. Time is a good unit of measurement, but years is not a unit of measurement which is acceptable. 5 years anta helbaaru. It depends upon how many hours do I use. If I use this laptop for 11 hours every day, it is different. If I use it for 2-3 hours every day, then it will work for longer. So how many hours do I use is important, not number of days. Not number of days. See, if you use 11 hours every day, 11 hours every day, using it for 1 month is as good as using it 5 hours every day for 3-4 months. You understanding? So very simple thing is, we should measure the life of the asset in time, not in years, not in months, not in days, but in hours. So they say this TV can survive 15,000 hours. This printer can print 65,000 pages. So they measure it in much finer units of measurement. Based on that, when we do depreciation, it becomes machine hour rate method. Very similar. Read this. Under this method, useful life is measured in terms of, very good, depreciation is dependent on machine hours run during the year. Depreciation is equal to cost minus scrap or residual value multiplied by number of machine hours run during the year divided by total useful life in hours. Okay, everyone understood machine hour rate method? Very nice. Then we have a method called depletion method. What is it called? Depletion method is followed in the case of natural resources or wasting assets. What do you mean by wasting assets? Oil well, iron ore, stone quarry, granite deposits, coal deposits, all of this. So very similar to production units. Very similar to, it is just that the resource involved is slightly different. Higher the production or higher the extraction of the asset, higher the depreciation. Lower the extraction, lower the depreciation. And in this case, we don't buy the asset, we take it on lease. We don't buy the, we take it on lease. So we don't prepare asset account, we prepare lease account. We prepare, and in that lease account we go on writing the depreciations. Observe here. So this method is used to depreciate natural resources or wasting assets. Natural resources will not be bought, it will be taken on lease. Valuation of reserves is based on actuary. That value of the lease no is actuarial science valuation. You don't have to know what it is, they will give as per actuarial valuation. Total extraction is 2000 tons or 2 lakh tons. They'll give the number. That number is based on actuarial valuation. You just have to use that number to find the value of depreciation. How do we do it? Same. Lease amount multiplied by extraction done during the year divided by total expected extraction over the useful. Same like production units. Names are different. Extraction during the year divided by total extraction over the useful life of the asset. Clear? Next thing what will we do is sum of year digits method. That's the next one. Under this method, how do you find depreciation? Formula is quite unique, but before we go there, I have an interesting question to all of you. Tell me, what is sum up to 100 numbers? 1 plus 2 plus 3 plus 4 plus 5 till 100. How much is it? How do you do it? How do we do it? It's very simple. I'll write 1 plus 2 plus 3 plus 4 plus 99 plus 100 is equal to n. I'll flip it like this. What will I write? I'll write 100 plus 99 plus 98 plus 97 plus 2 plus 1 is equal to n. Same, no? 1 plus 2 plus 3 is nothing but 3 plus 2 plus 1. Am I right? Now, I have two equations. Add them. 100 plus 1, 101. 99 plus 2, 101. 98 plus 3. At the end, 2 plus 99, 1 plus 100, 101. Everything is 101, no? Am I right? Yeah. Is equal to 2n. Now, n you keep that side, you bring 2 this side. This 101 is there how many times? 100 times. 101 into 100 is equal to 2n. N is equal to 101 into 100 divided by 2. And that 100 is 100 plus 1, no? In the beginning, 100 then. So we're finding sum of 100 numbers. So it is, if you're finding sum of n numbers, n plus 1 into n divided by 2 will give the answer. If we're trying to find sum of n numbers, we should do n plus 1 into n divided by 2. That gives the answer. We'll use this as a basis to determine depreciation. Let's say the useful life of the asset is 5 years. Useful life of the asset is 5 is n. 5 plus 1, 6. 6 5s are 30. 30 by 2, 15. Basically, 5 years is the useful life. 5 plus 4, how much? 9 plus 3 plus 2 plus 1, 15. So, first year depreciation is 5 by 15. Second year depreciation is 4 by 15. Third year depreciation is 3 by 15. Then next year 2 by 15, 1 by 15. That's how I do depreciation. You understand this? I'm doing did not understand. Useful life is how many years? 5. Take sum of the years. 5 plus 4 plus 3 plus 2 plus 1, 15. 5 by 15 first year depreciation. 4 by 15 second year. 3 by 15 third year. 2 by 15 fourth year. 1 by 15 fifth year. Like WDV, but there is a specific pattern. There is a specific. So how do we determine depreciation under sum of year digits method? Cost minus residual value. Multiply that with remaining useful life at the beginning of the year. 5 for first year, 4 for second year, 3 for third year, 2 for fourth year, 1 for fifth year. Divided by sum of years. Sum of years is 15. That is n plus 1 into n divided by 2. Easy. These are the methods of depreciation. If they ask a kutty small question, they'll ask on production units, machine or depletion or sum of year digits. If they want to ask a big question, they'll ask on straight line method or diminishing. With straight line method and diminishing, they will play asset is purchased in the middle of the year, asset is sold in the middle of the year, and change from SLM to WDV, WDV to SLM, all of that. When they ask production units, machinery rate, depletion or sum of year, straight question, they'll give one asset, specific useful life, they ask you to compute depreciation. Easy? Okay. Next, we'll understand the topic of revaluation and change. This is the last topic. We'll do bills of exchange tomorrow. Yeah, don't worry. But we have a little bit of this pending. Another 20 minutes, so I'll take 15 minutes minimum. Focus. Change. Hey, if anyone is getting late and you told at home that you will be home by 7 o'clock, you can go. Home is a place, not a person. Okay? If someone is waiting, you told them you will go out for call. Salpa idi paravailla. New Year agli, exam agli, later you meet. Yeah. Tata, bye bye. Hangewa tumba duro hobeku. Yeah. Happy journey. Yeah. Change in method. Change in method of depreciation. Change in useful life or any other change. How do we account? Hey, anyone who's getting late can leave. I have no problem. Yeah. Bye bye. Is not leaving. Okay. Change in method of depreciation. I told you change in method of depreciation is accounting estimate. We should give what effect? What effect should we give? Prospective effect. What effect? Similarly, what if there is change in useful life of the asset or anything? Let's see the first one. Shall we see change in method of depreciation? Where do we come from? Huh? Going home only. Huh? ಆಯ್ತು. ಒಂದೇ ಸತಿ ಎದ್ದೋಗಿ ಇನ್ಸ್ಟಾಲ್ಮೆಂಟ್ ಅಲ್ಲಿ ಎದ್ದೋಗ್ಬೇಡಿ. Excuse me, sir. Quick. Time out ಕೊಡ್ತೀನಿ ಮತ್ತೆ. Focus here. Shh. Organization as machinery bought for rupees 1 lakh. What price did we buy the asset? Mobile ಹೊರಗೆ ಹೋದ್ಮೇಲೆ. Asset is bought for 1 lakh. Useful life 5 years. Scrap value 0. How much is depreciation for each year? 20 alva. They followed SLM for first 2 years. First 2 years they did 20, 20, 1 lakh minus 20, 80, 80 minus 20, 60. 60 should be depreciated over next 3 years, 20, 20, 20. No, they changed the method of depreciation after first 2 years to WDV 25%. So third year 60, straight away you will apply. Actually, you should apply 25% WDV. I should correct it, but I hope you understood. You apply on that. From that year only you change. Okay. Then the next one, expected useful life. Expected useful life means you expected the useful life of an asset to be 5 years. Cost of the asset 1 lakh. How much is depreciation for each year? 20, 20, 20. First year you depreciated 20, 80 over. Second year you depreciated 20, 60. Remaining useful life is 3, no? You re-estimated it not to be 3 but to be only 2. What to do? That 60 will be depreciated over next 2 years, 30, 30. Get it? That is change in expected useful life. And same will apply when there is change in expected residual value. The year in which the change happens, from that year only we give impact, because these are accounting estimates. Change has to be accounted prospectively. Change has to be accounted. Prospective means what? From the year of change we account for change, not from the beginning. Okay. Very nice. So this is that 1 lakh. 1 lakh worth of asset. Useful life 5 years. Scrap value 0. 20 depreciation. You did it for first year. You did it for second year. Third year, before you could do depreciation, there is another piece. Sorry, third year also we did 20. Fourth year 20. Fifth year 20. Then comes the line of information. See here, at the end of year 2. At the end of at the end of year 2, remaining useful life was estimated to be only 2 years. 2 years over no 60. 60 is actually depreciated over 3. Now it is re-estimated to be 2. So what do? This last year depreciation should not come. Are you getting it? So that last year's depreciation is there, no? 20. That will be added to year 3 and year 4 plus 10 plus 10, making it 30, 30. 60 minus 20 ala, 60 minus 30, 30. 30 minus 30 0. No depreciation for year 5. It will all get over in year 4 only. Because we re-estimated the useful life at the end of year 2 to be only 2. Actually, at the end of year 2, remaining useful life should be 3. Okay. This is how you account for change in useful life. And last topic, revaluation. Hey, we still have provision for depreciation. Okay, I'll share one video on provision for depreciation. See that today before you come to tomorrow's class. If you get stuck, we'll do question on it tomorrow. If you are comfortable, we'll go to the next topic tomorrow. There are two things. One, you should do problem on stock reconciliation. 2, you should do problem on provision for depreciation today. Please do it today without fail. Okay. See, revaluation of property, plant and equipment. There is one value. We feel like that value is not the correct value. What do? Revalue madana, you do it. That is revaluation. So what do you do in revaluation? You assign it a new value. That new value what you assign can be more than the old value. It is more, it is called upward revaluation. The new value what you assign can be less, that is downward revaluation. When you revalue the asset upward, asset account will be debited, credit will be given to revaluation reserve. Credit should be given to. Okay, now let me explain what happens with this revaluation reserve. Asset is 10. Asset is no revaluation. Useful life 10 years. Scrap value 0. How much depreciation for each year? Hey. Asset is 10. Scrap value 0. Useful life 10 years. Depreciation for each year 1000 every year. Now I find 10,000 not correct. I will revalue the asset from 10,000 to 11,000. I revalued it upward. So the value of the asset has become 11,000. Every year I need to revalue 11,000 divided by 10, 1,100. If I would have not done revaluation, asset was 10. What is the revaluation every year? 1000. Now when you revalue the asset from 10,000 to 11,000, what is the depreciation for each year? 1,100 in P&L. Depreciation increased by 100 no every year. There is revaluation reserve created 1,000 rupees. This revaluation reserve will be transferred to P&L account. Retained earnings, balance sheet, not P&L account. Balance sheet ಬರುತ್ತಲ್ವಾ, P&L, net profit carried down, balance sheet you add, no? There you transfer 1/10 every year, 100, 100, 100, 100, 100. Because of 100 rupees depreciation extra, every year profit decreased by 100. That profit will come sadly to balance sheet. Today I made 100 rupees less profit. Why? Because of excess depreciation. Then revaluation reserve will tell excess depreciation happened because of me. Because I arised, value of the asset went up by 1,000, because of which you are taking 100 rupees extra depreciation. Don't cry, I will give you 100 rupees. So 1,000 itala revaluation reserve will become 900. 100 will come to P&L. Total profit in the balance sheet will be same. Next year again 100 rupees depreciation extra, revaluation reserve will give 100. Again 100 rupees depreciation extra, revaluation reserve will give 100. So for the next 10 years, depreciation instead of 1,000 it will be 1,100. Revaluation reserve of 1,000 will be transferred to retained earnings 100, 100, 100 every year. Do you understand this? Ultimate impact will be same. You say, sir, then why should we do this? I told you, no. Revaluation. You want to show the asset at new value in the balance sheet. You want to show the asset at new value in the. This is upward. This is upward. See there. What do you do with revaluation reserve? Treatment of revaluation reserve. It is transferred to P&L account over the remaining useful life of the asset. In the pattern of usage of the asset. In the pattern of usage, in the way in which you get the economic benefit from the asset, in that pattern. If it is SLM, SL. If it is WDV, WDV. Production units, production units. What is downward revaluation? Decrease in the value. Asset will be credited, debit will be P&L. Asset will be credited, debit will be, that entire amount will go to P&L account one time. Ashte, Mogit. By conservatism. You are bringing down the value of the asset. This is because the depreciations that you charge in the past is incorrect. You have already charged this in the past. Now only we have delayed. Don't defer it further. Immediately transfer it to P&L and close it. Did you understand this? Immediate recognition of loss considering conservatism. Okay. Everyone. Very good. Yeah. Then this is the point. Let's say a machine was bought for rupees 1 lakh. Useful life 5 years. Scrap value 0. You tell me what will be depreciation? 1 lakh minus 0 divided by 5. Every year depreciation 20, 20, 20. After year 2 it was revalued by 15,000. Then what to do? First year you did 20 depreciation 80. Second year you did 20 depreciation 60. Third year to 60 you add 15 making it 75. Now 75,000 should be depreciated over the remaining 3 years. 25, 25, 25 will become the depreciation. Did you understand? I can do a detailed problem, but this we don't have so much time. Get it? No. Entire course is about 225 to 230, sorry, 240 to 250 hours foundation. This won't even come to 12 hours. So do 12 by 250. It won't even come to 1%. 0.048 into 100 madila. 4.8%. 4.8% of time I should finish the entire syllabus. So you get it, no? But I have to run little faster. Okay? Yeah. Yeah. That movie they show in Instagram reel, 1 minute telly, they show that something like that. 2.5 hours movie I'm supposed to show in 1 minute. So that's slightly high expectation. So there's one topic that we did not discuss in depreciation, that is on provision for depreciation. I'll explain the concept of it to you, but I will let you people do one problem, master problem, the one which is there in our ICA study material. So you please do that before you come to tomorrow's class. Give me one moment time. I will explain what is provision and why does the company create provision for depreciation. Can I? Sorry. ಏನಾಯ್ತು? Focus. Can I have your attention? Provision for depreciation. Tell me, what is the journal entry for depreciation? Depreciation account debit to you credited asset, no? Now come back to basics. First 1 hour of discussion. Crediting a real account means what? Golden rules only you tell me. What is a real account rule? Debit what? Comes in. Credit what? So you wrote depreciation account debit to asset. Did the asset go outside? Did the value of the asset, did like part of the asset go out? No, nothing, no. So whenever you credit the asset, it actually means the asset will go out. Is the asset going? No. It is expected to be decrease in the value. Not even actual. Expected. Exactly 10% agata. Our expectation ashte. So our expected decrease, which is an accounting estimate, how can you literally credit the asset? It is incorrect. It looks like you are selling the asset. You have not sold the asset. It is expected decrease. You have to create provision. You should not write it against the asset. So usually we write the entry depreciation to asset. We don't want to credit the asset here. So what do? I debit depreciation. I credit provision for depreciation. I credit. This is like bad debts. Now I have debtors of 1 lakh. If the customer doesn't pay me 10,000, what does it become? Bad debt. Debtors will become 90,000. Customer has not told that he will not pay. I am skeptical that he will not pay. Will I read it as bad debt? No, no. It is provision for bad debts. It is provision for. There is difference between bad debts and provision for bad debts. You get this? So they're saying there is difference between actual decrease and expected decrease. So what they do is asset will be shown in the balance sheet asset side at 1 lakh. Depreciation of 10,000 will be called as provision for depreciation 10 liability. Next year, asset will be again 1 lakh. Provision for depreciation will become 20. Third year, asset will be 1 lakh. Provision for depreciation will become 30. Are you getting it? But for the sake of presentation, what I do, I'll not show provision on the liability side because it has a relative asset. So we'll deduct this provision from 1 lakh. I'll write 1 lakh minus 30,000 provision. 70 is the book value of the asset. This is different from without provision. In without provision, what do? 1 lakh minus 10, 90 first year. Second year, 90 minus 10, 80. Under with provision, first year, 1 lakh minus provision for depreciation 10, 90. Second year, 1 lakh asset minus 20,000 provision for depreciation 20. If I deduct, I'll get 80. So provision will go on getting accumulated. So first year, asset 1 lakh, provision 10,000. Second year, provision 20, 30, 40, 50, 60, 70, 80, 90. 10 years over, asset 1 lakh, provision 1 lakh. Provision credit, asset debit. If you scrap the asset, provision to asset you do, both you close. On the date of sale, you will close the asset account by crediting. Wherever the asset goes, provision follows. Wherever the asset goes, provision. Let us say at the end of 8 years, asset is 1 lakh, provision 80,000. Asset is sold for 80,000 rupees. Asset credit 1 lakh, provision debit 80,000. Provision debit 80. Debit 80, credit 1 lakh. Book value came to 20. Same, no. Then you write the same purchase consideration there and then identify profit or loss. Everything is same. Whenever you sell the asset, you usually write the entry cash account debit, P&L account debit to asset for sale of asset at loss. I won't write book value of the asset credit. Instead, I'll credit original cost. So I will debit accumulated depreciation. See here, cash account debit selling price, P&L account debit will be loss. I will credit my asset with original cost, debit accumulated depreciation. Everyone understood this part? Pakka? If it is profit, instead of P&L account debit, it will be P&L account credit. This is provision based accounting. Everything else is same and simple. Just have to remember the concept that whenever we depreciate the asset, the value of the asset decreasing is not actual, is expected. So I will not credit my asset. Instead, I will credit provision for depreciation. That provision will be there till the date the asset is there. The day asset is sold, we credit asset, debit provision. Instead of crediting asset by 20,000, I will credit asset by 1 lakh, debit provision by 80. That's nothing but 20 crediting to asset. No. Did you understand? I'll maintain provision till the date of sale. Hey, Aglila, 5 minutes. This is provision. Then comes disposal. So, 5 minutes, Andre, 5 minutes. Now, on the date of sale, I taught you entry, no? Bank account debit, P&L account debit, accumulated depreciation debit to asset. Entry, what is the entry? Bank account debit, money received, P&L account debit, loss, accumulated depreciation debit to asset. In asset ledger, we'll write credit side, by cash, by provision, by P&L. Is the asset sold 3 times or 1 time? 1 time. Why did you write 3 times by cash, by P&L, by accumulated depreciation? That's the reason you open disposal account. You understand? So what is the journal entry without disposal? See here. Cash account debit, P&L account debit, provision account debit to asset. No. Asset is credited with 3 items. In assets ledger, it will come 3 times. Are you selling the asset 3 times? Only once. So what you do, you transfer everything to one dummy account called disposal account. You transfer everything through one dummy account called disposal. What is disposal account? Very simple. Yeah. Cash account debit is there, no? To disposal account. P&L account debit is to disposal account. Provision for to disposal account. Disposal to asset. Sir, then disposal will get closed. Exactly. That's what I'm trying to tell. See the entry: cash debit, P&L debit, provision debit to asset, cash to disposal, P&L to disposal, provision to disposal, disposal to asset. You route everything to one account. By doing this, you know what will happen? In the asset account on the credit side, there will be only one item. By you will remove the entire value of the asset, put it in disposal account. There only you put cash, there only you put accumulated depreciation. There you will find profit. If you don't do this, in the asset account credit side, there will be multiple items. You don't want to write multiple items. If the asset is sold once, you want to write only one item on the credit. This is the point that I wanted to prove on disposal based accounting. So far, once it's been asked in the exam, don't ignore this and then go. Please read this part also. So today, what I'll do is I'll share one question on disposal accounting, one on provision for depreciation, and I'll share stock reconciliation about 2-3 questions which is there, which has been asked in the last 2-3 exams. So today I have a homework to do, so that you will also feel like you've done something on the topics that we did in the class today. So like usual, this is not like anything which is new. Okay, every time we do till depreciation. So very rarely it has so happened that depreciation was also left incomplete. In one of the attempts, depreciation was also left incomplete. Today, if it would have started at 8, no, I would have finished bills of exchange and final accounts. I would have touched, just at least touched. Never mind. So what will we do tomorrow? Let's start with bills of exchange. Let's have a quick on bills of exchange. Once quick is over, then we'll do final accounts and incomplete records, followed up with partnership, incomplete records, NP1 company. Is that okay? It's little too much. You guys need to understand. Yeah, but we can't help. It's your syllabus. You are writing exam, and we have to run. Is that fine? Very good. Yeah. So shall we take a break for the day? We have finished chapter 1, 2, 3, 4, and 5 in today's class. Tomorrow let's do 6, 7, 8, 9, 10, and 11. Okay, and we also simultaneously finish the questions on RTP in the topics that we just did in the class. Did you guys learn something new today? Did you guys have a little fun today? Remember, life is not a battle to be struggling, it's a game to be enjoyed. Till the time you learn something new or you're having fun, it's all good. The day you guys stop learning something new or stop having fun, trust me, you might start struggling because you might be in a battle. So thumb rule to stay happy is pretty simple. It's to stay in the game. So for one last time on this day, I have just one simple question for all of you. Are we in the game? Yes. Are we in the game? Yes. On the top of your voice, are we in the game? That's it, guys. Tata, bye-bye. Take care. See you all tomorrow in the morning at 8 o'clock in this room. Yeah, till then have a great time. Bye.